from these tariff policies, the likelihood that the US economy would just moderate this year was pretty high anyway. US consumers were saving almost nothing last year. You had markets pricing in huge amounts of good news. You had 2 years of extraordinary fiscal stimulus under the Biden administration that was due to wear off. And so what you actually have is you have this cyclical downward momentum and then these structural downside risks. That's a lot of pain potentially to come through to the US economy. My base case is actually not recession. I see about a 35% risk of that. The lesson from, say, the UK Brexit was actually economies tend to muddle through. The US economy is very dynamic, but I still find this hopium that you mentioned is just the theme in markets, and I don't see how it's very sustainable at this stage.
Does that mean we're misplaced pricing in just 2 cuts from the Fed this year, Callum?
Oh, that's a great question. I think the Fed, in all likelihood, would prefer to be cutting interest rates given the downside risks and given the fears of recession. But you need to get through this very likely immediate hump in prices as firms try to pass some of these tariffs on to consumers in the US. And that puts the Fed in a very difficult position. It's dual mandate, maximum employment and price targeting, stable inflation is on a collision course with tariff policy. The last thing the Fed wants to do after this very bitter period of inflation that we have just had is start cutting interest rates as prices are rising. Keep in mind, the Fed normally reacts more strongly to downside risks to growth and employment than upside risks to inflation. So this is a very unusual situation. My hunch is we'll get 3 cuts this year. Once the Fed starts to move, probably in Q3, they'll start to move quickly, but at least for now they have to sound hawkish.
Well, what we saw in the data yesterday, Callum, was this fear that Priya Misra from JP Morgan talked about us yesterday, the idea that services inflation starts to decline and goods inflation starts to reaccelerate. To her, that was a red flag and a warning that consumers are soon going to have to make hard choices, and you get some sort of demand destruction coming in to this economy. Is that a concern for you too, that flip for where the inflation from the data is coming from?
That's absolutely right. So if we get significant goods price inflation, especially in inelastic categories, those are the essential products, not discretionary spending, just essential products. And this is happening as consumers are turning fearful and as broad financial conditions tighten. What you'll find is consumers will be forced to reallocate spending from discretionary services towards non-discretionary goods. That actually may make the arithmetic a little bit easier for the Fed, because if they can say, well, look, services prices give us a better handle on underlying inflationary momentum. Goods prices are given as a signal to this self-inflicted inflation shock. Actually, we can look through this a little bit and we can start to sound a little bit more dovish. But for me, the key question for the Fed is over the next 2 to 3 months, which breaks worst, inflation to the upside or economic data to the downside? Ultimately, that will decide the trade-off that the Fed makes between its inflation and employment mandates.
Callum, how difficult is the data going to be to understand over the next few months, especially as we're in this 90-day pause and there are reports of shipments taking off nonstop about ports all of a sudden being overrun? The assumption is that they will be to get ahead of what happens after 90 days. Is the data going to be really hard and difficult to parse through?
Will be extremely difficult to pass to. What I would recommend is just making an idea, come up with a concept of something like core GDP. I think Bloomberg actually came up with some kind of indicator like this. It's very useful. So that's consumer spending, it's parts of business investment, it also includes some government spending. That gives a handle on the domestic momentum in the US. That probably gives a better guide because it takes away some of these trade and inventory distortions. But what we're likely to see is 2 things. One, wild gyrations in imports and exports as firms try to guess and move ahead of any potential rising tariffs after this 90-day pause. But also what I describe as event horizon risk. This is where the administration sets up these event horizons where we can't do anything until we know what kind of world we're in. Is it world A or is it world B? And there's very little overlap between those 2 worlds. And so as we face these rolling event horizon risks, the incentive is for firms just to pause investment. It's for consumers just to pause big ticket. And so these 2 things happening, these gyrations linked to tariffs moves, but also this event horizon risk, complicate the economic story enormously.
Callum, this was an absolute masterclass. Thank you so much for joining us this morning. That is Callum Pickering of Peel Hunt. Let's get you now some other top stories that are trending on the terminal this morning. Tencent's revenue beat estimates after growing its gaming and social media portfolio through a persistent Chinese economic slowdown. Revenue for the 3 months ended March rose to $25 billion. Its net income increased by 14%. Tencent has benefited from the Chinese tech renaissance triggered by DeepSeek, with its apps gaining users since integrating with DeepSeek's offering. The U.S. and South Korea have agreed to continue discussions on FX policy. That's according to sources. The South Korean Deputy Finance Minister met with the Assistant Secretary for International Finance in the U.S. Treasury Department on May 5th. The dollar is now declining as signs grow that the Trump administration is shifting focus from trade to exchange rates. And a Swiss court has ruled that the government's decision to strip bonuses from a dozen former Credit Suisse bankers was unlawful. The country's finance minister had issued an order following the bank's rescue by rival UBS in March 2023. It told Credit Suisse to cut bonuses for its executive board members by reducing them by 50% for managers 1 level lower and 25% for employees 2 levels down. Coming up, the Trump administration clears the path to AI expansion between the U.S. and Saudi. We'll have more on the deals and Trump's visit to the Middle East. That's coming up next.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
The circuit is back.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The names that move markets are on Bloomberg.
We do not project recession in our assessment of where the world is headed. If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
Nobody covers business like Bloomberg.
I've seen such progress. It's really incredible. I've also seen great unity and friendships. I've spent a little time with you just before this, and I've seen tremendous unity, tremendous friendship, and the whole world is watching the Middle East, and many are watching with envy. You have something very special going on.
President Trump speaking in Riyadh moments ago as he prepares to finish the first leg of his Middle East tour. The Trump administration has been clearing the way for allies in the Persian Gulf to expand their capabilities, and big U.S. tech is capitalizing on the opening. Humane, a newly formed firm coming under Saudi's PIF, is at the center of the slew of deals with NVIDIA, AMD, Amazon, and others. Let's get more details from Bloomberg's Stuart Livingston-Wallace, who leads our coverage in the Middle East. Stuart, just what did we get out of the Middle East visit so far? It has been deal after deal.
Yeah. I mean, the scale of it is really quite impressive. And we haven't quite totted up the numbers. And there's a caveat here in that many of those deals are not necessarily finalized, importantly. Secondly, there have been some worries expressed back in Washington from some of the hawks, particularly around concerns about China getting access to some of this tech. But at least on the face of it, we're talking about hundreds of billions of dollars of deals. A very, very significant part of that is the tech side. So the so-called tech diplomacy kicked off in full swing. We saw basically every tech leader on the planet show up in Riyadh yesterday. And the mood on the ground was pretty jubilant because this has been a fraught issue for a number of years. So assuming all of those issues can be resolved and that everyone can get on board with it, I mean, it does signal a major shift in terms of where that tech is going to sit in the future. And again, if all those deals come through, then basically the Arabian Peninsula pushes itself up into a similar sort of position that the US has and China has in terms of AI.
What about the investment coming the other way? The President Trump announcing that Saudi would invest about $600 billion in the US. Paul Donovan of UBS pointing out that that's about 60% of Saudi's GDP. What might that look like, Stuart?
It is, and there were promises that they're going to try and get it up to $1 trillion, which would be basically all of GDP. So again, some caution with those numbers. Some of those will be previously announced deals, some of those deals will never happen. But I think whatever the final number, again, the scale of those deals is incredibly impressive. I suspect a large number of them will come to fruition. It is absolutely in the interests of the peninsula, specifically Saudi Arabia and the UAE, to get their economies away from oil or the dependency on oil. They know that's going to run out eventually. And there's a really serious push now to expand both their industry, to expand their technology, to expand their general involvement in global trade into something that doesn't involve energy. So, certainly from the side of the Arabian Peninsula, there is great appetite to do this.
Stuart, before we let you go, just quickly, Trump also made some news in terms of U.S. relations with Syria. What did we get there?
I mean, again, quite surprising. I mean, that was the sort of the moment in his rather long speech yesterday in Riyadh where he got a standing ovation. He was clearly encouraged to do this by the Saudis and others because this is the way they see it, that for all the questions there are about the leadership in Syria, and obviously the background is in terrorist organizations, they are very keen for Syria to come back into the orbit of the Arab world and to basically uncouple it from Iran. So for many years under the former regime in Syria, it was backed by Iran, it was supplied by Iran, and that's ultimately what they're trying to get away from. So that intersects almost perfectly, I think, with Trump's intention here, which is to create a counterweight on the Arabian Peninsula going forward, a counterweight against Iran, so that US involvement in the region doesn't have to be on the scale that it traditionally has been in the last couple of decades.
Stuart, thank you very much for that excellent update. That is Stuart Livingston Wallace. Now let's turn back to Washington, D.C., where lawmakers have also been busy. House Speaker Mike Johnson told reporters last night that Republicans could reach a compromise on the state and local tax deduction today. Let's bring in Bloomberg's Joshua Gallo on this. Josh, so the SALT tax breaks looks like it might be coming up today. What might we expect from a deal?
Well, it looks like Speaker Johnson is prepared to try and push through a deal that would raise the cap from currently $10,000 to $30,000 for individuals making up to $200,000 a year. That would, of course, be tripling it from the 2017 deal. But this is a really thorny aspect of U.S. tax policy, and it's highly politicized. The reason is that it mainly affects areas that, like California, New Jersey, New York, with very high property values and relatively high tax brackets. So people really want to be able to deduct more of those state and local taxes from their federal taxes. The problem is, of course, the Trump administration is looking for revenues to pay for their overall tax cuts, so that's not helpful for them. From a political perspective, of course, Trump is the one who really wanted to cap this back in 2017 because it hits primarily Democratic states. So, but now he's got to help his representatives in those states that have been hurting from that cap, and also sell it politically in areas that are less prosperous, that are going to see cuts to things like Medicaid and food assistance, while at the same time seeing breaks for areas like affluent areas like California and New York.
Well, this has been an extremely thorny issue, Josh. If House Republicans are able to come to an agreement on this, does this suggest that there is room for a more easy passage of, in total, the big, beautiful bill?
I think so. I mean, Speaker Johnson wants to get this over to the Senate soon. He wants it out of committee, and his aim is to get it to Trump by 4th of July. That, of course, is a pretty tight time frame. That's only about 7 weeks from now. So, and a lot needs to be done. But this is one of the biggest sticking points. If they can come to an agreement on the state and local tax deduction, they will have gotten past a very big hurdle in getting all of their members in those key states on board. And they have to do that because they're proceeding with, budget reconciliation, where they can bypass a process that would have to get Democrats on board. But in order to do that, they need all of the Republicans to vote with them.
Josh, thank you so much. That is Bloomberg's Josh Galou with the latest in Washington, D.C. Now, coming up, we're going to take a look at what else is making headlines around the world. We'll peep into the front pages. That includes China's attack on the U.S.-UK trade deal. That's coming up next on your Bloomberg Brief.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running it like 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Let's take a look at the front pages this morning. First up on the Washington Post, they lead with President Trump announcing plans to lift sanctions against the Syrian government and a willingness to negotiate with Iran. Trump also said today he'd explore normalizing relations with Syria. It signals a reordering of foreign policy, which there are no permanent enemies. Next up, the Wall Street Journal has this, that Health Secretary RFK Jr. bid to label pesticides as a potential cause of health problems has seen some pushback from the White House. Trump had pledged on the campaign trail to investigate pesticides as part of an effort to win support from Kennedy backers. And finally, on the FT, China has criticized a trade deal between the UK and US. Beijing said it was a basic principle that agreements between countries should not target other nations. It has also warned countries against signing trade deals with the U.S. that threaten Chinese interests. All right, as we head to break, let's get a check on currencies. The yuan rising this morning after South Korean officials confirming that FX talks were indeed part of the talks with the U.S. The dollar overall weaker this morning. Coming up, we'll catch up with State Street's Marvin Lowe. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. AI deals galore. President Trump clears the path for tech deals in the Middle East, with chip makers planning to spend billions of dollars. And more deals stateside. House Speaker Mike Johnson says Republicans could reach a compromise on the state and local tax deductions as early as today. And back in black, U.S. stocks erase this year's drop as trade tensions cool. And it has been a remarkable rebound for U.S. stocks, undoing the 15% year-to-date losses in under 6 weeks. Bespoke pointing out that that is the fastest recovery since 1982. We're unchanged this morning for both the S&P and NASDAQ futures. Your Russell 2000 futures a little bit weaker, down by about 0.2 this morning. It was excitement over softer CPI tech deals in the Middle East yesterday that had us pricing in just 2 Fed cuts for this year. For now, that brought front-end yields below 4%. We're below low 3.99 this morning, down another basis point. Your 10-year little change, but that 30-year yield stays stubborn. It closed at the highest level since January yesterday, and you can see on the bottom of your screen the dollar weak, that unable to recoup the year-to-date losses despite what the equity market is doing. Okay, let's get some stocks to watch this morning. With that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So there's strength in the chip makers once again following news of these deals over in the Middle East. Nvidia set for a third gain. We've had a 10% rise in that stock over the past few days, and we're up another 1.8% in the pre-market, given news of that deal with the UAE. And then Supermicro, smaller company, but up almost 8% on news of a pact with Saudi Arabia. Both of those moving higher. Then in terms of the clothing stocks, American Eagle Outfitters absolutely slammed in the pre-market this morning. We're seeing that one down close to 15%, pulling their guidance due to consumers cutting back on shopping and the weakness in consumer sentiment, according to the company. Then another look at the owner of Calvin Klein and Tommy Hilfiger, one I'm a little bit more familiar with. We don't actually have American Eagle over here in the UK anymore, but that one up 2.7% as Jefferies recommends buying due to strength among younger consumers, according to the broker. That one rising 2.7% in the pre-market this morning, Danny.
Joe, even if it was in the UK, I can promise you it is not for me and you, the demographic of American Eagle, so you're not missing too much. Joe, thank you so much for joining this morning. Bloomberg's Joe Easton. Now, State Street's Marvin Lowe has been weighing in on the latest trade developments, and of that, there have been a lot. He writes, quote, "It does appear as if the administration has shot its bullets, and the worst case is now part of the market narrative. Given the much cleaner positioning that investors now maintain, we should be able to build on risk assets, although a period of consolidation comes first." I'm pleased to say that Marvin will join us for the rest of the hour. He is Senior Global Macro Strategist at State Street. Marvin, great to see you.
Great to be here.
All right, so a period of consolidation first, and then some gains. How are you thinking about where we move forward from here?
Yeah, I mean, a challenge really is that we've recouped so much in such a short period of time. So, you know, everyone's clearly looking at the statistics that we are now flat for the year for the most part. But don't forget, during that period, earnings for the year have come down, and a lot of that has come out of the first quarter conversations with companies that, you know, there's just a lot of uncertainty around it. But the general trend is that it's going to be weaker from an earnings perspective than when they thought at the beginning of the year. So the fact that we're actually back to kind of that level playing field means that we've expanded multiples to get here. So, you know, really one has to look at whether or not it should be as broad-based as it is. And then you've got other asset classes that are not necessarily recovering as aggressively. And are there messages in that? Kind of having said that, we have certainly come off the cliff. There's an opportunity to continue to build on risk, but, you know, I don't necessarily think that it's as all clear as kind of this really strong rally that we've seen over the last couple of weeks signifies.
Well, the dollar's certainly been one of those notable asset classes that hasn't come back with the rest of the equity market. You ask if there's a signal in it. Is there a signal in it?
You know what? You know, certainly it is. A weaker dollar has been, I believe, one of the goals of the administration. It's not necessarily a bad thing, particularly if it could be done without a lot of the turmoil that kind of was associated with it earlier during the volatility. But kind of having said that, with tariffs, a weaker dollar, both of them equal higher prices. So, you know, this kind of inflation story, even though we've got a decent CPI to kind of grab onto now, is still a story that's really in flux.
I want to talk about the inflation, but first on this idea of a still weaker dollar. Does that cap some of the gains in the equity market? Because for all of us sitting here in America, you're back into the black for the year. But if you're a foreign investor and you haven't hedged your dollar exposure, you're still under pressure at the moment because of that weaker dollar. Does that prevent foreign flow from coming into the U.S.?
Not necessarily. You know, there is this trend that I kind of see where it's easier to buy U.S. companies than it is to buy the U.S. government. And the U.S. government is really encapsulated in the dollar. It's encapsulated in Treasury securities. And we're seeing the power of U.S. corporations make their way in kind of through a lot of these Saudi agreements. Having said that, do you go in and buy U.S. assets without hedging? And if you ultimately do hedge those assets, you wind up with a weaker currency as part of that. And one of the big trends that we saw leading into this year was a very, very low hedge ratio relative to historic standards because the strong dollar, U.S. exceptionalism, there was no reason to hedge it. You're starting to see kind of cracks in that, and it does have an impact on the currency for sure.
Back to the idea of inflation. There had been a thought, and Anna Wong from Bloomberg Economics has been leading the charge on this, that if you have deals or at least pauses, it might be more inflationary because you have a stronger economy, people can spend more, and you get companies passing on. Plus, you have a tax bill that isn't as restrictive as most had feared. So the net sum of what we've gotten from this week is a more inflationary environment. Would you agree with that?
You know, to a certain degree, it does create kind of a stagflationary type of concern. That's one side of it for sure. And the other side of it is confidence, just whether it's corporate confidence, consumer confidence. If given the means, I do believe the American consumer is one of the things that we can count on. But yes, having said that, you know, you've got this impulse where people are rushing out to theoretically beat this tariff. And having these pauses, having these start on, start off type of environments just really is incredibly challenging for businesses that are planning. And, you know, that's kind of the soft data that we're all waiting to see if it actually makes its way into the hard data. Remember, soft data is generally considered leading, hard data is generally considered lagging, and there's a reason we have those terms for that.
So if the hard data is going to be lagging, when does it show up? And what does that mean for risk markets that have been very happy to price it in as if it will not show up?
Yeah, for sure. You know what? I think it takes fairly significant events, unless all of a sudden the administration changes its mind. Go back to the reciprocal, we'll go back to the board and say this is the way we're going to start approaching things. If we don't get a shock like that and we get kind of these on and off and then these various carve-offs, it's going to be fairly difficult to get a sense of how long-lasting and what the ultimate level is. But you do have things like the debt ceiling, which will create a lot of liquidity kind of situations where ultimately if the government has to issue several hundred billions of dollars in debt to kind of make up for their piggy bank, which they've been using, that money has to come from somewhere, not necessarily from a yield call, which I also do think that there's ultimately a yield call, but when you need to reallocate money and the pool of liquidity becomes a little bit more scarce, then you see what people want to own and what people don't want to own. Right now, there's a decent amount of liquidity in the system, and we've got kind of a reprieve from what was a fairly challenging tariff trade environment to get over. You know, it's natural for people to get excited again.
Well, the long end certainly has not been able to come down to the same extent as the front end. Obviously, you get a repricing of the Fed. How much of that is, all right, the trade thing, we seem to be walking back on that. That seems to be normalized. The next source of attention for this market needs to be deficits. For sure, for sure. I mean, near and dear to my heart, you know, spending a lot of time on the fixed income markets, really spending a lot of time in thinking how much compensation you need to go out the long end. Really, the two asset classes that have struggled to kind of come back from a lot of the turmoil, you know, if we're looking at it from a year-to-date perspective, we're looking at it from a Liberation Day perspective, it is yields and it is the dollar. And again, both of those are kind of the most directly tied to what buying the U.S. government means. Does that suggest then that there still is a lack of trust, that there's been some sort of damage done from the volatility in policy we've seen? Yeah,
I think that's an easy narrative to grab hold of. You know, can we put the genie entirely back in the bottle? I think that other countries are approaching relationships with the U.S. with more of a jaded eye, and I think that ultimately makes its way into kind of the way we approach investments for sure.
All right, Marvin, you're going to be sticking around with us for the rest of the hour. I'm very pleased to say Marvin Lowe there at State Street. First, let's get you some other top stories that are trending on the terminal this morning. Now, Tencent's revenue beat estimates after growing its gaming and social media portfolio through a persistent Chinese economic slowdown. Revenue for the 3 months ended March rose to $25 billion, with its net income increasing by 14%. Tencent has benefited from the Chinese tech renaissance triggered by DeepSeek, with its apps gaining users since integrating with DeepSeek's offering. A Swiss court has ruled that the government's decision to strip bonuses from a dozen former Credit Suisse bankers was unlawful. The country's finance minister had issued an order following the bank's rescue by rival UBS in March 2023, telling Credit Suisse to cut bonuses for its executive board members by reducing them by 50% for managers 1 level lower and 25% for employees 2 levels down. NATO allies are working on an agreement to significantly boost defense spending. Negotiators are making progress on a path to achieve 5% of GDP on defense and defense-related spending by 2032. The agreement would mark the biggest spending increase by Western allies since the end of the Cold War. Coming up on the show, a floodgate of deals. President Trump secures investment in the U.S., clears the path for big tech to cut AI deals in Riyadh. We'll have more on the president's visit coming up next. You're watching Bloomberg Brief.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
The top names in business are on Bloomberg.
The policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. It's going to be important that we get more clarity on the direction of travel from here. As I'm talking to CEOs, as I'm talking to our clients, they are holding back on investment, and they're certainly tightening their belt. You're going to see some companies laying off employees and running their businesses tighter because of this level of uncertainty.
Nobody covers business like Bloomberg.
I've seen such progress. It's really incredible. I've also seen great unity and friendships. I've spent a little time with you just before this, and I've seen tremendous unity, tremendous friendship, and the whole world is watching the Middle East, and many are watching with envy. You have something very special going on.
President Trump speaking in Saudi there moments ago as the first leg of his Middle East tour winds down. Big tech at the center of President Trump's deal-making in the Persian Gulf. The newly formed firm Humane, coming under Saudi Arabia's investment fund, is at the center of a bunch of deals with the likes of NVIDIA, AMD, Amazon, and others. For more, we are joined by Bloomberg executive editor for tech, Peter Elstrom, and State Street's Marvin Lowe is still with us. Peter, a lot of deals. Break them down from us. What did we get over the past 24 hours?
Well, this is a quite significant change in U.S. policy around technology exports. The Biden administration had been implementing a pretty complex set of regulations where they were stopping the export of a number of different things, including NVIDIA chips that are used to train these AI models. What we've seen now is the Trump administration is essentially throwing out that framework. They formally repealed this AI diffusion strategy that the Biden administration had been using, and instead they're cutting these bilateral deals, including what we saw with Saudi Arabia, Arabia, where they're trying to allow more of an export of those NVIDIA chips and other kinds of technologies to countries depending on certain circumstances that they negotiate. So in this case, you've got a quite big deal where this AI company in Saudi Arabia, Humane, is going to be able to buy NVIDIA chips and AMD chips. They're also getting other kinds of support from the U.S. We think this is part of a broader strategy as the Trump team goes through the Middle East. We expect more deals of this type as they go to the UAE in particular.
Peter, what about the security concerns? Part of the reason some of these chip sales were capped was for fear that they'd end up in the hands of China. Is there anything being done to address those concerns specifically?
Yeah, that's a very good point, Danny. That's totally unresolved at this point. So at a high level, they're saying they want to change the strategy and open the door to more exports of AI chips in particular, but they haven't worked out this very thorny issue of how they're going to deal with the China risks inherent here. In particular, in the past, they've been concerned that either the AI chips are going to get diverted from the Middle East into China, or companies are going to be able to tap into AI capabilities through cloud computing services within the Middle East, and they have not resolved that. There are tensions in the Republican Party at this point about whether the Trump administration is going to be able to do enough to mitigate those risks, or whether they still have to resolve them in some sort of way other than that.
Hey, Peter, question for you. Looking at the deals that were cut, particularly on the high-end semis, is it a bit of water in the desert, if you will, in that the kingdom has been restricted from owning this, and ultimately anyone that wants to build these AI models want to own more of it? But kind of this AI story, as it evolved over the last year and a half, has been an uplift for a lot of different companies. But can it expand beyond just these high-end semis, particularly after the kind of the DeepSeek shock that we got a couple of months ago?
Yeah, that's a very good question. Really, the development of these AI technologies has been led by the American companies and the Chinese companies. I think you have those two very powerful poles of AI development. Now you're seeing other countries try to jump in here and develop some AI capabilities that will be beneficial locally, and perhaps they want to be able to compete globally too. As you mentioned, Saudi Arabia has a long ways to go to catch up just to compete on some of the most basic levels. The UAE has been investing for a bit longer. We do expect G42 in particular to be able to get access to a lot more chips than in the past. We have a scoop out right now talking about how the number of chips that they want to import into the UAE is going to be quite significant, roughly 4 times as much as they would have been able to buy in the past. So I think they probably have a bit more of a head start in terms of developing these capabilities. But both of the countries have a long ways to go to be able to compete on a global scale.
So after the China announcement started to come out, we saw NVIDIA pull back on its expectations with regard to how much revenues ultimately can collect from that part of the world. Does this, for the most part, offset a lot of that? Is that kind of where the commentary is going to go, that while we still have China concerns, we've got this really big wellspring that the advanced chip makers can tap into?
Yeah, you make a very good point. NVIDIA had been barred from selling its H20 chips into China. That was certainly a setback for them. They were quite vocal in their opposition to those new restrictions. They're worried about competition domestically from companies like Huawei in particular. This is directionally, it's certainly a benefit for them. They're going to be able to sell more into the Middle East to some of these customers. You see in the share price, the NVIDIA stock was up about 11% over the past couple of days as investors anticipate that they are going to be able to boost some of their revenues with sales into parts of the world like the Middle East.
Peter, thank you so much for joining us. An excellent roundup. That is Bloomberg's Peter Elstrom. And Marvin, as you point out, there has been a lot of excitement about these deals. NVIDIA surely took off yesterday. How much of that do you take with a grain of salt? Because we saw in Trump 1.0 that just because deals were announced doesn't always mean that they follow through.
Yeah, for sure. And the size of the deals that are being promised is a significant portion of GDP, which is where everyone's focused on. Certainly if you are in NVIDIA, if you're trying to figure out how you're going to make all these chips, you're excited. I really wonder if this is the U.S. manufacturing renaissance. Again, kind of that tall glass of water in the desert. It's easy when you've got a product that everyone wants that people couldn't really have access to because of restrictions that were put in place. Is this going to expand into other parts of the U.S. economy, which is really where all of this trade discussion had wanted to go, bring back manufacturing, make U.S. more of a significant exporter. We were already exporting as many NVIDIA chips as we possibly could. They couldn't keep up with things. Is there other parts of this discussion which can actually benefit beyond just what winds up being the Mag 7, once again, from a discussion perspective?
All right, Marvin, you're going to stay with us. Really interesting discussion there. I first want to get a quick look on the stocks that are moving in the pre-market this morning. And as we've been discussing, NVIDIA and AMD are moving higher on the back of the AI deal. We're also looking at United Health. That is bouncing back after closing 18% in the last session after it announced that it would be replacing its CEO and cutting and completely removing, I should say, its outlook for the full year. Coming up, we're going to get you set up for your trading day and what to watch. That's coming up next on your Bloomberg Brief.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
This is Bloomberg Brief. I'm Danny Berger, and still along with me is State Street's Marvin Lowe in New York. All right, let's get you set up for your trading day today. We're going to hear from Fed Vice Chair Phil Jefferson. He'll be delivering remarks at 9 a.m. Eastern. Then RFK Jr. testifies before the Senate on President Trump's budget request for the Department of Health and Human Services. That's at 1 p.m. And then we'll get more Fed speak. San Francisco Fed President Mary Daly at 5:30 p.m. Marvin, that's certainly a lot of Fed speak. We had Goolsbee yesterday. Any reason to believe that they're not just going to say, we can be patient?
Unfortunately, no. Unfortunately, no. They just don't know. We heard it over the last couple of meetings. We certainly heard Chair Powell during the last presser really say that there's nothing I can do, in as many ways as possible. So yeah, they're waiting for the data. Certainly the relief on the tariff discussion gives them a little bit more comfort in terms of the downside, but really with the market expecting and really wanting rate cuts, nothing that's evolved makes that easier for them.
Yeah, I think it was 22 times that Powell in the last presser said some version of wait and see.
Exactly.
So a lot of uncertainty there, but they're waiting for the data, Marvin. Yeah. Not even just them, but how do you handle the incoming data? It's going to be really distorted as we have shippers rushing to get goods into the U.S. before this 90-day pause is out, as we still have companies sitting on their hands unsure of what to do, and as we likely have consumers also trying to get ahead of any potential price increases.
Yeah. Investing is a real interesting process because there's a lot of different ways of going about it. You could trade it, and that's a lot of times what we talk about, particularly these big moves. If you time the trade right, if you get the call, if you get that call correctly, you can certainly get ahead of it. But then there's a more intermediate, longer-term perspective, which is where the asset allocation discussion goes. Like, where do I want to own what type of companies, where in the world? This is kind of a really good time to take a step back, particularly given the rally that we've had, and really look at your portfolio and think about where you want to be, and kind of have those broad markers around what you're looking in the data to kind of get you to your thesis. So, for the most part, traders are going to trade, but analysts that are looking at that intermediate term, they're really wondering how much can the consumer spend? What's GDP going to be? And what's the inflation and kind of interest rate environment around it? And I think that this is a time for us to really assess everything and understand what that data is saying those answers might be.
Well, here's one trade that's certainly going on this morning, and that is a weaker dollar. Let's just look at some of those crosses this morning, because you are looking at the Bloomberg Dollar Index down by about 0.5%. Marvin and I had been talking about this, unable to make new gains with the dollar. Literally 30 seconds, Marvin, but Korea and the U.S. talking on FX. Is this the next target for the administration, a weaker dollar?
You know what? Certainly it does seem to be the focus on many of these conversations, whether we were talking about Taiwan, whether we're talking about, South Korea now, and it is one of the goals of the administration to somehow prop up manufacturing through that weaker currency.
Marvin, it has been such a pleasure to have you join for this half hour. Marvin Lowe there of State Street, and that is it for your Bloomberg Brief Surveillance. We'll take the reins from here. You're watching Bloomberg.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There you understand the history of this great land. not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
There is a lot of appeal to U.S. denominated assets still.
I don't think we're going to see this resurgence to buy America.
It's very hard to undo a decade of policy that's been very favorable for the U.S.
From a market perspective, anything that lowers that amount of uncertainty is positive.
Most of the gains are behind us because it still is very hard for the S&P to reach new highs.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
How is it only Wednesday? Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday as the president doubles down on deals.
And with this trip, we're adding over $1 trillion more in terms of investment into our country and buying our products. There are multi-billion-dollar commercial deals with Amazon, Oracle, AMD. They're all here. Uber, Qualcomm, Johnson & Johnson, and many, many more.
President Trump clearing the way for NVIDIA and AMD to sell chips to Saudi Arabia, boosting chip stocks and helping to wipe out all of the equity market losses for 2025. Attention now shifting to Washington as House Republicans push to reach a tax compromise potentially as soon as today.
Before we get to taxes, before we shift our focus yet again, I think it's fair to recognize just how rare it is to see this type of upswing in this type of period of time, let alone the period of time. It is incredibly rare for the S&P 500 to be down more than 15% and then actually climb out of that hole. It's only been done 5 times over the past span of modern history. So do people have confidence in this, or is this a head fake that is designed to really be a short squeeze and exercise the maximum amount of pain?
I think you're bullied into this if you're missing out on these gains. Over the past few weeks, we've had a positive growth shock off the back of the headlines of the past few weekends. A positive growth shock that's led to revisions in equity market price targets higher, revisions to Federal Reserve forecasts for rate cuts, pushed them out. A positive growth shock that's moved this market in a major way in the last month or so.
A positive growth shock that we didn't necessarily get the worst case scenario. And so suddenly we have long-term investors who are grappling with, okay, is this a really good thing? Or are we looking at tariffs that are still, even after the revisions, at around 16%, which is according to Yale Budget Lab, which is the highest level still going back to 1937. How do you factor that into an economy that we will not get a clear picture of potentially for as long as a year? As we were hearing about yesterday, it becomes really cloudy. And then you add to that the confusion around policy. How much can we just focus now on the tax bill and ignore all that noise?
Well, let's sit on the tax bill and let's talk about the yield curve. So the 2 years anchored around 4%. This idea that the Federal Reserve is anchored around doing nothing for the foreseeable future. Further out along the curve is starting to get really interesting again. The 30-year pushing towards 5% once more, and this time for different reasons.
If you end up with the tax bill as originally drafted, which was a real kind of a rough draft on Friday, and they've been up all night trying to get this together, and then it's going to go to the Senate and it's going to be rewritten completely. So initial estimates do have it increasing the federal deficit by about $5 trillion over the next 10 years. You would have to imagine that this supply would end up pushing yield term premium upward for this long end of the yield curve, which is one reason why people talk about 5-year, people talk about maybe 10-year. Nobody talks about 30-year. Priya Misra talking about that as the risk asset at a time of so much uncertainty.
The bond market in focus, the 30-year this morning, 490, 10s at 445. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark as stocks erase losses for 2025. Norman Rule of CSIS as President Trump vows to lift sanctions on Syria, and Jens Nordvik of Exante Data on why this is just the the start of a bear market rally for the dollar. We begin this hour with our top story. President Trump emphasizing the importance of coalition building in the Middle East. Joining us now from Dubai is Bloomberg's Jordan Fabian. Jordan, welcome to the program, sir. Yesterday, deals, 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 and then a shift to foreign policy. What's the next leg of the trip all about?
Cementing a relationship with another U.S. partner in Qatar. This is a nation that geopolitically they've relied on to try to negotiate hostage deals with Hamas. And the president is also looking to extend that deal making to Qatar as well. There's that possibility that the Qatari royal family gives him a luxury 747 jetliner to use as Air Force One, not to mention other sales from companies like Boeing to the Qataris.
Jordan, how much does this really cement the Middle East's position as a new power broker at a time when power seems to be shifting away from other centers that have traditionally been thought of that? I'm thinking in particular of Europe.
Certainly. I mean, you look at a country like Switzerland that traditionally has served that role as a neutral broker between two nations. And to be fair, we did see that when the U.S. and China reached their tariff détente last weekend. But increasingly, the U.S. and other nations looking to Qatar to broker these deals. Controversially for a lot of U.S. policymakers, Qatar has been a client of Hamas. That's something that some Republicans, even allies of Trump, have scrutinized, say that U.S. shouldn't have such a close relationship with a country like that. But the president is putting aside concerns about human rights, about traditional U.S. values in the search of a deal. He says, as long as you're dealing with the United States, we're going to look the other way on those other matters.
Hey, Jordan, appreciate the update. As always, Jordan Fabian there. Out of the region this morning on the latest, the next leg of the trip, a turn towards foreign policy after a big boost to chip makers in yesterday's session.
Yeah, who didn't get a boost, right? We were talking about NVIDIA, AMD, Amazon, Alphabet. We're talking even Cisco coming out with some sort of sweetener from that particular transaction, some seeming more concrete than others, but really a deal palooza over there in the Middle East.
Helped to wipe out what remained of the losses of 2025. Equity futures this morning just a little softer. NASDAQ futures down by not even 0.1%. Here's the view on Wall Street this morning. Victoria Fernandez across Mark writing, uncertainty is still the name of the game, but perhaps trade negotiations can begin to offer an off-ramp, with headlines providing some tailwinds to the equity markets and a steepening of the yield curve. Victoria joins us now for more. Victoria, good morning. It's good to see you.
Thanks for having me.
We're back to where we started, 2025. How much has changed, though? How different is this equity market?
Yeah, it's all about the underlying, the internal momentum that we're seeing in this market. So we had the external momentum. We've seen the S&P come and make a 20-day high. We've seen it recover, as you were talking about, in a very quick pace from the downside that there was. But what does that internal momentum look like? And it's still weak. And to me, that's the key component. We just saw this week the amount of S&P constituents making 20-day highs that are in uptrends, sectors that have been in downtrends and relative lows that are now changing to relative highs. The question is it a head fake that you mentioned a moment ago? Are we just on a 90-day pause where is the downside, the declines on the downside, is that reversing a little bit? Yes, but do we have that solid trend on the upside that we really want to see? I'm not sure we're there yet.
Well, let's talk about leadership. Where's it coming from at the moment? And how's that developed over the past few weeks?
So that's changed, and a change in leadership is one of the things that we've been wanting to see to say that this market could continue, right? So we were looking at utilities, we were looking at staples, we were looking at financials before. Now we've started to see industrials come up a little bit. Consumer discretionary is coming up. Leave out Google, leave out Meta, even though that's about 2/3 of that sector. You look at more of the entertainment component, the gaming names, that's starting to take some leadership. So you're seeing that shift, which is positive. But again, is it just because of a headline that we had over the past week, or is it going to be more fundamental?
Yesterday, John asked someone, what's on your dashboard of economic data to watch, given the fact that everyone is saying that the soft data is unreliable and the hard data is also unreliable because it's backward-looking, forward-looking, and whichever way you're looking that you would like. So how do you assess the real-time implication for the economy at a time when policy is not set, And you have a motley kind of response from corporate America, with American Eagle withdrawing its outlook, others actually upgrading what they see ahead.
Yeah, I think the soft data, hard data conversation is actually really important. Soft data really kind of telling you where the momentum is in the market, but the hard data being the confirmation of what you're seeing. And typically it's soft data that flows through to hard data. I don't think you can ignore soft data. It is out there. A lot of it is self-fulfilling. When you have consumer sentiment really low, that means the consumer is not going out and buying because they're concerned. So maybe you're not seeing it in retail sales yet, or maybe some of the hard data is really being affected by the pull forward that we saw in front of the tariffs. And so therefore it's muddled, it's a little murky, and I'm not sure we can rely on it wholeheartedly. Even the CPI report we got, you know, people are saying, look at the last half of April where it all started moving up again. Maybe that tells us the next couple months could be a surprise.
I have to say, when we start talking about economic data at this point, my mind starts to hurt because I think about all the variables, and you could talk about even the sentiment data, the soft data, as being backward looking, because you know, sentiment could have shifted quite considerably in the past
from
couple
day to
of
day.
moments, from day to day. Right. So here's this question. If you still do have tariffs at the highest level going back to 1937, sure, it's not necessarily as high as it could have been. Do we have a sense of what the ramifications are and how much has already been priced in and how much more has to go?
Yeah, I think when we talk about what's priced in, it's interesting because I think a much brighter outlook on tariffs is being completely priced in this week, and maybe that's too much. Maybe we're getting over our skis a little bit in that direction. We've heard that the market could probably take a 10% universal tariff. We heard that in the beginning. There'd be a little bit of noise, but it would be something we could handle over the long term, and I think it's interesting that that's kind of where this administration has come back to. If you look at the deal with the UK, if you look where we are with China, it says 30%, but 20% of that is actually a fentanyl component. It's the 10% that's on the tariff. So maybe that's where this administration comes back to and says, we can handle that. And over a 10-year period, talking about the budget, that's about $2.25 trillion. So I think there's some math going on behind the scenes as to where these numbers end up.
Speaking of the economic data, the number 5 container carrier, Hapag-Lloyd, had this to say, estimating the boost of more than 50% to volume compared with recent weeks. The last couple of days, we've seen a huge surge of volume, and now we need to see how long that lasts. So we've had the front loading, then we had some quiet, and now we've had a boom again.
Yeah, and we heard that same kind of tone from Maersk, right? The idea that these ships are gonna start going in mass because everyone's gonna try to pull things in as quickly as they possibly can. Ryan Peterson of Flexport saying there is going to be a boom in deals. So how do you price that in?
There's a scramble. The Fed chair's head must be spinning. Yes. The president's pushing for rate cuts. The inflation data was a little bit better than expected yesterday. How much comfort can you take from that?
I don't think there's much comfort there, actually. And I think when we see the premiums go higher on the longer end of the curve, as you were talking about a moment ago, some of that is because we're just pushing cuts further out in the year, in my opinion. If I'm Powell and I'm sitting there, and he doesn't ask my opinion, but if he did, I mean, I think he's saying, look, now I've got even more uncertainty I have to deal with. Now he just pushed my decision time 90 days out with the deal he made with China. I thought I was going to be okay July, maybe making a decision. Now I'm in August. I'm at the September meeting having to do that. So I think his job just got a little bit harder, actually.
We're looking forward to the update to the forecast in the next month or so. Victoria Fernandez across market is going to stick with us. If you're just joining us, equity futures this morning negative by about 0.1% on the S&P 500. Lots to talk about regarding the tax bill. We'll do that in just a moment with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Ahmed. Hey, Yahara.
Hi, John. On that tax bill, House Speaker Mike Johnson says a compromise on SALT could come as early as today. A proposal being debated would increase the cap from $10,000 to $30,000, phasing out for individuals who earn at least $200,000. The standoff over SALT is one of the remaining sticking points as Republicans seek to advance President Trump's tax cut bill through the House. Meanwhile, NATO allies are working on an agreement to significantly boost defense spending. Negotiators are making progress on a path to achieve 5% of GDP on defense and related spending by 2032. The agreement would mark the biggest spending increase by Western allies since the end of the Cold War. And President Trump continuing his criticism of Fed Chair Jay Powell, posting on Truth Social after yesterday's CPI data saying no inflation and prices of gasoline, energy, groceries, and practically everything else are down. The Fed must lower the rate like Europe and China have done. What is wrong with too late Powell? That's your Bloomberg brief. John?
Yahara, thank you. The pressure is never ending. Up next on the program, closing in on a compromise.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market.
We'll get to that in just a moment. We'll catch up with Bloomberg's Tyler Kendall live from New York City this morning. Good morning.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The names that move markets are on Bloomberg.
We do not project recession in our assessment of where the world is headed. If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
Nobody covers business like Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
This equity market wiping out the losses for 2025. Positive for the year. Positive post-April 2nd. Up from the low by almost 20% on the S&P 500 in just a number of weeks. This morning, negative by 1/10% on the S&P. Likewise on the NASDAQ. Under surveillance this morning, closing in on a compromise.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. I think in this bill, what we'll do to extend the Trump-era tax cuts is going to be critical for the economy. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market to let people know that Congress is on the job.
Here's the latest this morning. House Speaker Mike Johnson saying Republicans could reach a compromise on the SALT deduction today, a main sticking point in Trump's economic package. Bloomberg's Tyler Kendall joins us now from the nation's capital for more. Tyler, let's talk about that sticking point. What does a compromise look like?
Yeah, hey, John. So at this point, the proposal that's on the table is what you outlined there. It would lift the SALT cap from $10,000 to $30,000 per individual and be phased out with income limits. But these Republicans from high-tax states like New York, New Jersey, California say that's not enough to ease the tax burden on their constituents. And for context, they came into this week saying that they wanted to see that cap lifted to $62,000. Now, we know House Speaker Mike Johnson is negotiating with them directly, and there appears to be a way out of this, which is that the tax bill currently on the table is pricing out at about $3.8 trillion. We know the House had about $4 trillion to work with, so there could be some additional room there. But of course, that would spur concerns by fiscal hawks who are looking for savings where they could. A few different areas where we could potentially see some compromise. The Speaker said that they're considering doubling the cap for married couples. That could potentially be somewhere where we could see some broad consensus. And then the other thing to watch for could be expiration date. So perhaps they will lift the cap to a higher level, but it just won't stay in for as long. John, in all of these conversations, though, important to keep in mind that these lawmakers are really digging in. These are Republicans that represent swing districts in blue states. They say that they help deliver this majority for Republicans, and this is the issue that they campaigned on.
And Tyler, nobody is sleeping in that city right now. It sounds like everybody was up all night trying to go through this draft, which sounds like a lot of fun. Now, of course, it's going to go over to the Senate if it does pass and get completely rewritten. So do we have a sense of how much House Republicans and Senate Republicans are on the same page?
Yeah, Lisa. In fact, they actually are still on the Capitol, still working through this markup. One estimate that we got is that particularly when it comes to the tax cuts, that could go into mid-afternoon. It's going to be 24 hours plus of debate. Now, both sides say that they are working together. If you listen to President Trump, he says that the White House is closely in touch with both leaders, House Speaker Mike Johnson and, of course, Senate Majority Leader John Thune. But at the end of the day, it depends on who you ask, because Senate Republicans have already signaled concerns with a few things that the House is doing, including the SALT cap, but also when it comes to those Medicaid cuts that we are expecting. The current House proposal does implement those work requirements for able-bodied adults ages 19 to 64. We know that's going to be a sticking point in the Senate, but at the same time, there's also a lot of fiscal hawks in the Senate who want to see some deeper spending cuts, so we're going to have to see how this all shakes out.
Critical for the economy, jet fuel for the economy. Tyler Kendall, thank you. With us to extend that conversation, Victoria Fernandez across Mark. Victoria, your view, is it both critical for the economy and jet fuel for the economy?
It is critical, I believe, for the economy. When you look at all of the elements that this administration wanted to bring together, they hit us with tariffs first, which was kind of that negative component on the economy. They need the tax component, they need the deregulation component to come in and help buffer that. Is it jet fuel? I think it's more of the buffering than the jet fuel in order to kind of bring this economy back onto solid footing, like we were talking about earlier, get those internal fundamentals going. But it really frustrates me when I hear them say they're digging their heels in on things. And because a good deal, they always say, is one where nobody's really happy. And so that's what I think we have to do here. They have to have some compromises on something, whether it's SALT, whether it's on the Social Security components, whatever it may be, the healthcare components. There has to be some kind of a compromise, and until we see that, I'm not sure we're going to get much out of it.
Well, let's focus on the composition of the agreement if we do get one. So there is a difference, of course, between removing a potential headwind and providing a tailwind. The bulk of this bill is going to be extending current law.
Right.
What are the sweeteners that could act as that jet fuel in the years to come?
Yeah, I think some of it are the campaign promises that people are looking for to see. So the no tax on tips, right? Lowering taxes on seniors, some of that. The SALT deductions. And they're actually talking about closing loopholes, right, on pass-throughs for SALT, which they're saying is going to raise like $900 billion. Okay, well, that's great if we can see. Everyone loves a closed loophole. So if we can get some of those things done, maybe that's positive. But that's where we have to see some of these elements come in. We're seeing child tax credits getting extended. Incentives for businesses in regards to building, manufacturing plants and R&D and expensing all of that. That, I think, is where you're going to get the tailwinds coming. We'll see profits increase in corporations. To me, that's saying margins are better, employment will stay well, and consumers will spend.
Maybe I'm just naturally a nervous person, but as we start talking about this, there are sort of two sides of the coin that both potentially could be really problematic for the bond market. Either you've got jet fuel that injects some sort of growth shock that is positive, but also potentially inflationary. Or on the flip side, you have essentially a less growth forward type of proposal that increases the deficit and also creates a problem for long-term bonds. So do you see it either way potentially being a risk for the bond market?
Yeah, either way, you're going to get a steepening, I think, of the bond curve, right? You're going to see that longer end go higher, in my opinion. And we talked about Powell a little bit earlier. I don't think that puts him in a great position to say, well, great, let's cut and bring the shorter end lower. So I think you're going to continue to see yields move up on the higher end. I think they'll probably stay somewhere around the 450, 460 level for now, being in kind of that trading range. But that pressure is there. It's really, Lisa, it's the credit component, right? Credit component, you look at investment grade credit, it's only out about 20 basis points on the year. High yield, obviously much further, about 250, 300 basis points out on the year. So I think they have to watch and see what happens to the credit spreads. And does that give them a signal that maybe things have gone a little bit too far?
This is important. You think that the credit side of things is the more interesting one, not the duration side that could potentially speak to the whole bond vigilante movement that could get spurred by some sort of deficit spending plan.
Well, because it's that credit component that I think is really kind of the underlying driver of what we're seeing across the board. It's what's going to tell us what can happen with earnings. Earnings is going to drive, like I said, what you see with profit margins and with employment and all of those elements that the Fed is watching and that the market responds to. So I do think we have to watch credit, although I will say over the last few months, the FX markets have been driving more than the credit markets, which isn't typically what we see, right? Credit's usually our canary in the coal mine, but it's that combination, I think, of concern around credit and what's going to happen if corporations don't get the incentives that I think they're waiting on, which means we're not going to see CapEx intentions probably go higher. There's going to be some concerns there, but then you also look, we had a very poor 30-year auction. We saw yields go higher after that. What does the demand look like there? It's very much a combination of the two.
What do you think is behind those poor auctions? Because I think there's a big difference between saying we're going to have deregulation, pro-growth, pro-risk bills going through Washington, and that leads to high yields. A difference between that and people starting to worry about financing the deficit, international investors requiring a weaker dollar and higher bond yields. Which road are we going down?
Yeah, I think international investors are still there. Maybe they're not buying quite as much, but we're not seeing them really go in and sell out of their treasuries. There was this huge concern around that. We're seeing it more on the equity side. We saw in the last week of April about 15 billion move out of U.S. equities and into European equities. So we're seeing that transition there. I don't think that's it. I think it's more of a concern around the debt. I think you could have some bond vigilantes out there. And it could be people saying, wait a minute, if this is all going to happen and yields go higher because recession is now less of a concern, maybe I'll wait on the 30-year until yields are a little higher and lock that in.
So put that all together. What are you doing with bonds?
So we've actually done, and I know you hate this word, but we're doing a barbell in our strategies, and so I should whisper that over here to Lisa.
I could tell where you were going with that, the hand motions.
But I think it makes a lot of sense. That kind of belly of the curve has been the most expensive part of the curve. So you've got to do what's best for your clients, and that's buying on the short end, and then it's going out a little bit longer and locking in there. We're not going out 30 years, but we're going 7 to 10, and then buying some on the short end too. I think when we finally get easing later this year, that'll be beneficial, and we want to have cash flow for clients.
There's two words we despise even more, idiosyncratic and diversification.
Good, I didn't use either of those today.
You want to be diversified.
Yeah, diversified, idiosyncratic. I think transitory can get thrown in there too.
Yeah, transitory belongs there too.
Short-lived, as you pointed out.
I think the list is long, right? Victoria, it's good to see you. Thanks you for being here.
Appreciate
Thank you.
it.
Victoria Fernandez there of Crossmark. Up next on the programme, we'll catch up with Norman Rule of CSIS as President Trump vows to lift sanctions on Syria. Live from New York City this morning, good morning to you all. Equity futures on the S&P 500 just about unchanged. From New York, this is Bloomberg.
let's cut right to it. This is Bloomberg's new show, Primer. Technology is a trillion-dollar game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Wall Street absolutely scrambling to update forecasts. Big revisions following the US-China trade truce over the weekend. Upgrades to the S&P 500 from Goldman, from Ed Yardeni. Wells Fargo and Chris Harvey saying this: stocks have come very far, very fast. We think that what were ceilings now become floors and expect dips to be bought. Saw some evidence of that already this morning. We were down a few tenths of 1%, and now we're almost positive. On the S&P, we flip into the green on the NASDAQ 100 in the last couple of moments. 3 hours away from the opening bell. Let's get you some morning movers. We can do that this morning with Danny Berger. Hey, Danny.
Hey, John. One stock that's still decisively into the green is NVIDIA. Shares up 1.8%, still enjoying that afterglow of the benefit of all the deals announced at the U.S.-Saudi conference, giving Saudi more chips as the Saudi new venture looks to build out a data center, as the U.S. also considers letting the UAE have more chips from NVIDIA too. Dan Ives writing a note this morning saying that it is an AI revolution for Saudi, a new market for NVIDIA, especially as China continues to face restrictions. Also, one of the biggest movers for the S&P 500 pre-market is United Health. Those shares up 2.6%, but it is a bounce back from a big decline yesterday, 17% after the company completely suspended its outlook, named a new CEO. We are getting more details about that new CEO this morning, about some of the compensation that he will get, a $1 million base pay, $60 million in equity options. They were also sure to underscore that he would have security benefits as the new CEO. Finally, rounding things off this morning with a company that has also suspended its guidance for 2025. That is the retailer American Eagle. They blamed macro uncertainty, but to be clear, the first quarter, they gave a pre-update of that, looking very weak for them too. It had excess inventory, they had discounts, and again, they just had an inventory write down too. So those shares massively under pressure this morning, down 14%, John.
Danny, thank you. I can't think of a more difficult time to try and manage your inventory through all of this over the last few months. The pandemic was the pandemic, whatever that was. This moment's been tremendously difficult for these guys.
They have to deal with not only the potential of tariffs, but also fast-moving fashion, particularly for the teenage set, which I can tell you is a very fickle bunch. But I will tell you that I do find it interesting. Some pulling their guidance, some upgrading their forecasts, like on holding. How much is execution and how much really is the macro environment?
Another update coming tomorrow, retail sales tomorrow morning and earnings from Walmart, so look out for all of that. On our radar this morning, President Trump delivering on his promise to strike deals on his Middle East trip, clearing the way for NVIDIA and AMD to sell chips to Saudi Arabia. Both of those names, Bramo, again this morning, higher in the pre-market.
Fascinating to me, the fact that, first of all, to set the stage for this trip, President Trump got rid of the so-called diffusion rule under Joe Biden, which was basically to prevent or limit the number of chips that could be sold to places like Saudi Arabia and Qatar. Now they're talking about selling a massive amount in addition to getting these contracts for the likes of NVIDIA, AMD, Global AI, Amazon, Cisco, Alphabet, OpenAI, the list goes on and on and on. Question now goes to, are there any strings attached? Is there going to be any kind of way to avoid having those sales go over to China? What are some of the details underpinning some of this, given some of the strategic discussions that have been going on in the United States with other trade negotiations as well?
What's clear, though, the president's in deal-making mode big time internationally over the past week or so, both on the chips front in the Middle East and the trade front in Geneva, with the Swiss brokering that deal between the Chinese and the United States. Scott Besson getting that done. And that's seen this equity market unwind all of those losses we've seen over the past few weeks. Now attention turns back to Washington. And we're going to hear a lot about the tax bill in the weeks to come. The House Speaker Mike Johnson saying Republicans could reach a compromise on the SALT deduction as early as today, a breakthrough in one of the biggest sticking points in advancing President Trump's tax agenda. And then it's on to the Senate. And as you said, then it's back and forth, back and forth, back and forth, and this could be taking a while. But ultimately, they've got an aggressive timeline. They want this done by Independence Day.
And they're basically not sleeping in order to do it. The fact that they've basically been up all night in order to write and rewrite some of the details here is important. Tyler Kendall pointed to the fact that some proponents of increasing the SALT tax deduction have talked about how some of the proposals are not as expensive as people previously thought, so they can use that extra wiggle room to potentially go toward increasing the SALT tax cap. And so here's the question. Who's going to win out? The sweetener crowd or the fiscal hawks? Because that really is the battle that the market is going to be watching most closely.
Or the bond market.
Exactly.
And we've been talking about that a few times. I think you've got to pay attention to the long end of the curve. It's subtle, but we're just starting to push those levels, push back to those levels that got people nervous a month ago.
And it goes to this theory that we've talked about extensively, where if you don't necessarily have tremendous amount of growth, but also a marginal increase in the deficit, that could be the wrong kind of sell-off at the long end of the yield curve that I think a lot of people are trying to avoid.
The president celebrated defense spending just yesterday. NATO allies are working on an agreement to boost defense spending themselves in order to meet President Trump's call that they allocate 5% of GDP. Sources telling us here at Bloomberg the NATO foreign ministers will discuss the initiative this week.
And this really would boost spending for the entire region for the first time, or to the greatest levels that you've seen since the Cold War. I mean, if they were to actually go through with this, they are in discussions. Mark Rutte, who has been actually a proponent of some of these, has been instrumental in this. I am just curious how far they will go and whether this is viewed as stimulative. I know that a lot of people have been talking about this is one bullish case for Europe because they're going to be spending. Is it for a growth perspective, or is it for just some of the defense companies that have seen the biggest boost from this?
Can we just think about, though, and reflect on the difference between now and the president's first term? The sneering, the smirking, the pushback that he received when he was pushing them to spend more. And here we are, years later, and they're all getting together without him, trying to push defense spending up to 5%. Not because they're trying to bow down to the president, but because they realize he was right all along. That's a major change.
There has been a major shift, and there are these arguments, and they have some real credence that some of what President Trump is doing is pushing other regions, including Europe, to do what their economies need anyway. In this case, the backdrop of the Ukraine-Russia war really drives home the need for them to beef up some of their military resources at the same time that the U.S. is threatening more strings attached. So it's a very different reality, but you are right. This is a very different tone in these negotiations.
Huge wake-up call for the Europeans over the last several years, that's for sure. Let's stick with foreign policy. President Trump vowing to lift sanctions on Syria and ramping up pressure on Iran to strike a nuclear deal.
We are currently exploring normalizing relations with Syria's new government, as you know. I am also ordering the cessation of sanctions against Syria to give them a fresh start. I want to make a deal with Iran, but for that to happen, they cannot have a nuclear weapon.
The former senior U.S. intelligence official Norman Rule writing the following: the president's visit reinforces the growing sense that Saudi Arabia and the UAE play an expanding role on the world stage. Norm joins us now for more. Norm, welcome to the program, sir. I just want to pick up on that line of thinking. If that's the case, if they spend an expanding role on the global stage, Norm, at whose expense? Who is being left out?
Good morning. Well, I think their view would be no one is being left out, but rather they are playing a new role where they connect the global north, the global south, and they're able to represent voices that previously weren't heard so often. Africa, India, and the smaller countries of the world. The COP28 that took place in Abu Dhabi, I think, was a representative of this and changed many regional views. And they see that they can bring together Zelensky, Putin, President Xi, President Trump, and they can solve problems in a way that Europe is no longer able to do so.
So, Norm, let's talk about one of the problems that they tried to address yesterday, and that was Syria. What's the significance of lifting sanctions on Syria?
The significance is huge. It provides Syria with economic possibilities to restore an economy that's been shattered by years of sanctions and its own mismanagement. This decision also comes at a time when Europe is considering its own sanctions posture towards Syria. For Syria to reestablish itself in the international community, independent of Iran's control, it must have a viable economy. There were great celebrations throughout Syria after the president's announcement, with the credit going to the Saudi Crown Prince for making this request.
There's a good deal of skepticism, Norm, about this embrace of the Middle East, and a question of how much they can fill that role that Europe used to play of being a true ally of the United States, and whether they can be relied upon over a longer period of time. From an intelligence perspective, do you think that there is some dissonance there, or do you think that the rules of the game have just completely changed in terms of who the allies are and who are not?
I think it depends on what game you're playing. I think it depends on what your targets and issues happen to be. If you care about freedom of navigation and you're looking at the Red Sea, if you're looking at the Persian Gulf or other locations, you're going to have to work with the local players, and you need to give them a capability to burden share. So the president's significant military package to the Saudis actually enhances their capability to do what we would need them to do to burden share in that area. And in many ways, this is what we did with Europe over the decades.
There is this question, Norm, about whether this is going to become a liability down the road. And there is also some concern about opening up. Yes, it's a deal palooza, and yes, you see all the tech leaders in the Middle East trying to get deals. But the prior administration was trying to limit some of the chip sales to the region. They were concerned about potentially those chips getting passed along to China and beyond. And this question of what kind of limits are we setting on these strategic areas? Do you have a sense of what kind of strings are attached around these chip sales?
Absolutely. And it's an important and valid concern that the previous and current administration share. And the Saudi and Emirati position have been clear. Tell us exactly what you want us to do to make sure this technology is protected. They have not said, this is what we'll do and you have to live with it. Rather, they have said, tell us what we need to do in terms of a security architecture, physically, in terms of access, in terms of how we use this data, this material, to make sure that it does not touch your security equities. And that explanation satisfied sufficient critics within the Trump administration to make this proposal possible. And it will be transformational, not only for Saudi Arabia and the Emirates, but there will be a over into the region. You're going to see their engagement with India, Africa, and Europe change dramatically as a result of this.
Norm, do you think that some of the naysayers of all of this are just worrywarts? The people who are talking about the plane from Qatar to the president as being a security hazard, or other types of complaints, are just people who are trying to find something to gripe about? Or do you think there's anything legitimate here?
No, the world is filled with people who like to gripe, and there are plenty of legitimate criticisms in the world. I'll leave it to others to talk about whether or not this plane is a legitimate gift or not. But in terms of what we would do in a security sense, we have more than sufficient technical capability to ensure that if a plane like that were to come to the United States, that we would be able to make sure that it is not a security threat to the United States. It would be stripped and rebuilt in many ways to have equipment placed in it so that it could be used. So it's not going to be a security threat once it's looked at. But as to the appropriateness of its acquisition, that's for others to talk about.
Noam, since we're dealing with worries, can we just finish where we started and address one significant worry? Who is this individual running Syria right now? We understand his role in overthrowing Assad, and we understand that Assad was backed by the Russians and the Iranians to some extent as well. But is being the enemy of my enemy's friend sufficient to make you a trustworthy partner in the region?
Individuals who have dealt closely with the president of Syria state that he seems sincere in his desire to be a president of Syria, that he is driven not by his previous associations with al-Nusra, an affiliate of al-Qaeda, but rather of a desire for a unified Syria. His approach to handling the Kurdish issue and some of the other ethnic elements of Syria is reassuring, but the proof is going to be in the behavior going forward. And the fact that the president is talking about lifting sanctions doesn't mean sanctions can't be placed in the future if that behavior is reversed.
Without a doubt. One to watch. Norman, thank you, sir, for your thoughtful responses, as always. Norman Rule there of CSIS. Things are so busy on the foreign policy front, we didn't even get to Ukraine, and the potential for a significant meeting taking place in Turkey tomorrow.
Yeah, this might be the first meeting since the real conflict began in Turkey between Zelensky and Vladimir Putin. I know that Zelensky has talked about President Trump possibly stopping by to say hello and popping in. You raise a good question, though, about the Syrian president and this question of, do you give a chance? Do you not? What do we know? At the same time, how do you support an economy that's been flat on its back at a time where potentially it's getting a new start?
Things are delicate there. They always are. Equity futures this morning just about unchanged on the S&P, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. Israeli Prime Minister Benjamin Netanyahu says he's days away from ordering an all-out escalation of Israel's war against Hamas. Netanyahu says his armed forces are preparing to, quote, finish the job. Hamas this week released the last surviving U.S.-Israeli hostage, but still holds 58 Israelis, with fewer than half believed to be alive. Meanwhile, Burberry shares are rising nearly 16% in London trading, the company announcing plans to cut as many as 1,700 jobs, representing about 18% of its global workforce. The cuts will amount to an additional savings of $80 million in the next 2 years. The announcement also comes as the company reported better than expected comparable retail sales in the fourth quarter. And hundreds of Starbucks workers have walked off the job to protest a new dress code which requires baristas to wear solid black tops. Starbucks Workers United represents staff at about 570 of the 10,000 company-run U.S. stores. It's filed a complaint saying dress code changes during contract talks are unlawful. That's your Bloomberg Brief. John?
Yahara, thank you. Going to leave that there.
Really?
Yeah, I'm
wow,
not going
I'm
there.
impressed. That's seriously restraining.
I'm being very, very disciplined this morning. Up next, a turning point for the US dollar.
Fiscal deficits still being high, likely the trade deficits being high. That on balance, I think, means the dollar's likely to be on something of a weakening trend.
Jens Nordvik of Exante Data joins us next. Looking forward to this one from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer is not here for that. As small businesses doing under $50 million, you know, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Equity futures this morning, just about unchanged, stable at the moment on the S&P 500. A raise in losses from early this morning. We were down about 1/10% or 2. We're now unchanged on both the S&P and on the NASDAQ 100. We're positive by almost 1/10%. Under surveillance this morning, a turning point for the US dollar.
The reality is, the dollar is at the center of the global financial system. That is an extremely sticky phenomenon that's been a part of our backdrop for decades. You see the likelihood of ongoing twin deficits, those fiscal deficits still being high, likely the trade deficits being high. That on balance, I think, means the dollar's likely to be on something of a weakening trend.
So here's the latest this morning. The dollar sliding as traders weigh a potential new focus for the White House. A person familiar with the matter telling Bloomberg the US and South Korea discussed currency policies earlier this month and agreed to continue talks. Jens Nordvig of Exante Data has been bearish on the dollar for months and writes the following. It's likely that we're at a multi-year turning point. I think the dollar should be moving substantially. Jens joins us now for more. Jens, good to see you, sir.
Good morning.
It's been too long. Thanks for dropping by. We've got some time to work through this. You're looking at potentially a system-level shock that leads to a strategic reallocation of the US dollar away from the US dollar to other currencies. Can you just set the scene for us from 35,000 feet, what you think's happening here?
We've really been on a strong dollar trend since the summer of 2014, right? So we've had this incredible run in US equities. We've had US yields that were generally higher than other places around the world, and investors from Europe to Canada, Australia, Japan have been very comfortable building up really big allocations to the US, unprecedented high allocations, right? And now we're coming into this year, a lot of people were expecting, oh, okay, Trump 2 is going to smell a bit like Trump 1. People actually added aggressively to their equity exposure into this year, right? And then it has turned out that Trump 2 was not really anything like Trump 1. And a lot of people are rethinking those allocations. And it's not just about the tariffs, right? It's about what's happening with foreign policy, who are allies, what's the NATO arrangement going to be. There's a whole host of issues, right, that means that a lot of people are thinking about, is it really prudent as somebody who's allocating globally to have such incredible overweight in the United States? So I'm not talking about is the reserve currency status going to disappear. We're talking about people who have been very, very overweight. Are they going to do some risk management and take the allocation down? And I think the feedback we get from speaking to chief investment officers all around the world is that it takes a lot to shock them, but they are shocked, and they want to change their allocations.
To your point, this has been building for a decade plus of dollar longs building across all asset classes. What we're trying to understand now is, as we take some of the air out of that trade, what are the policies that you see that make the shift away from the US dollar sustainable, durable, beyond just the chaos of the last month or so? How do you think about that at the moment? And do you consider them a push dynamic, bad policies in the US pushing capital out, or a pull dynamic, better policies elsewhere sucking capital in? Which one is it?
Yeah, so the first thing I would say is that we have a list of US policy shocks. And that list of policy shocks is actually generating policy shocks elsewhere, right? So in Europe, we've had now a historical change in fiscal policy where essentially the fiscal rules have been rewritten, right? The rules that underpin the euro have now been changed in a way where you can invest more effectively, right? That's a big change. So That's important for the growth outlook in Europe. We just talked about, as you mentioned, right, the NATO budget potentially also totally different, right? 5% numbers. We used to talk about whether we can get to 2, right? So big changes. So that's something that underpins this idea that there are other places, because if you have more investment in Europe, you also have more bond issuance, right? So the whole supply and demand dynamic is changing. It used to be the case that there was actually very few assets to buy in Europe, and that's changing too. If you look at the comparison between international investors and US investors, in the US, you have an incredible home bias. That's the other part of the story, right? If you look at all ETFs that are issued in fixed income in the US, 1.7 trillion, there's only 0.5% that has any foreign currency exposure. So it can only go one way from here. That's not going to be quick, but over time it will happen.
There's an important point here. You said that this isn't necessarily the loss of the dollar as being a reserve currency. This is just simply a normalization and diversifying away from the dollar. Some people might say that this is a feature, not a bug of this administration, that they want a weaker dollar in order to increase exports. And actually, we're going to see this increasingly as a part of policy, not just as a potential consequence.
Yeah, I think you're right. We certainly have people within the cabinet, Scott Bessent included, right, that have a different nuance to dollar policy compared to the past. There's always this focus on, okay, how do we insource some manufacturing, and a weaker dollar certainly would be helpful in that regard. And you're right, I think if you look at the price action today, it is influenced by these, let's call it Bloomberg headlines about Korea trade deals, so and currency deals. So there's an element of that. So nobody's going to be fighting this trend if the dollar is going gradually weaker.
How much more weakness is there? And potentially, do you see the euro as the biggest winner?
So again, we've literally been going in one direction for 11 years on a trend basis, right? So we've just started, and if we have a big asset allocation shift, it's something that can play out over a 6 to 9 month horizon, and we can easily have, you know, a 5% move down in the dollar index, right? And then we get to these questions, okay, is it going to be orderly, or could there be something that's more dramatic, right? And what we had in April, I have never seen. I've been doing currency analysis since 2000, effectively, right? What we saw in April, we have never seen before, right? Where US bonds are selling off, equity is selling off, and the dollar trades down. So I think that was only for not that many trading sessions, but it's still a warning sign that that can happen, right? So I am, in addition to what we just spoke about, like, I think there's some additional tail risk that if the budget process is not one that investors are comfortable with, I worry that we can have some of the same dynamics as we had in April. So that wouldn't be my central case, but the people who are involved in these budget negotiations have to remember what happened in April. The US bond market is not a kind of indisputable safe haven anymore.
Yeah.
And what happens with the budget is absolutely going to matter.
There's evidence that spooked not only investors, but also the White House in the last month as well.
Yeah, you said yesterday, who's the bigger arbiter, Republicans or the bond market? And I think a lot of people are watching the bond market very closely.
Based on this conversation, it might be the bond market. Jens, good to see you, sir. It's been too long. Thanks for dropping by. Jens Nordvik there of Exante Data. Up next on the program, Wei Lee of BlackRock, Tobin Marcus of Wolf Research, Holly O'Neill of Bank of America, and the former New York Fed President, Bill Dudley. From New York, the second hour of Bloomberg Surveillance. Up next.
The top names in business are on Bloomberg.
The policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. It's going to be important that we get more clarity on the direction of travel from here. As I'm talking to CEOs, as I'm talking to our clients, they are holding back on investment, and they're certainly tightening their belt. You're going to see some companies laying off employees and running their businesses tighter because of this level of uncertainty.
Nobody covers business like Bloomberg.
If I want to go to use an ATM and I have a Bank of America ATM card, but I don't see any Bank of America ATMs, I go to some other bank ATM, I pay a fee. Is that it?
You wouldn't, David, because you're.
What?
You wouldn't, but other people might.
I thought you had to pay a fee. I mean, is that a profit center for banks? Those fees, or
no? You know, at the end of the day, we get 55% of our revenue, our $100 billion of revenue last year. 55% came from interest, 45% came from fees. The dominant part of those fees are trading revenue and asset management fees and things like that. We have consumer fees, but they've come down dramatically because basically we said to the consumer is, you keep changing your behavior, we keep driving down the cost to serve, and we'll give that back by lower and lower fee structure.
Do you think we will have in our collective lifetime no more currency, everything will be digital, or you think that's not likely?
Not in our lifetime.
What about a digital currency, which doesn't preclude other things, but a digital currency?
It's pretty clear there's going to be a stable coin, which is going to be a fully dollar-backed, type of thing, which is no different than a money market fund with check access, is no different than a bank account, really. And so, if they make that legal, we'll go into that business. So you'll have a Bank of America coin and a U.S. dollar deposit, and we'll be able to move them back and forth.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
The circuit is back. How confident are you that AI's promise will outweigh the perils?
I'm not confident.
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
The world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
It's really hard to get a true economic read.
It sounds like there's a lot going on under the hood.
Potentially there's more growth worries priced in the U.S. than elsewhere.
The risk of recession is receding here.
If there's still uncertainty on the other side of that bad data, it's very hard to sort of look through that.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The president just touching down in Doha. We'll get you an update from Anne-Marie in just a moment as we commence the second hour of Bloomberg Surveillance. Good morning to you all. Your scores look like this on the S&P 500. Equity futures totally unchanged this morning on the S&P, slightly positive on the NASDAQ. A quiet session today, a busy one tomorrow. Tomorrow, you'll hear from Chairman Powell, you'll see retail sales, and you'll get an update from Walmart as well. Look out for all of that. Our heads are still spinning here at Bloomberg. What a year it's been so far. Year to date on the S&P 500, we are now positive, up on the year. We dropped almost 20% from the highs. We've rallied more than 18% from the lows. This has been vicious. It's been fast.
And it's been rare. This typically does not happen. Just to put this into perspective, I keep going back to this. Bespoke Investment Group came out with a statistic showing only 5 times in modern history have we seen this kind of retracement of a more than 15% loss in 1 year. So it raises this question, is this the start of something bigger, or is this a sort of knee-jerk response to headlines that potentially could change at any moment when we're staring into the black box of data that's messy and a Fed chair who's telling us just wait and see, and wait and see.
We've heard all these comparisons to the pandemic. It's not the pandemic. And we said repeatedly on this program, the biggest difference is the president can turn the virus on and off whenever he likes. And over the weekend, he turned it off again.
There seemed to be a real sea change when it came to the relationship between the U.S. and China. The fact that tariffs were brought down, the pause period, and suddenly there was not a goal of decoupling fully. I think that phrase really changed the game for a lot of people. Suddenly, there were the contours of the rules of a new game. That more broadly, these two economies, the biggest in the world, are interconnected, but in a couple of key areas, there are going to be greater disputes. Of course, the problem with this is the world doesn't stay on hold for 90 days, and we see the Chinese leader Xi Jinping heading over to Latin America, trying to strike deals over there, criticizing the UK-US trade relationship. So this story isn't written yet, but for now, the temperature has been turned way down and people are celebrating.
The mood music has changed, that's for sure, in this market. The focus shifting once again. This time it's shifting towards tax policy. We'll get you an update on that as well in the next 20 minutes or so. Equity futures just turning positive on the S&P 500. We're up by 1/10 of 1%, turning positive on the year as well. We'll catch up with Whaley of BlackRock in just a moment. We'll also speak to Holly O'Neill of Bank of America on the state of the US consumer. And we'll get you an update from the former New York Fed President Bill Dudley on why the Fed's problems aren't over. We begin this hour with our top story. President Trump in the Middle East, emphasizing the importance of coalition building. Anne-Marie just landing in Doha, head of the president, and she joins us now for more. MH, welcome to the program. Welcome back. Give us an update on what you're expecting today, and please take some time to reflect on what we heard just yesterday.
Well, really yesterday, Jonathan, I think wanted to highlight this administration, the economic relationship, the deals the president was able to put over the finish line. A lot of that we need to make sure we're tracking because it's big numbers. Do they actually come to fruition? That's what we're going to be keeping an eye on. Things like AI, data centers, advanced technology, those chips that Saudi Arabia, UAE now going to be able to get their hands on. Really a transformation of a lot of these economies that have been traditionally economies. They're able to exert their influence due to the price of oil and gas. The president is now really shifting towards foreign policy. And what better place to do that than Doha? Whether or not as the Trump administration or the Biden administration, Doha and Qatar has served as this mediator when it comes to talks in Gaza, when it came to the fall of Kabul and Afghanistan. The Qataris have seen as a place where they want to step in and try to mediate. So we do have the past few weeks, as soon as yesterday, we had negotiators here from Israel. Of course, this is where Hamas's political office is, as well as American officials are here trying to get some sort of ceasefire agreement when it comes to Gaza. And we should also reflect on what happened this morning. The president this morning met with the new Syrian leader for 33 minutes, and then he came out and talked about the fact that maybe we're going to have new relationships, normalized ties with Syria. This comes after yesterday, the president talked about a cessation of sanctions on Syria, and I'm getting mixed messages from Washington, D.C. There's some people who say, why do you continue to keep a country in chains due to the actions of the previous regimes? And there are others who are skeptic about al-Sharaa and obviously his ties in the past as a militant leader in al-Qaeda. But as Norm Rule said in the last hour, he was talking about the fact that they do think this is someone that the administration sees as he wants to turn over a new leaf. The Arab world erupted in that room yesterday because they want to make sure Syria stays within the Arab world and is not leaning towards Iran.
It's a sea change in the region. Anne-Marie, appreciate the update. Stay close. Anne-Marie's going to go off and do some reporting, and if we get any headlines for you, we'll bring them to you. It's been a big move, both for the broader market and for chip stocks specifically. That deal for AMD, for NVIDIA, looking for new markets when they've been effectively closed off by the Chinese and the US and their fight that continues.
This really is the key point. How much do the sales in the Middle East really offset the lack of sales that you get over to China, given the fact that there will be that strategic decoupling that Treasury Secretary Scott Bessent talked about?
Let's get you the view on Wall Street. This from Whaley of BlackRock, writing the following. We still see tariffs causing further contractions in quarterly activity, but the cumulative impact may be more limited. We stay risk on. Wade joins us now for more. Wade, good morning.
Good morning.
Can I pick up on that line? The cumulative impact. How are you measuring that?
Well, there are two potential templates that we can mirror what's happening right now. One is COVID, the pandemic. You switch off and you switch on. But in your case, you're saying that you can switch off again and switch on again, but we're talking about kind of being able to switch it back on quite quickly. The other template is Brexit, where you have multiple kind of years of cumulative scarring, where you have the economy below trend even today. So right now, given how quickly we have seen walk back, maybe the COVID type of template is appropriate in terms of structural scarring, but we're already seeing some sort of contraction, and I think technical contraction in the future is not off the cards, it's not off the table, but chances have been lessened because of the immutable law seemingly at work to guide the destination of where we end up.
When you say we stay risk on, what does that mean in today's market?
It means positive on U.S. equities and corporates in terms of credit over U.S. government bonds. I think what we have seen so far this year, especially this week, is that greater uncertainty doesn't mean greater certainty of a bad outcome. People make false equivalence between the two, but there is a huge difference. So when we talk about kind of U.S. debt arithmetics, when we talk about supply chain dependency, this will govern how quickly decoupling can happen, if at all, which is why we were able to stay risk on despite elevated uncertainty in terms of policy making. I would also say, we talk about U.S. equities recovering year to date. U.S. equities more than recovering the drawdown since April the 2nd, but U.S. government bonds haven't. Term premium went from 35 basis points on April 2nd to 70 basis points. Dollar hasn't recovered fully. So there is something more exceptional about U.S. equities and U.S. corporates, and this is what we are focused on in terms of our risk-on strategy.
This is something a number of people have put up, have talked about, the fact that U.S. exceptionalism still lies with U.S. big tech, and it still lies with some of the mega trends as you've put them out there. It doesn't lie necessarily with the dollar and U.S. assets per se, just by virtue of the U.S.'s position in the world. I want to stick with tech. This has been a bet of yours and the sort of structural theme. Just on a tactical level, has the rally already taken back all of the bullishness that you feel? And for now, it feels like maybe it's going to take a breather, even with some of these deals going on in the Middle East?
Well, tech has taken the brunt of market correction since beginning of the year. We think that there is more to go. If you look at their guidance, they have all committed to their previous capex spend, if not increasing. Broadly, companies are guiding down their capex expectations, but for hyperscalers, they continue to be all in on AI transformation, and multiples now look a bit more attractive compared to compared to before the sell-off, right? So we do think that there is more to go. Now, the bigger picture, we talked about the walk back and how markets are kind of jumping on incremental positive development. But the bigger picture is that we're still talking about a landing zone or for U.S. effective tariffs somewhere between 10 to 15%. That is still 5 times more than the levels at the beginning of the year. And everything considered, we're still talking about an environment where we have higher tariffs, potentially lower growth because of that, and potentially higher inflation because of that. So I think that big picture is important to bear in mind as we think about portfolio construction. And I think markets jumping just to incremental positive news development is a typical case of behavior buyers of anchoring. We just look at kind of the incremental pieces, but the big picture has, tariff represents a stagflationary shock, and we still have higher tariffs compared to before.
Which speaks to sort of the divergence between tech exceptionalism and the rest of the universe. And I just wonder how pressured the rest of the universe of stocks you see as really feeling, especially if you do see potential risk to government bond markets going forward.
Which is why we definitely prefer tech and financials that have been leading in the latest earnings season compared to the rest of the market, compared to small caps, for example. So we see tech as the drivers of U.S. exceptionalism in terms of U.S. corporates, and maybe the rest of the markets as passengers of U.S. exceptionalism wave. And especially at times like this, where we're still talking about higher rates, high for longer, central banks not able to come to the rescue of the economy as they were before, we still want to focus on companies that can grow their margin, that can grow their profitability. And if you look at the latest earnings season, and also previously, tech and financials remain those sectors that we want to focus on.
What happened to the European trade? Where is it now?
Well, we closed the European underweight to lean into the European trade, but we're just neutral, not positive.
What's holding you back still?
What's holding us back? Well, what we have seen so far, if you look at the rally back from the lows post April 2nd, is that the outperformance of Europe over US has stopped. US started catching up now, and if you look at the hoops that Merz has to jump through to get confirmed, there remains risks risks around implementation of all these ambitious policies and reform targets. So we do want to see more kind of clarity around the ambitious targets for us to be positive across the board. But we have liked European financials for a long time. They have been outperforming. We also see opportunities in defense as a sector, given the future spend and lack of capacity in that space. So being selective on European equities, definitely seeing a lot more opportunities compared to the beginning of the year. But the market has come a long way. So I think one thing that we have seen so far is reversal strategy as a near-term way of navigating market volatility has worked. And right now, reversal strategy seems to support U.S.
There's this reason why people are sort of saying pause to Europe. Just want to finish up with China. Do you think that there is more to go there, given the fact that seems like there isn't a full-scale decoupling, and it does appear to be supported by some fiscal as well?
Well, we're also selective in China. We're neutral more broadly across the Chinese equity market, but we like technology in China because of the innovation potential, as well as China tech potentially going a bit more globally. And we also like financials in China because of the national team's support, as well as funds closing their underweight. But the reaction of Chinese markets to the latest development has been somewhat mixed, because the more we see kind of progress on the trade front, the less likelihood there is for more support on the policy side to come through. So now there is definitely a positive momentum in that previously people are talking about maybe 3 handle for Chinese growth this year because of the tariffs implication. But now people are very quickly upgrading their forecast for Chinese growth this year. So selectively opportunistic and positive on Chinese equities is our near-term tactical view. But over the longer-term structural constraints around kind of aging population, lower growth, that hasn't changed.
So those estimates revised higher to closer to 5% already this week. Wei, it's good to see you, as always. Thanks for dropping by.
Thanks.
Wei Li there of BlackRock. Equity futures on the S&P turning positive, higher by a little more than 1/10%, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. Not positive. Our shares of American Eagle Outfitters, those are down 12.5% in the pre-market. In a preliminary earnings release, the company said it expects revenue to be down nearly 5% compared to a year ago. The retail clothing chain also pulled its guidance for the full year due to, quote, macro uncertainty. Meanwhile, Jaguar Land Rover has joined other car makers in withholding profit guidance due to the uncertainty caused by President Trump's tariffs. The British auto giant, owned by India's Tata Motors, says it's evaluating the impact of global challenges and will provide an update during next month's Investor Day. And trading and investment platform eToro has raised nearly $620 million in an upsized IPO. According to a statement, the Israel-based company sold nearly 12 million shares at $52 per share. The pricing marks a major rebound after eToro had paused its listing last month amid tariff-related volatility. eToro shares are expected to trade on the NASDAQ under the symbol ETOR. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the program, jet fuel for the U.S. economy.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market.
Up next on the program, Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The names that move markets are on Bloomberg.
We do not project recession in our assessment of where the world is headed. If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
Nobody covers business like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The president in yesterday's session, the Fed must lower rates. He won't like what he's hearing. On Wall Street, a lot of banks, Citi, Barclays, JP Morgan, pushing back their call for the first rate cut. Goldman going all the way back to December from the summer for that first rate cut for 2025 from this Federal Reserve. This market, though, not interested in that. This market interested in deals in the Middle East for chip makers. This market interested in a trade truce between the US and China. Equity futures up again this morning on the NASDAQ by 1/3 of 1%, on the S&P by more than 1/10 of 1%. Under surveillance this morning, jet fuel for the US economy.
This bill will get to the president's desk, and we hope to do that at least by July 4th, if not sooner. I think in this bill, what we'll do to extend the Trump-era tax cuts is going to be critical for the economy. We believe this is going to be jet fuel for the economy. It will also send a very important signal of stability to the bond markets and the stock market to let people know that Congress is on the job.
Here's the latest this morning. The House Speaker, Mike Johnson, working to get President Trump's big, beautiful bill over the finish line. Johnson suggesting that Republican lawmakers will likely reach a deal on the SALT cap today. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back to the program. Just describe what that compromise might look like.
Yeah, hey, John. Well, it's going to depend on a few things. The current proposal on the table would lift the SALT cap from $10,000 to $30,000, phased out with income limits. But these Republicans from these high tax states like New York, New Jersey, California say that's not enough to ease the tax burden on their constituents. And they're threatening to sink the entire reconciliation package over this one issue. For context, they came into this week looking for that cap to land somewhere closer to about $62,000. So there's a pretty big gap there, but there does appear to be a way out of this, which is that the House tax bill is currently pricing in at about $3.8 trillion. We know that House Republicans were given about $4 trillion to work with here, which would suggest that there's perhaps $200 billion worth of wiggle room. But at the same time, fiscal hawks, of course, have been trying to find savings where they can. There's a few different areas to look out for some other compromises when it comes to SALT. Perhaps we could see a doubling of the cap when it comes to married couples. That's something that would be considered widely popular. And then another thing is expiration dates. So perhaps they will lift that cap higher, but then it just won't stay on for so long. The one thing important to keep in mind here, though, is that these Republicans really do have leverage because House Speaker Mike Johnson has such a slim majority. And John, these are Republicans that represent battleground districts in blue states, and they say they're really digging in.
They've got to fulfill a promise, that's for sure. Tyler, thank you. Tyler Kendall with the latest down in Washington, D.C. They've got an aggressive timeline as well. Tobin Marcus of Wolf Research writes this: despite a bumpy road ahead, we still expect the final bill will be enacted by July. Tobin joins us now for more. Tobin, welcome back. It's good to see you. Let's get to that aggressive timeline. What gives you the confidence we can get this all done, wrapped up, passed by July?
So there's a very hard deadline at the end of July, which is the twin occurrences of the August recess, when these guys are going to be out of town for an entire month. They tend to be very keen about getting out of town. And even more importantly, the debt ceiling X date, which is likely going to fall sometime in August. That is a quite immovable deadline, as opposed to some of the symbolic or aspirational deadlines around getting it done by this recess or that recess. So July 4th, as Speaker Johnson is alluding to, I think is ambitious, but not totally unrealistic. The end of July, I think, is a harder stop.
So, Tobin, what does this bill look like if they do get it done in your timeline, and how widespreading is it with respect to getting some of the campaign promises implemented?
I think they're going to be able to deliver on some version of most or all of President Trump's main campaign promises. They have in here now short-term versions of no tax on tips, no tax on overtime, something that checks the box on no tax on Social Security, although it's not exactly that. On the business side, we're going to get bonus depreciation, R&D expensing. They have this new structures expensing provision that kind of has supplanted the original idea for a 15% reduction of the corporate rate on U.S. production. So I think they're going to be able to check the box on much of that. The harder questions are on the offset side. Still ongoing debates about Medicaid. They put in quite sweeping, though gradual rollback of IRA that, in line with our views, looks like it's been pretty tolerable for markets. But it does seem like the pieces are falling into place on most of what they set out to do.
Tobin, what have we learned in terms of just how much, as Anne Marie would say if she were here, President Trump is sort of chief whip? He is the one going around and getting people to support and line up behind this bill. Do we have a sense that that clutch is still very much present?
They haven't really needed him yet in that closer role in the House process. I think they probably still will. We are still seeing, simmering concern about Medicaid, for example, from both the moderates and the conservatives. I think that they may need to bring him in to lead on one or both of those groups of folks. For example, if they do take the SALT numbers up to appease those blue state members, that's going to make the deficit situation look a little bit worse. There are already concerns about that on the conservative side. So I think if you're trying to get those folks on board, keep them in line as the bill gets a little bit less fiscally responsible, that I think is going to be an important role for the president.
It's open. We know a lot about the SALT lobby. We've talked about them tons over the past few weeks. Who are the hawks in the Senate that we need to focus on in the weeks to come?
So from a spending perspective, Ron Johnson has kind of put himself out there along with Rand Paul, who I think most folks are figuring are not going to end up voting for it, Senator Paul, as saying, we need more spending cuts. This needs to be a more fiscally responsible bill. I think those were points well taken because a lot of the strategy for managing the cost of the bill is to rely on timing gimmicks. So both those individual and corporate tax cuts that I was running through, most of those expire in 2028 or 29. By our reckoning, extending those for the full decade, as we all expect that they will try to do, adds another $1.2 trillion in costs to the bill. So quite substantial. This is not really a bill that tackles the deficit, and it's stimulative in the early years. And then they're also going to be pinched on the moderate side. Senators Collins, Murkowski, Hawley have all raised concerns about the Medicaid reduction. There are various folks, including Senator Capito in West Virginia, who've been concerned about how far some of the IRA rollback provisions go. So, as in the House, I think there are going to be a lot of different vectors of concern and people nibbling on different axes.
Tobin, just before you go, we're getting live pictures of the president disembarking Air Force One. He's just touched down in Doha. Foreign policy has become increasingly a focus of this trip to the Middle East. Tobin, all these promises over foreign policy deals, can you talk to us about defense spending? Just how big is that push going to be? Where are the cuts?
So, the answer to where are the cuts in general on all of this, I don't think that the deficit is really going to be a focus to the extent that some of the rhetoric would suggest. The president's budget proposal calls for, sort of flat discretionary defense funding, a big tranche of defense funding through this reconciliation bill, and then big cuts in non-defense discretionary spending. I don't think they're going to get non-defense cuts. That needs to be done on a bipartisan basis, and they're not going to have the votes for that. So I think mostly we're looking at, kind of flattish funding along with this big new infusion of defense funding in the reconciliation bill. Deficits are not going down. They're not going to hit Secretary of Essence 3% target. Mostly they're going to deliver on their other policy priorities and let the fiscal picture shake out where it does.
Tobin Marcus of Wolf Research. Tobin, thank you. Those pictures coming live from Doha as the president takes the next leg of his trip in the Middle East. The next leg focusing on potentially foreign policy and more.
Which potentially could be the next leg upward if there are some deals struck, in particular the war with Ukraine and Russia.
Futures right now positive by 0.2%. Up next, we'll get you a read on the U.S. consumer with Holly O'Neill, the president of retail banking at Bank of America. From New York, this is Bloomberg. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Nvidia up again in the pre-market, this time by more than 3%. Just adding some weight to this rally, adding some weight to a major rally off the low. The closing low on April 8th, we're up by more than 24% since then on the NASDAQ 100. The NASDAQ 100 this morning positive by 0.4%. The S&P up by a quarter. With 2 hours until the opening bell, with your morning movers, here's Danny Berger. Hey, Danny.
Hey, John, I got to say, it's not just NVIDIA. It's really any of these AI companies that have had a whiff of a mention in U.S. and Saudi deals. Supermicro Computer, one of the biggest beneficiaries of that. It's up 16% pre-market. It was also up 16% yesterday. The gains keep on coming. For this company, it specifically struck a deal with a Saudi data center company called DataVolt, saying it would be a multi-year partnership, that Supermicro would help supply some of the servers for it. The company has been struggling, so this is a big turnaround for them. We also had some sell-side action, specifically coming from Morgan Stanley, that seems to be shaking things up this morning. It gave a double downgrade of CBOE, saying that normalized relationships, or at least thawing of the tensions between U.S. and China, happened bigger and sooner than they expected. So defensive stocks that did well during the market turmoil, i.e. an exchange that does better when volatility and options are being traded, now isn't going to do as well. So they have downgraded CBOE, those shares falling 1.5%. Now, for a very similar reason, those analysts at Morgan Stanley also upgraded KKR. A more normalized capital markets environment means that private capital can do well, that deals will be getting done, one hopes, in a more normalized macro environment. Those shares up 1.8%, also saying that it's an attractive entry point considering that those shares have sold off this year, John.
Hey, Danny, thank you. Appreciate the update. Just an update on our programming tomorrow morning. Jim Zelter of Apollo. Jim Zelter a number of weeks ago talked about so-called macro paralysis. And I wonder about that macro paralysis theme now after the events of the past week.
Is it macro deal making? Is it essentially the paralysis released, cured, as people try to get to the playing field and really strike up some deals?
Look out for that interview tomorrow morning around 7 a.m. Eastern Time. On our radar this morning, President Donald Trump landing in Doha for the next leg of his trip to the Middle East. Trump expected to participate in a Qatari state dinner later on today, and that destination is playing a bigger and bigger role. You talked about it in foreign policy.
Yeah, especially given what's going on with Israel and Gaza and what they've done in terms of negotiating some of the release of hostages. On the way there, how much is he going to make a stopover in Turkey at the same time to really discuss what's been happening between Ukraine and Russia and brokering a meeting between the two leaders? Here's a question. How much does this really solidify this region's instrumental role both on a foreign policy level but also at an investment policy? And you point to the fact that tech stocks are surging and they're taking another leg higher pretty much across the board, partly because it is clear that there isn't the same kind of discrimination against some of the more friendly nations when it comes to chip sales as there is to, say, China.
I'm pleased you brought up Turkey. I think that's potentially an important meeting tomorrow. As far as I'm aware, we still don't know who's in the Russian delegation. And I think I get the sense, and others do too, that who is in the Russian delegation will dictate whether the president actually goes to Turkey to be a part of these talks or not.
If it's Vladimir Putin, yes. If it's not,
something
no.
like that.
Something
like
very
that.
similar, very simple kind of cheat sheet. That's kind of what people are looking at. It is going to be curious to see how serious these talks actually are about ending that conflict that has killed so many people.
It's been depressing, awful, that's for sure. Elsewhere, we've got to return to the markets and talk about what's happening here stateside. Equity futures, as Lisa indicated, are near session highs off the back of these moves that we've seen in chips. But one thing that hasn't fully recovered is the US dollar. If you notice, the South Korean won has been climbing. Sources telling us here at Bloomberg that South Korea and the US discussed currency policies early this month in Milan, with an agreement to continue talks on operating their FX markets. Now, this is interesting. We had a conversation just moments ago with Exante Data's Jens Nordvik. And Lisa asked him an important question. He was reflecting on this dollar long that's been built up over the last decade and the potential for a reversal. And the fact is that that move might be welcomed by this administration, and our reporting would, I think, to some extent speak to that.
If you have a weaker dollar, you can increase your exports in a more consumer-friendly manner. It is cheaper for other countries to export from the United States. So there is this theory that maybe this is what this administration wants, especially as news comes that they are discussing currency manipulation as part of the trade discussions. Can I just say, this feels a little bit like a Festivus-style airing of the grievances of, you know, VAT tax and currency manipulation and chickens. I mean, it feels like that pretty much around the world. And when it comes to South Korea, they did intervene in their currency last year, late last year, when the dollar was surging. Here's a question, though. What is the ultimate goal? Is it just to normalize the trade relation? At what point does it get too weak? This is going to become on your dashboard, maybe, of headlines to watch and ranges to look out for.
Yeah, this is part of our reporting, and I'd like to hear them talk about it on the record to see what the ultimate objective actually is. Now, Lisa mentioned this yesterday, that this market has potentially been reduced to just monitoring the social media account of the President of the United States, and Goldman did some research just for Lisa. President Trump likes US oil prices between $40 and $50 a barrel, according to Goldman Sachs. The firm analysed his social media account, finding he has posted nearly 900 times about oil and US energy dominance.
So this is the new model, evidently. The inference about preferences that this president has, and you mentioned earlier, John, I wonder what that inference would be for the Fed policy and what exactly triggers him to start jawboning the Fed. But this highlights two things. Number one, how important oil really is, raising questions yet again about the increase in supply from the Middle East ahead of some of these negotiations. But then there's a second question. Is this the new dashboard? You talk about economic data. Is the new dashboard Truth Social posts that you can then somehow calculate, get a sense of getting into the mind of the president, and then getting ahead maybe of some of the headlines that have been jerking around this market?
I'll let others do the psychoanalysis of the president regarding his social media account. It has been reduced to the entire market. I agree with you. It's been reduced to just tweets and headlines regarding trade. His point on gasoline, though, is real, and he's right. Gasoline prices have been falling, and that helps set the tone for the consumer. So let's turn to the consumer. Retail earnings ramping up, with Walmart reporting on Thursday, offering another read on the US consumer. The team at Bank of America writing the following: spending momentum remains, though it's moderating. Consumers appear to be pulling back, particularly on bigger ticket discretionary services like airline tickets and lodging. Holly O'Neill is the president of retail banking at Bank of America. I'm pleased to say she joins us now. Holly, welcome back to the program. I want to talk a little bit about the consumer, and then we can get to what you're doing operationally. But let's start with the consumer if we can. What are you noticing, and how is that different to what we've seen previously over the past few years?
Well, the consumer appears to be continuing to spend. They're very healthy. And you had the headline. They spent in April at a rate of about 1%, and that's our credit and debit data. And that was just slightly cooler than they spent in March at 1.1% growth year over year. So they have momentum, but it's moderating a little bit. And I think the driver of that is that they're supported by continued wage growth. So we saw good wage growth in April, both in higher income and lower income, though it is moderating a little bit. So that theme is still healthy, but moderating.
Holly, I'm pleased you broke up the income groups, because we sit on that just for a beat. The low-income group have been squeezed for a while. We've seen that in data repeatedly throughout this cycle coming out of the pandemic. Do you see any stress going up to the upper-income cohorts?
No, so the lower income household wage growth, just to give you the numbers, picked up by about 1.5% in April, and that was stronger than March. So March was 1.4%. So that wage growth in the lower income cohort increased a little bit, and I think that wage growth is continuing to support the consumer and the consumer spending. When you get deeper into the data, some of the credit data as an example, the lower income households are continuing to hold up. Overall, we've seen 30-day delinquencies come down a tad. So I think that consumer still is showing signs of good health.
This really raises a question, Holly, about how much we can really count on some of the soft data, which indicated an incredible amount of nervousness and pessimism among consumers in the United States during the month of April, in particular after April 2nd. Are you saying you're just not seeing it? That frankly, people can go out and gripe about how concerned they are about the future of the world, but then they go out in a spending spree?
We're not seeing it. And I think we often talk internally about, you have to separate what consumers are saying versus what they're doing, what we're seeing in our data. And that data is telling us that they're continuing to spend, although it is moderating. And so we saw in April, restaurants, good spending there, but we did see a dip down in airline and lodging, leisure travel a little bit. So consumers are adjusting slightly, which leads to that, the momentum is dipping just slightly, but you really do have to separate what consumers are saying in many of the confidence and sentiment numbers versus what they're doing, what we're seeing in our data, whether it's spending data, payment data, or credit data.
Holly, I want to congratulate you. You have basically just received a pretty big promotion. You're running much more of the consumer bank, and you come at a time when there's a real question around how different the scenario is in different parts of the United States, how it's not a monolithic story at all, and how different regions are feeling very different realities depending on what their local economies really depend on. How different is the scenario that you're looking at in the United States right now, depending on which region you're in?
So we obviously have across the country footprint. We have 3,700 financial centers in all of these local communities. So, our goal is to really deliver for our consumer clients, approximately 70 million of them, uniquely to what their situation is, whether that's geographic or that's individual. So, we are there to adjust and course correct based on what our clients are telling us and based on what they need.
Holly, how are the interactions changing between customers? How different are they now? And how does that change what you need out of your physical footprint?
So our strategy is all about physical footprint supported by digital. And it's really the combination of the both that I think lead to the power of how we can deliver for the consumer client. So those 3,700 financial centers in local communities, coupled with world-class digital capabilities. Those digital capabilities continue to grow, they continue to advance, and consumers love them. At the same time, it does not substitute for face-to-face interaction that we get in our financial centers when a consumer client really wants advice and guidance in their financial position. So it's the combination of the two that I think really deliver the power for our consumer clients.
Holly, how much have you been able to expand the physical footprint, in part because of the turmoil that happened? It feels like 10 years ago, but not that long ago, I guess March 2023, in terms of some of the regional banking turmoil. How much of this has just accelerated since then as you look to take market share?
So we continue to expand into new markets. We continue to build new financial centers in communities where we need them. So we will continue to advance that agenda across the country. New markets. Idaho is a recent new market that we've entered, and we've got more coming. So we will continue to expand in new markets. We'll adjust our footprint in existing markets, opening new financial centers. Over the last decade, we've opened roughly more than 200 financial centers. And as we look forward, we expect to continue to open 150 more over the next 2 to 3 years.
Holly, I was dead wrong about all this. I thought as we change these interactions, we'd end up with a smaller footprint, that it would give banks a reason to cut costs and reduce their physical footprint. Holly, why is that not happening? And is there space for that to happen in the future?
Yeah, no, you're not wrong. It has happened. If you look over the last decade, we started with 6,000 financial centers. We are down to 3,700. That may tick down slightly overall as we do things like consolidate, close 2 financial centers in a local community and open 1 new financial center. So you will continue to see at the margins some reductions, but that physical footprint, that engagement with our clients in their local community is incredibly important as a complement to the digital reach that we have with our clients.
Holly, appreciate the clarity. As always, it's good to catch up. Holly, I know there of Bank of America. Whenever we catch up with Bank of America, just a direct read on the consumer. No politics, no bias, nothing. Just this is what's happening, this is what we're seeing. And what they're seeing is still okay. Some resilience.
They didn't see any translation from that soft data into the actual behavior of consumers. This just goes to the angst that people have of what can they rely on as a sense of exactly the real-time response of consumers and of corporations.
If you are just joining us, welcome to the program. Equity futures here near session highs, up 0.25% on the S&P. Chip makers doing nicely, and Nvidia up in the pre-market by something like 3%. With an update on stories elsewhere, with your Bloomberg Brief, here's Yahara with more. Hey, Yahara.
Hi, John. President Trump says the luxury jet being gifted to him by Qatar's government will be used as a temporary Air Force One. Trump said it would be foolish not to accept the jet, which he says will save the U.S. hundreds of millions of dollars. The offer setting off alarm bells within the U.S. intelligence community, where gifts from foreign powers have long been viewed with suspicion. Meanwhile, Harvard has expanded its lawsuit against the Trump administration for freezing billions of dollars in federal funds. Harvard claims that federal agencies illegally halted funding because the university refused to submit to government control over its academic programs. Yesterday, the Trump administration cut another $450 million in grants to Harvard. And baseball's all-time hits leader Pete Rose has been taken off MLB's ineligible list, qualifying him for Hall of Fame induction. Rose, who died last fall, had been banned since 1989 after he was found to have placed bets on games as a player and as a manager. MLB Commissioner Rob Manfred said he met with President Trump earlier this year where the two discussed Rose's situation. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, appeasing President Trump.
I think the Fed's going to be in a good position to cut a few more times. That could appease Trump, because really what was holding them back, you can't cut when there's 145% tariffs, where no one knows where they're going to go in the globe right now.
Up next on the program, the former New York Fed President, Bill Dudley. Live from New York, you're watching Bloomberg TV.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count
toward the reconciliation numbers. Don't ask why. I can't understand why. We're running it like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
The top names in business are on Bloomberg.
The policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. It's going to be important that we get more clarity on the direction of travel from here. As I'm talking to CEOs, as I'm talking to our clients, they are holding back on investment, and they're certainly tightening their belt. You're going to see some companies laying off employees and running their businesses tighter because of this level of uncertainty.
Nobody covers business like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Neil Shearing, Capital Economics, with this to say. The recent climb down has left the effective US tariff on the rest of the world at around 15% versus 27% previously. Still the highest since the 1930s, unlikely to cause a global or US recession. That's the view from Neil this morning.
This is the ultimate question. Yes, the mood music has changed dramatically, but so too has the landscape versus the end of last year, and it is a vastly different and higher cost tariff regime than we had before.
Equities, off the back of all these headlines, positive for 2025. Equity futures up again this morning by 0.2%. Under surveillance this morning, appeasing President Trump.
I do think reduced tariffs gives Powell a little bit of ammunition if he has to cut rates. I think the Fed's going to be in a good position to cut a few more times. That could appease Trump, because really what was holding them back, you can't cut when there's 145% tariffs where no one knows where they're going to go in the globe right now. It's so hard to tell where we're going to wind up as a steady state.
Here's the latest this morning. President Trump calling for the Fed to cut interest rates once again, saying it's, quote, not fair to America after a soft CPI report out just yesterday. Former New York Fed President Bill Dudley writing the following: the Fed has little choice. When it doesn't know which way the risks skew, it must wait for more information. Right now, any major move would have only a 50-50 chance of a positive outcome. Bill joins us now for more. Bill, welcome to the program, sir. Why such a negative assessment of the position that they're in right now?
Because they don't know where the tariffs are going to land, number one. And two, they don't know what the effects of the tariffs are going to be on growth versus inflation. So they're uncertain about two dimensions. So they can't really just sort of flip a coin and say, oh, we're going to worry about the growth dimension, because that could turn out to be wrong. So they have to sit and wait for more information. I mean, if you were driving a car in a thunderstorm, you wouldn't just put the car on autopilot and hope that you would get through it safely. So you pull to the side of the road until the weather cleared up, and that's what the Fed has to do. The Fed is going to be criticized for waiting. They have to wait, and because they're waiting, they're probably ultimately going to be late. But it's not the Fed's fault. I would behave exactly the same way in this set of circumstances.
Bill, what's their definition of late, and what's your definition of late? Because he reflected on the move last summer, and he said, in some ways, we were a little late, and other people thought he was being preemptive. What's late to you?
Well, I think late is responding only after you've seen a sizable increase in the unemployment rate, because at that point, it's really hard to avert a recession. You know, when I evaluate the risks to inflation versus the risks to growth here, I guess I worry more about the downside risks to growth. But the Fed can't put all their marbles on that side of the equation, because inflation's been running above the Fed's target for 5 years, and if they're wrong and inflation expectations get unanchored, then it's a really difficult problem getting inflation back down. So I think they have to wait. Because they wait, because they'll be forced to wait, they'll probably be late. Trump will blame the Fed for being late, but the reality is Trump created the conditions that forces the Fed to have to wait.
Bill, I'm just curious going forward how much you see the Fed unwilling to move, even if the unemployment rate rises by 0.5 percentage point, which is sort of the trigger that a lot of people are looking at, if you do see those inflationary pressures coming back.
Well, I think if the unemployment rate rose by, above 4.5%, that would change the Fed's calculus. They would be much more worried about the self-reinforcing deterioration in the labor market leading to a full-blown recession. So I think the unemployment rate is really the single most important indicator. If it stays around where it is today, Fed's going to just sit and wait. If the unemployment rate starts rising quickly, then the Federal Reserve will start to respond. But I think it's going to take some time. I mean, the hard data on the economy shows that the economy is still just fine. I mean, the first quarter GDP report was very misleading because it was mainly the fact that they couldn't count inventories properly to match up with the big surge in imports.
Bill, if you were still on the Fed, and you have been on the Fed through crises and through really difficult times where the market was moving faster than the underlying economy, what data would you look at to get a real read on what was going on in the United States?
Well, I think some of the banks have actually pretty good real-time data in terms of what's happening in sort of credit cards, and they're not seeing much of a slowdown at this point. Initial unemployment claims, it gives you a pretty high-frequency look at what's happening to the labor market. That doesn't show any deterioration yet of note. So I think you're looking at things that at the margin that suggests that weaknesses that starting to accumulate. Now, what's interesting is the tariffs are actually starting to bring in revenue. So fiscal policy right now is actually starting to become tighter. And I'd also look at low-income households, because I think that's where the squeeze is going to be the most significant. So if you start to see delinquency rates on subprime auto loans really start to head up, I mean, they're already high. If they start to head up even more substantially, that would be also a sign of growing strain on the growth side.
Bill, at some point, the Fed will have to update their numbers. On March 19th, they put out these forecasts: GDP at 1.7% for 2025, PCE at 2.8, unemployment at 4.4. On June 18th, they'll have to deliver an update. When we get that update, Bill, what do you think it will look like relative to March?
I think they'll show somewhat slower growth to reflect the fact that tariffs have gone up more than they anticipated, and somewhat higher inflation to reflect the same consequence. So I think it'll be even a more pessimistic forecast in the sense that the Fed will be missing both of its dual mandate objectives by a bigger magnitude. But they still don't have clarity on what's happening to tariffs and the impact of tariffs on the economy. And so I think it's going to take a while for that to be realized. And only then will the Fed be able to act.
One missing piece: slower growth, somewhat higher inflation. What does the median dot do, Bill? Because I think that implies what their reaction function is, how they'd respond to that kind of data mix. Do you think it changes?
I think that you can make the case that the Fed starts to cut rates in September, and maybe we could still get 3 rate cuts this year, which would be consistent with the March summary of economic projections. But obviously, as time passes and the Fed doesn't act, the likelihood is the median number of rate cuts starts to come down just because there's fewer meetings left.
Bill, appreciate your time, as always, sir, and enjoy your pieces on Bloomberg.com. On Bloomberg Opinion, the former New York Fed President, Bill Dudley there. How do they respond to a stagflationary mix in the forecasts?
They have a couple of weeks and many, many, many more headlines to discuss before they get to some sort of response. But that is really a key question, and will only open them up, I'm sure, to more job owning from the Fed unless they cut rates by 100 basis points. This from Austin Goolsbee of the Chicago Fed this morning in another publication, saying our job is not to respond to daily market gyration. It's to be a steady hand of wait and see.
They're going to wait and see, but they've got to put some numbers on wait and see on June 18th. The next Fed meeting is not too far away. Up next, Kate Moore of Citi Wealth. We'll catch up with Chris Casso of Wolfe Research, Michael Reed of RBC Capital Markets, Lindsay Rosner of Goldman Sachs. From New York, this is Bloomberg.
In the world of real estate, which is your favorite child, data centers or offices at the moment, in terms of the near-term ability to put money to work?
I think from a value standpoint today, offices are pretty compelling in a place like New York City or San Francisco. Because in New York, you have financial services firms who are growing rapidly. You don't have any new building. In San Francisco, the values fell very hard, in some cases 75%. And AI and technology innovation really housed in San Francisco And so I think in some of these markets now, given the sharp decline in value and the lack of new supply, office buildings become interesting. You definitely want to buy more modern buildings. But I still like the data centers too. There, what's attractive is this need for compute power. I referenced DeepSeek, but obviously the cost of compute has come down pretty dramatically, and we think the usage is going to go up. Our lives are migrating online, and I think these data centers are a critical part of that infrastructure. I think margins in companies are going to expand dramatically. I think we're going to use these bots to help us do so many things in our lives. And so ultimately, I think the infrastructure spend against this will be quite significant.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
There is a lot of appeal to U.S.-denominated assets still.
I don't think we're going to see this resurgence to buy America.
It's very hard to undo a decade of policy that's been very favorable for the U.S.
From a market perspective, anything that lowers that amount of uncertainty is positive.
Most of the gains are behind us because it still is very hard for the S&P to reach new highs.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
What a year so far. It is May 14th. We are positive on the year on the S&P 500. We are positive post-April 2nd, and we have rallied by more than 18% from the April low. Your scores this morning look like this, adding some more weight to the rally. Futures higher by 0.2% on the S&P, on the NASDAQ higher by 0.3. Your week ahead looks like this, pushing ahead to tomorrow. These are the main events. Earnings from Walmart. You'll get retail sales as well, and then an address from the Fed Chair, Jay Powell. All of that through the next 24 hours. And of course, as always, one eye on the President of the United States, Donald Trump, who's just landed in Doha and had this to say. The president saying there might be news on Russia and Ukraine later on today, 24 hours ahead of a meeting that could take place over in Turkey.
Everything everywhere all at once. So here you go. Where do you focus and how do you see the potential upside? One thing that I've noticed from a lot of people is there's this real debate, given how much the market has rallied from the lows, what could send it higher, right? Given the fact that so much of the reprieve has already been baked in. And some people point to actually this. If there is some sort of deal between Russia and Ukraine, if there is progress on the geopolitical hot zones that have really been causing trouble for a lot of places, barring that, take a step back. Where do you focus, given the fact that this is a whack-a-mole market with lots of headlines, to just flip your head upside down again?
On the tax bill, apparently. and I'm pleased you mentioned this, it feels like we're taking down the temperature across several dimensions. The war in Ukraine, the situation with China, access to chips, a big feature of the rally in yesterday's session.
Yeah, and this is actually really interesting, right? How much do you take away business potentially from China and then really replace it with the Middle East, given the fact that that seems to be the big promise, at least of the Riyadh trip, of the Saudi Arabian trip. Now the question goes to some of the foreign policy elsewhere. You do mention the tax bill. This is sort of, again, if your head is spinning and you're sort of like, where are we going? It's because that's basically what this market is doing. It's sort of, which is the focus of this minute? And that really is the push-pull. At what point do you get some sort of ballast from some sort of calm on trade, which again is disputable, at the same time that there's discussion about deficit spending that potentially could upend the bond market? So, you know, yeah, there we are.
I know this sounds really frustrating. I remember Rick Reeder of BlackRock said to me years and years ago, he said the market can only focus on the shark closest to the boat. And the shark closest to the boat for the last several months has been trade. And after the weekend, there's a new shark. The shark is the tax bill down in Washington, D.C. And to see the market focus shift the way it has done, just in the last 24 hours alone, David Kelly at JP Morgan Asset Management came on the program. We got CPI. And we turned around to him and said, can the Fed be comfortable with this, a downside surprise on CPI? And he went straight to the tax bill and talked about a reassessment to growth and inflation 12 months, 24 months out.
Yeah, what kind of sweeteners do you get? What kind of potential increase to the deficit? Just to build on your analogy, if the market can only focus on the shark closest to the boat, what do you do if there are about 5 different sharks that are just eking out a little nose extra closer to the boat? Do you focus that much more on that one? Can you ignore the 4 other sharks that are right there? It's a school of sharks, and it's just sort of, you know, out there, and you have to keep track of them, and then they all kind of speak in truth.
My response back then was something like this, that if you're focused on the shark closest to the boat, you miss the storm on the horizon. Is that the bond market?
Well, yeah, maybe that's the storm on the horizon, but it's also a shark. It's just a little bit further.
Managed to get gloomy for you. I don't know where this is going. Coming up on the program, Kate Moore of Citi, on why tariff de-escalation doesn't signal the all-clear for risk. We'll catch up with Chris Casso of Wolfe Research as Trump opens the floodgates for AI deals, and Lindsay Rosner of Goldman Sachs as uncertainty limits portfolio allocations. We begin this hour with stocks gaining after the S&P 500 wiped out losses for 2025. Kate Moore of Citi Wealth with this to say: the market has been too fast to dismiss tariff pain. Businesses and consumers will need to share the burden of higher tariffs, and we expect both margin pressure and slower demand. Kate joins us now for more. Kate, good morning.
Hi, I did not bring my shark with me.
Good. We can move on. Your former colleague as well. Let's talk about all this volatility over the last month. I remember something you said last time we spoke. You said, I'm biased to action. I'm biased to action, but in this environment, you have to be very careful about the decisions you make. What about this new environment now?
Well, sometimes the most important action is not doing anything and actually waiting for more information if you're going to be making fundamental decisions, or if you're using fundamentals and data and strong database forecasts and to reallocate your money. In this case, we haven't had a significant positive change. Yes, there's a big change in terms of sentiment. There was a lot of technical pressure. We saw a lot of the fast money rush back into the market. But the earnings story hasn't changed. You know, the fact that we are in a slower growth environment than we were 3 quarters ago hasn't changed. You know, are we entering a recession? You know, who knows? I think we're in a period of slower growth. We were there before the April 2nd tariff announcements, and that we needed to kind of adjust our equity allocations for that slower growth period. And I just don't see any significant catalyst to the upside in terms of earnings growth or economic growth.
Can you share with us the adjustments you made before the April 2nd announcement? And what is defensive in 2025? Is the nature of defensive stocks different to maybe what it was years ago?
Well, okay, yes, great 2 questions there. Rotations and stuff before the April 2nd tariff announcements. You know, there were some allocations to small cap in the portfolio that we took off. We basically said, hey, look, we don't see as much opportunity for small and medium-sized businesses in a slower growth environment, even as the labor market is reasonably strong. But inflation, we think, would continue to be a bit sticky, and we just didn't see that upside. Small cap, as you know, tends to outperform when growth accelerates. The other thing that we've been really debating, frankly, is the U.S. versus the rest of the world. And you know, we've seen a significant amount of, you know, investors say, hey, we don't want to own as much U.S. given the amount of volatility, the policy uncertainty, the growth uncertainty. And that's all good and fair. But the truth of the matter is some of the highest quality earnings and cash flow still exist in the U.S. And so as we think about themes and where the leadership could be in the back half of 2025 2027 onwards, it may be uncomfortable for some people that some of that leadership still exists in the US around technology, around spending on AI infrastructure, and around these companies that have outstanding balance sheets, superior management teams, and can really weather the storm of lower economic growth.
There are a lot of things to unpack there. Just sticking on tech, since that is driving the rally this morning, certainly on the headlines coming out of Riyadh and the potential deals that are agreed upon, how much does that give you comfort to even add some of the bullish positioning in this area, given the fact that any decline in business from the likes of China could be offset by the Middle East and, frankly, elsewhere?
Yeah, so in this period we've been in for the last few months where there's been so much uncertainty and we've seen businesses kind of pause in terms of some of their spending and consumers maybe pull forward some of their demand. And, you know, the one area that we've seen no one take their eyes off of is AI and technology, because it's existential for almost every business at this point. No one can afford to step away from their plans, their spending, their investment, their people development in this area, because if they come out of a slower period of economic growth and they're not positioned for an uptick and they're not looking competitive relative to the rest of their industry, they're going to be toast. So this is an area where I would say the spend is going to be Teflon around a lot of tech. And there are going to be other areas around extra capital expenditure or non-necessary CapEx and stuff that I will expect to be slower.
So we dealt with that shark. It's off, and I am going to bring that up again. There's another shark, which is right here, which is what John was talking about, which is the bill that they are crafting down in Washington, D.C. Right. It's still going. It's been 24 hours of discussion. How much does that raise your attention in terms of focusing more on the bond market and the potential ramifications for higher yields, deficit spending, potential steady growth, but not necessarily expansion to offset some of that increase in fiscal spend?
Yeah, look, I mean, it would be great to have some fiscal support, but by the way, we were having a bit of fiscal drag even going into this tax bill. That was 2025, just sort of the CBO estimates in general. I don't think we're going to get a huge amount of stimulus. I think that some of the stimulus that we would get for perhaps some segments of the consumer is going to be offset by a decline in spending on programs that are going to be essential for other parts of the consumer. So in general, I'm a little bit worried, frankly, about these negotiations, the impact it's going to have on growth. And as you mentioned, we're watching really the signals from the bond market very closely. But in the near term, I would say we were paying a little bit of attention 1 year on that, but most of the attention, frankly, is on whether or not there are additional trade deals struck over the next couple of weeks, or at least promises of conversations.
So you think that that's the more important driver going forward? To get a sense
I don't think people are going to be because the tax bill is complex and there are so many cross currents in it. I think they're going to be more focused on the cost side, particularly from the tariffs. In the near term, more than the tax bill.
Any thoughts on timeline? How quickly this gets done? They're very aggressive. They think they can get this done by Independence Day, before the end of the summer.
That feels ambitious, and I would suggest that September feels more likely to me. But I'm not as much of a DC expert as some of the folks that you have on the show.
Does that make a difference as a market expert, though? Does that make a difference if it drags on into the fall?
Well, I think we're not going to have a quiet summer. Look, we have a number of deadlines around the tariff stuff that we have to pay very close attention to. There's going to be lots of conversations, headlines, announcements. I think anyone who's expecting to sort of check out and go to the beach is going to find themselves disappointed. Because there's going to be a lot to pay attention to. And at the same time, and this isn't really critical, we're getting some of this information on tariffs, or we go through the first 90-day window for most countries and then the next 90-day window for China. We're going to be entering into second quarter reporting season. And we know this has been a choppier period of time where there's brought forward demand and then perhaps some slower demand as people wait for clarity.
And then brought forward again.
And then brought forward again.
Over the last week or so.
That's right.
So how much weight will you actually put on earnings reports? What will you look for? What have you looked for over the past few weeks?
Yeah, it's been hard because you say, wow, that was a good first quarter for most companies, and it exceeded expectations, and you want to feel positive about that. But at the same time, I'm so focused on what companies are doing in terms of guidance, and most of them have not really significantly changed their guidance as a result of some of this tariff. They've maybe given another scenario. A few companies and a few industries, as we know, pull their guidance. But on the whole, they're just like us. They're trying to, take in new information, sometimes on a 30-second interval, and factor that into forecasts for, big spending and hiring and investment.
Just quickly, when you put this all together, it sounds like you see margin compression in the ex-tech world.
Yeah.
You see the idea of yields being sticky and stagflationary types of forces. This is a very bad mix for most assets. Is that kind of what you're expecting, sort of flat to negative on the year?
I don't want to use the word bad. I'll say it's a more challenging mix for parts of the market. I always like to say I never want to bet against the resilience of large cap U.S. companies. You know, they will make the changes they need to defend their margins. But I think we'd be a little bit naive to think that there's not going to be an air pocket in terms of activity or a challenge to margins, frankly, for a number of months. Perhaps it will last quarters. Does that lead to a significant earnings decline in 2025? I don't think so. But it's not going to be a smooth ride. And I think people have to be prepared to rotate into the higher quality and more sustainable earnings parts of the market, which may favor tech.
This interaction between margins and the economic slowdown, huge question from economists.
Yeah.
Will it mean losses to labor? Will it mean layoffs? We saw a little bit from Microsoft, again from Burberry this morning. I'm going to use the word we all hate on this program, Burberry, idiosyncratic. I get that. There are other stories out there too. Are we going to see the job cuts? That's what people fear.
Well, you know, companies haven't really cut for the most part at this point, right? They've been holding on to labor. They don't want to get into a place where they get whipsawed and then all of a sudden, you know, as we know, the cost of bringing a new employee back on or trying to convince someone to return to the firm is incredibly expensive. So I think that they're willing to keep the labor force as is for the next quarter or two. But if margins are seriously compressed, I'd say into 2026, that's going to be a different story at a time where we might see some other headwinds.
And this is the low churn dynamic that Citi, Andrew Hollenhorst, has talked about now for a number of months. Almost a frozen labor market. Yes, we see these big payrolls gains every month sometimes, but look at the JOLTS figures. The JOLTS figures speak to that slow churn, low churn dynamic in the labor market in America.
Is that healthy enough to keep the economy on solid footing through a tumultuous time and to keep people being able to absorb potential increases to prices? And that's the ultimate question. Or does it mask real pain that's emerging in small pockets elsewhere? And frankly, that is a conundrum.
Kate, this was great. It's good to see you again. Thanks for dropping by. We'll do it again soon. Kate Moore there of Citi Wealth. Equity futures at the moment positive by 0.2%, 1 hour and about 16 minutes away from the opening bell. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Goldman Sachs analysts say President Trump likes U.S. oil prices between $40 and $50 a barrel, judging by his social media. The firm analyzed his posts and said he tends to call for lower prices or celebrate falling prices when WTI is greater than $50. Goldman Sachs says Trump's preference for low oil prices supports their view that prices will edge lower in 2025 and 2026. Meanwhile, shares of American Eagle Outfitters down nearly 12% in the pre-market. In a preliminary earnings release, the company said it expects revenue to be down nearly 5% compared to a year ago. The retail clothing chain also pulled its guidance for the full year due to macro uncertainty. And Tesla CEO Elon Musk might get a new pay package. The board formed a special committee to explore a new package, according to the Financial Times. They say the committee will also explore alternative ways to pay Musk for his past work if Tesla fails to reinstate his record 2018 pay deal via appeal. Deliberations are still in the early stages. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the program, the Morning Calls Plus, Chris Casso of Wolf Research as Trump opens the floodgates for AI deals in the Middle East. Live from New York, this is Bloomberg.
going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The names that move markets are on Bloomberg.
We do not project recession in our assessment of where the world is headed. If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
Nobody covers business like Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Here's a flavour of the equity story this morning. So far, slightly positive by 0.2% on the S&P, up by, let's call it 1/3 on the NASDAQ, adding some weight to the recent rally on both the S&P 500 and the NASDAQ 100. That NASDAQ up 24% from the lows of April. Just unreal, phenomenal rally we've seen over the past few weeks. That's the price action. Let's get you some morning calls. First up, Raymond James, double downgrading United Health to market perform, saying visibility for the rest of the year is low after retracting its guidance. That stock is bouncing back by close to 3%, hammered so far this year. Your second call from Jefferies, downgrading Rivian, predicting a disappointing demand outlook this year. That stock is down by 0.9%. And finally, Bank of America raising its price target on AMD to 130, saying its Saudi deal could offset China restrictions. Sticking with chips, semiconductor stocks surging after President Trump clears the way for major AI chip deals with Saudi Arabia. Chris Casso of Wolf writing this. This announcement does nothing to change our bullish view on NVIDIA or AI demand. Our concern is that government interference could potentially artificially reduce demand. Chris joins us now for more. Chris, welcome to the program, sir. I need to spend some time getting into what was actually announced yesterday, but I'd love for you to build on that. Why could government interference potentially reduce demand?
Well, and good morning. Our position is that there's plenty of demand for AI right now. Really, the constraints on, what NVIDIA can sell is constraints on the availability of power and the availability of making the chips themselves. So, in that vein, we feel that government isn't creating any new demand. What deals like the Saudi deal do would be, potentially shift the location of that demand from one region to the other. But then the other concern that we have is that, now that the AI diffusion rules that were put in place by the Biden administration are now being redone, the question is, how are they being redone? And, what it would seem like is that this will be subject to individual deals. The concern that we have is, not the deals that are being struck, and that's fine. It's the deals that won't be struck. So will it be a situation where, AI chips will be used as some negotiating leverage in a trade deal, and that trade deal doesn't happen? Well, that would actually be a reduction of demand.
So, Chris, let's build on some of that, because before I came to you, I read out this call from Bank of America that they say the Saudi deal could offset China restrictions. Are you saying it's too soon to know?
Well, I guess what we're saying is that Saudi deal was going, in the absence of any regulations, that Saudi deal was going to happen. If the regulations were in place, so the Saudi deal wouldn't happen, the investment just would have been made somewhere else in one of the regions that were allowed to have chips. So again, I don't think this creates any new demand, and therefore I don't think it offsets anything. It just kind of shifts where the chips are on the table.
Chris, does it do anything for just the development of artificial intelligence and the adoption of it, of the new technologies, to see governments so intricately involved in figuring out where deals would be struck, which companies are involved, which players really do get the upper hand?
Well, and maybe put it in a little different way, the Saudi investment is, one of the things in AI we're calling a sovereign AI. And, for example, this organization is involved in building large language models in Arabic. And obviously, most of the large language models are in, some of the more, the larger languages, English and such. So you still are, and this is a big driver in AI, is that you need to have this capability in every language on the planet. And so, the Saudi investment is certainly doing that. And again, what our concern in government interference in this is this was, market forces doing this on their own. And, what we prefer to see is as little interference in that as possible because the market is taking care of all the demand.
All of that said, Chris, you still are very much positive on NVIDIA, and you do see this bull case simply because demand is so outstripping supply. Do you think that NVIDIA is going to be really still the clear winner, or do you see some progress being made by others? And I'm thinking not just about the likes of AMD and other U.S. companies, but also those in China.
Well, and I think because of the restrictions that were put in place just a couple of weeks ago, where NVIDIA and AMD can't sell any chips to China, there certainly is going to be an AI industry in China. It's going to be led by Huawei because they have no other choice. The issue with Huawei exporting their technology outside, well, there's two issues. One is actually the administration has said that using a Huawei chip is not permitted under the particular rules. So it makes it difficult for Huawei to sell outside of China. And the other problem is that Huawei just doesn't have access to the same process technology that NVIDIA has because of restrictions on what equipment providers can sell into China, and then Huawei can't use TSMC like NVIDIA does. So I think Huawei itself is not a threat outside of China. Where there are alternatives for customers outside of China is doing the chips on your own. And the biggest one of that is Google. Google does their own AI accelerator, and it's very good. And what we're seeing is others, Microsoft, Amazon are starting to do their own accelerators as well. I think that's NVIDIA's main competition, is the hyperscalers doing chips on their own.
Chris, just build on that. You're saying the biggest competition could be their biggest customers.
Absolutely. And, in semiconductors, there's always been a consideration, do I buy the merchant solution that's available to everyone, or do I build it on my own? And because of the enormous cost of these chips, obviously it makes a lot of sense for these guys to do it on their own. What Jensen, NVIDIA's CEO, talked about at their event last quarter was his goal is to make this a race, right? He's trying to move as fast as he can, advance the technology as quickly as possible. And his customers, if they want to do stuff on their own, they have to keep up. There's a certain amount of the market which has to go NVIDIA because of software limitations and that. And, so NVIDIA is always going to have a big place at the table. And how much share they have of AI is ultimately going to be a function of, how effectively can those customers keep up with NVIDIA's technology doing custom chips on their own.
Thought-provoking stuff, Chris. Appreciate your time, sir. Chris Casso there of Wolf Research, just reflecting on what's been announced over the last 24 hours and giving his thoughts on the path forward.
The idea of the biggest competitors being the biggest clients, really compelling on multiple fronts. I will say, Google kind of has to. They've got an existential threat. I'm not just talking about being broken up by potential antitrust. My kids made me download ChatGPT.
How's that going?
And they say use it instead of Google because Google is old school and you really are dating yourself. And so I started just using ChatGPT, and it is, I shouldn't say this, but it's vastly superior. I mean, it really does.
It's a very different experience.
Yeah, it coagulates information in a much more cohesive way without the noise of the ads, et cetera. So it really raises this question. How does Google make itself relevant in the next phase of those kids who are all using ChatGPT?
One of the biggest headlines of the last month came from Apple. Search has peaked on Google. It was quite a big headline over the past few weeks.
Yeah, this is going to be a really important race for them to be involved in. On a broader level, though, it highlights how it gets really muddy when you try to get central planning involved with the idea of how you forecast demand and deals and all that.
There's a role for government, but I'm with you. I get uncomfortable around central planning.
I think a lot of people do.
I really do. Up next on the programme, Michael Reed of RBC Capital Markets and Lizzie Rosner of Goldman Sachs from New York City. This is Bloomberg. this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
60 minutes away from the opening bell, equity futures just about positive this morning and on the year now, up by 0.08% on the S&P 500 after a tremendous rally off the low, up by more than 18% from the lows of April on a closing basis on the S&P. As of yesterday, on the NASDAQ 100, a move of more than 24%. Just unreal. This morning, we're higher by a third of 1%. Let's turn to the bond market. Your scores, 2-year, 10-year, 30-year. Have a look at 10s. Your 10-year at the moment, 447.48. The 10-year at the end of last year and the beginning of this year, let's call it 456.
Yeah, we're basically right where we were before, so essentially nothing's changed. Again, people say don't go to the beach. Maybe we all should go to the beach because in, 3 months' time, it'll all look exactly the same, I'm sure.
Everybody who's endured the last month deserves a trip to the beach.
Amen to that.
Not sure who's banning the beach. Remember when Libby Cantrell banned the beach last year?
Yeah, and then we just heard a banning of the beach from Kate Moore. The banning of the beach has to stop.
No banning of the beaches, all right? 1 hour away from the cash open. Let's get your morning movers with Danny Berger. Hey, Danny.
Hey, John. I think if you're investing in chip makers, you can definitely take some time and go relax on the beach because these keep rallying. It's remarkable. We had a big surge yesterday, and it continues. NVIDIA up 3% in the pre-market, AMD up 4.2% after the deal signed with Saudi for a new investment pact with U.S. chip makers. Getting a lot of positive sell-side research as well. I know you're just having a conversation about this, but Bank of America also upgrading both of the chip makers, talking about multi-billion-dollar opportunities for them in Saudi. Dan Ives of Wedbush also taking the same tone, saying that it is more demand that's going to be coming for these chip makers. Now, to the downside this morning is Aurora Innovation. It is a self-driving truck technology firm. Uber heavily involved in the firm. It sold some of its tech operations to it when it comes to self-driving cars. It also took about a 23% stake in it as of the end of December. Well, Uber is now selling about $1 billion in convertible notes, and those notes can be converted for Aurora Innovation, a dilutive event. So we're seeing a big hit to shares, down 19% this morning. Also to the downside in a big way, American Eagle down 13%. It has completely scrapped its 2025 outlook. Another retailer to do this, saying it is facing macro uncertainty, also pre-announcing a very weak first quarter, heavily marred by discounts, by excess inventory, and a big write-down of that inventory. John.
Danny, thank you. The dispersion within that industry has been amazing to watch over the past month or so. We get another update from retail tomorrow. You'll get Walmart, get retail sales as well, and you'll hear from Chairman Powell too. It's quiet this morning, but a busier 24 hours coming up. Let's get to Mike McKee for more on that. Our economics and policy correspondent. Good morning, Mike.
Good morning, John. Well, we don't have any indicators today to speak of. We have mortgage applications. They were up just a little bit. But tomorrow, as you say, we get retail sales at Walmart. And what will be really interesting is to see what Walmart's guidance is going forward, because retail sales will only tell us what happened last month. And there's mixed pictures coming out in terms of the analysts for that. We do have some Fed speak today. We've got 4 Fed officials talking. Chris Waller did not mention the economy. He talked about Fed Research. But Phil Jefferson and Mary Daly are likely to talk about the economy and likely to use the word uncertainty. Austin Goolsbee on NPR this morning basically talking about uncertainty, saying the Fed has to be the steady hand in this situation, but nobody really knows what's going on. The market, though, doesn't have to really pay attention to the Fed, since the Fed is taking itself out of the arena for the moment. They're looking at what's going on up on Capitol Hill with the reconciliation bill. I got asked about this yesterday. What we've seen is a drop in the short end. This is the yield curve. A drop in the short end because people are thinking the Fed might have to get involved if the economy slows and they have to cut rates. But the long end going up because the reconciliation bill contains a lot of financial stimulus for 2026, 27, 28, and that could contribute to inflation in the long run. Also on the reconciliation side is the whole debate about the debt ceiling, and you can see that playing out now in the bill market. Look at the yield on the 3-month bill, which falls into that period in August when the debt ceiling would probably be hit if they don't get something passed sooner than that. It's jumped up. Uncertainty over what's going to happen there. So there is that you can see is the 1 month. That's where it was just 2 days ago, the 3-month as well. So as you can see, there's always something for the bond market to worry about, just not the Fed this week.
Mike McKee, thank you, sir. We'll come back to you in just a moment. That's a movie we've all seen way too many times over the last decade, right?
Yeah, this is the problem, is that right now it seems like whack-a-mole, and right now the focus is turning to the bond vigilantes, which once again are coming to the fore.
Michael Reed of RBC Capital Markets writes this. Here's his view on the trade deal over the last week. The trade deal with China won't get inflation back to target. Michael's with us around the table. Michael, good morning. Good
Thanks for having me.
Why do you encourage, why can't you take comfort from what was announced over the weekend?
Well, we're just going from something that was very bad to something that's now just bad. We're looking at an effective tariff rate that is about 5 times higher than it was in 2024. And the deflationary help we've been getting was coming all from the core goods space. So when you start adding tariffs onto goods, that's going to you're going to lose all that help. And you're going to lose that progress that you've been making, getting back to 2%. We saw that stall in 2024, and we don't think we're going to make much progress here in 2025.
In the pandemic, negative supply shock meets positive growth shock, positive demand shock on steroids. How different are things now, this year?
Very different. First, as you know, we don't have that positive shock coming from the stimulus. So while you did have a bit of a boost coming from consumer spending during COVID, we're not going to see that same effect here. Now, there are some positive tailwinds that could come from what we're seeing in terms of the tax cuts being pulled forward. Maybe the wealthy get a little bit of help in terms of the SALT deduction being bumped up. But when you talk about things like SNAP benefits maybe being at risk, that's going to hit the low-end consumer. Those are the folks that are really struggling now, and those are the folks that tend to spend the most money. They have the highest propensity to spend.
We've been debating how long it's going to take to see some of these things, when we start to get a definitive read, when we can actually listen to Fed officials giving us some actual constructive guidance based on their complete lack of visibility into all of this. What is your compass to understand on the margins just how stagflationary this could be, potentially how much growth could surprise to the upside? Because we keep hearing this word resilience when used with the U.S. economy.
So right now, our forecast for GDP is below trend. That is to say, we're about 1% versus what you see in terms of historic growth around 2%. And much of that comes from a drag on the consumer. We also have the impacts of trade right now. We saw that in Q1 being negative. Now, there's some mechanics, right? You're going to see maybe a boost in Q2 due to an inventory buildup. But I think further out, it really depends on the labor market, how the consumer overall reacts. And there's 2 very different buckets that we're seeing. We've talked about it in terms of the K-shaped economy, but it's really these, those halves, the high end, the high income consumer, and those low income consumers, because inflation has impacted those groups very differently.
Well, so extrapolate that out, because we've seen this for a while, and so far the wealthier individuals, which, as you put, might even get an additional break from some of the SALT tax deductions, have really propped up this economy en masse. And so you've seen luxury products do really well. You've seen airlines try to cater to the upper end. And you've seen a falling back of the lower income communities again and again. At what point will that matter to the overall averages? It matters very much to those communities, but it hasn't necessarily had the same ramifications in the overall general economic metrics as many people would expect.
Yeah, so I think what's at risk right now is the jobs that are tied to trade. And that's where you have a high volume of jobs at risk. So think retail trade, wholesale trade, transportation and warehousing. And those are very much correlated to the volume of goods coming in. So if you continue to see tariffs, even if we go from 20% to 10% in terms of the effective tariff rate, you're still going to see a drag on imports into the U.S. ultimately. We're not seeing it yet, but that will happen. And that's when you start to see those job losses. Businesses will have to make a decision whether or not they protect their profit margins. And labor tends to be the first to go. And so you could see a high volume of workers in those sectors lose their jobs. And I think that's when you start to see upward pressure on the unemployment rate.
And that's when the Fed conversation might shift. Be honest, did you fall asleep last week in the news conference? Did you come close?
I came close, but Powell continues to kind of maintain a center line in terms of how he's managing both the expectations for labor and inflation. So I think the takeaway was we'll continue to wait and see.
Can he repeat the act on June 18th?
I think he's going to have to.
It gets harder with the forecasts. How are they going to change versus March?
Yeah, I think they won't change all that much, to be honest.
Interesting.
They will maybe move some of their GDP forecasts lower. I think they'll have to think about inflation. But if they're doing what we're doing, it's no longer thinking about a point forecast. It's thinking about scenarios. How is this going to play out? What are the odds you're placing on different outcomes for the economy based on what's going on with tariffs as well as fiscal policy?
We want to understand how they respond to certain scenarios, and that could be implied in the forecast. And a question we asked a little bit earlier to Bill Dudley was, how will the forecast change? And he said GDP might come down a bit, inflation might go up a bit. And then we responded and said, well, what would happen to the median dot in response to that? How will they respond to a stagflationary scenario? Because he avoided that last week. If that's asked again, if they're put on the spot, how do you think they answer that question?
I think they're going to wait and see what the data tells them. I think that's what they're going to say. What we think is going to happen is they're going to be more sympathetic to labor in the sense that when you start to see job losses, that has a significant impact on the economy, on consumer sentiment. And historically, if you look back at what the Fed has done, they tend to cut faster when the unemployment rate goes up, even by 0.3. So we do think unemployment will gain in terms of their eyes if it becomes a risk that job losses are accruing.
That seems to be the bias on Wall Street. That if the labour market cracks, they'll crack too, and they'll cut rates.
That's what we heard from Bill Dudley. Right now, the unemployment rate really does take precedence over the inflation rate. I guess that the logical question would be then, is it plausible for them to cut rates and see a steepening in the yield curve? Again, that long end selling off, which is what we saw last year, and something that people say is probably going to be an ongoing theme.
What did Michael Reed publish last week? What was that note?
His team came out with this, which was absolutely the best email of the whole thing. Today's Fed press conference was the epitome of this could have been an email. And that email didn't even need a body, just the subject line, wait and see. By the end of that event, Powell has said wait and see 12 times, and wait by itself another 13. So to me, that won the moment.
Michael said wait and see a few times as well. That's a note from a guy that almost fell asleep in the news conference, clearly. Michael, it's good to see you. Michael Reed there of RBC Capital Markets. A lot of attention is shifting now to the tax bill down in Washington, D.C. A lot of economists have done a lot of work on this. Neil Dutta of Renmac is one of them. And he said a few times now, there is a difference between removing a potential headwind and providing a tailwind. Mike McKee, I want to bring you back into the conversation. The difference between extending current law and doing something in addition to that. Just how stimulative will this tax bill be, Mike, next year and beyond?
It won't be like the Tax Cut and Jobs Act originally was, and it certainly won't be like the stimulus that we got during COVID. But it will add to consumer wealth over the next 3 years, and it's timed that way deliberately because the tax cuts that they're going to add for tips and for not paying interest on new cars, those are going to take effect next year and take effect through 2028 as long as Donald Trump's in office. So those years, that's something that will be added into what people take home. Also, the child care tax credit's going to be extended, but just for a few years. All this because because they're using reconciliation and they can't have this long 10-year debt out after that. But we're going to see some short-term stimulus that might help the economy. The bond market's looking at that as perhaps a little inflationary, especially if you combine it with tariffs.
Mike McKee, thank you, sir. Good luck to the Federal Reserve, who on June 18th have to update those forecasts. Lindsay Rosner of Goldman Sachs writes this: markets have completely removed pricing in the worst-case tariff-created economic scenario. The question is, if we've come too far, too fast. Lindsay's with us around the table. Lindsay, good morning.
Thank you for having me. Hi.
Some of these markets are back to where they were at the start of the year. How different is the world now? How much has the world changed now versus the start of the year?
It's changed tremendously. I think, as the prior economist just mentioned, tariffs are still net significantly higher. And so it kind of feels like a scenario where you started off with a 30% personal tax rate, it got moved to 70%, and it came back to 50%, and you think it's awesome. But don't forget, it was once at 30, and I think that's what the market seems to have lost, and it's just really excited over the past 48 hours. So I think it's going to come back to reality, sadly.
What does reality mean?
Reality means that spread should be a little bit wider, we think, and that there should be more dispersion around credit quality. That's why in our portfolios we are moving more up in quality, because we think that will protect you if we do in fact see maybe not a recession, but just softer growth. That really seems inevitable.
This builds on something that you wrote in some of your notes, saying that uncertainty for you means the bar from straying to straying from a home base allocation is higher. And it goes to the question, what is that home bias allocation? Is it to higher quality, just focusing on credit of companies that can pay it back?
Yeah, that's exactly right. It's doing that work, looking at the credit fundamentals and understanding which companies can survive in an environment where tariffs are going to be here. They are maybe not going to be as extreme as we feared, but they're here. So companies that are in the crosshairs, i.e. Consumer, retail, hotel, things that you should be concerned about around tariffs, that's stuff we want to de-emphasize in the portfolio. And home base also, just having portfolios with carry. This is an environment where you want to have carry to kind of wade all of this out.
Is high quality credit safer on some level or more defensive than duration of the U.S. government?
Well, we actually like both. Certainly there was a big debate about, has the U.S. lost their safe haven status? We do not believe that that's happened. We think duration makes sense in a portfolio because we think that the Fed will act if need be. And again, to echo the prior guess, if the Fed sees 5% unemployment, they will be cutting. What's changed, though, I think, in the probability and what the market's showing you right now is that the probability of a 200 basis point cut, because we see a really sharp, immediate recession, that's been taken off the table. And that's what you see in the forward probabilities on future interest rates.
As you know, risk can cut both ways. How much upside risk to growth does this tax bill potentially introduce?
It could, but I think we all have to lower our expectations. It's certainly not what was anticipated post-election. It's the greatest thing since sliced bread. The world is going to be a completely different place. Maybe we'll have a quantum leap in terms of economic growth. That I don't think is realistic, and I think we've all been honest with what the prospect could be, but it certainly could be helpful, for sure.
What do you think is realistic? Can we put some numbers on it?
Yeah, I think we're not going to have, I'll frame it in the terms of economic growth. We are not going to see 2% trend growth. Could we see 1? Does it not have to be 0 and certainly not negative? Yes, I'll say that. But to think that what could happen in this tax bill could then unleash animal spirits and that we move beyond a 2% trend growth, we are not seeing that at all.
Is 1% growth sufficient to keep spreads contained?
Right now, what really is being priced in, both to spreads and equities, is something on the order of 2% or trend growth. So back to the point of we think that things can widen from here. It's because what's being priced in feels a little too optimistic to us.
When Lisa asked you about credit, you talked about some areas, consumer-facing, retail, etc. How much dispersion are you seeing between individual credits? Because Lisa and I were talking about this earlier this morning. You see some retailers doing okay in this environment, others really struggling. How much dispersion is appearing?
Yeah, dispersion is really revealing itself. I think earnings told us a lot. Interestingly, as Mike McKee said, kind of stole my thunder, I think what'll be very interesting will be Walmart on Thursday. That is going to kick off what is happening with the consumer right now. And if you remember back, it was February 20th when Walmart last reported. They were the kind of shot across the bow that let us know, hey, something could be a little bit problematic with the consumer because of this macro uncertainty. So reading those tea leaves in earnings is really powerful, and there's a lot that you can do on the alpha side of the table to find the winners and stay away from the losers in this environment.
How much of the corporate pain is going to be absorbed by private credit markets?
Private credit markets, as we know, are growing and stand ready and open to take some of that on. So
have they already, though? Are they going to experience it in greater amounts than the public markets?
I don't know if it's a greater magnitude. I mean, there's some interesting differences between the private and public market. One of the positive things that they say about the private market in the pitch is that there's a lot of flexibility to work with the company and the lender. And that's a relationship that can be improved, and terms can be changed if needed. I don't think that the private market's underwriting is far different than what's in the public market, but there are some tools and some flexibility, and the underwriting's a little bit different. So the private market will not be immune if we have problems in credit.
Lindsay, good to see you. Clinic as always. Thanks for dropping by. Lindsay Rochner there of Goldman Sachs. Looking out for Walmart earnings tomorrow, and I think for a lot of us that is on the dashboard tomorrow morning. Walmart, retail sales, and you'll hear from Chairman Powell too. Equity futures at the moment positive by 0.2% on the S&P, with an update on stories elsewhere with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. United Health's new CEO, Stephen Hemsley, will receive $1 million as an annual base salary plus a one-time $60 million equity award as he returns to the helm. Hemsley will also get additional personal security benefits following the December murder of the company's top insurance executive. Meanwhile, Harvard has expanded its lawsuit against the Trump administration for freezing billions of dollars in federal funds. Harvard claims that federal agencies illegally halted funding because the university refused to submit to government control over its academic programs. Yesterday, the Trump administration cut another $450 million in grants to Harvard. And at a congressional hearing today, Health and Human Services Secretary RFK Jr. plans to defend his decision to cut thousands of staff and funding at the agency. Kennedy will testify about his agency's 2026 budget request and his progress toward President Trump's goal of shrinking federal spending. That's your Bloomberg Brief. John?
Yahira, thank you. We'll catch up with Yahira again tomorrow. Up next up on the programme, we'll set you up for the day ahead, and we'll touch base with Anne-Marie in Doha. Live from New York, this is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a trillion-dollar game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
The top names in business are on Bloomberg.
The policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. It's going to be important that we get more clarity on the direction of travel from here. As I'm talking to CEOs, as I'm talking to our clients, they are holding back on investment, and they're certainly tightening their belt. You're going to see some companies laying off employees and running their businesses tighter because of this level of uncertainty.
Nobody covers business like Bloomberg.
The circuit is back. How confident are you that AI's promise will outweigh the perils?
I'm not confident.
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The open about 36 minutes away with equity futures positive by 0.2%. A busy 24 hours coming up. Your calendar, your trading diary looks like this. Today, the President of the United States in Doha after wrapping up his visit to Riyadh. Tomorrow, this is where it all begins. Walmart earnings, PPI, retail sales, another round of jobless claims, plus remarks from Fed Chair Jay Powell and President Trump heading to Abu Dhabi. So look out for all of that. And going into the weekend, one final data point for you, UMich consumer sentiment. Joining us now on the ground in Doha, AMH. Anne-Marie, let's get to it. The President just landing moments ago, a number of hours ago. Talk to us about this leg of the trip and what we should look out for.
Well, the President's spending some time right now, Jonathan, at the Royal Court meeting with the Emir. We're expecting both of them to come out and sign a bilateral agreement. We understand this is economic cooperation. Potentially, this is where we're going to hear about the Boeing deal that we talked about last week, a Bloomberg News exclusive, that Qatar was finalizing putting these finishing touches on buying at least 100 wide-body jets from Boeing, which will be a huge boost for that airliner. I actually heard today that the number is going to be higher than 100. This is a huge deal for this massive American company. So potentially we can hear that. Of course, lingering on this leg of the trip is all the fuss, really, about that Air Force One. A lot of pushback right now, Jonathan, in Washington about the security concerns if he was to accept that jet.
Looking forward to your reporting, Anne-Marie, on the ground, following the President. We're looking forward to the next 24 hours. Lisa, what are 24 hours coming up for this market?
To me, the highlights can be Walmart. How are they dealing with some of their supply chains? How much are they competing on price? And how much are they going to hope to capture some of the market share at a time where that's been what they have been doing for a long time?
You're not alone. That's the main event for many. Coming up tomorrow, reacting to all of that, must watch. Gene Soroka of the Port of Los Angeles, Jim Zelter of Apollo Asset Management, Michelle Meyer of the MasterCard Economics Institute, and the JP Morgan Chase CEO, Jamie Dimon from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Italian Open update for Bloomberg TV and radio from Tennis Channel. Reigning Roland Garros champ Carlos Alcaraz reached the quarterfinals in Rome for the first time with a 3-set win over the hard-hitting Karen Khachanov. 41 winners for the 22-year-old who closed out the victory 7-5 in the third after just under 2.5 hours. And don't forget, you can watch all the action live daily on Tennis Channel.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past
to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
In case you missed it, on Bloomberg Open Interest, how much would it cost to bring production here, Rebecca? I mean, what kind of upcharge would you be looking at?
There is no handbag infrastructure in America anymore besides a couple of small factories in New York City. So not only would we have to build a factory that could make the amount of units we're trying to make, but we'd have to bring back hardware manufacturing, bring back tanning and leather. I mean, these are all things that are purchased overseas and assembled. You know, if you want this to really work, give us grants to build factories, give us several years of tariff breaks in order to make these things happen, and then we'd love to make in America. It just right now, if I were to switch everything to America, my price would double, and my consumer is not here for that. As small businesses doing under $50 million, you know, keep us alive. We are employing millions of people collectively and affecting livelihoods across the U.S.
Don't miss Open Interest live weekdays.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Futures rising again, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Shonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, we are back in the green as investors await fresh catalysts for the rally that erased the S&P 500's 2025 losses. Bold calls out today. Citi and JP Morgan are betting that this year's biggest losers, that's small caps, tech hardware, and home builders, will become short-term winners as trade tensions ease. And deal-making in the Middle East. President Trump ties that push U.S. tech initiatives to center stage. Shonali, what stocks are you watching?
And some people like those initiatives, particularly these AI companies. NVIDIA is up almost 3% pre-market, about 2.8%. Chip makers are all higher as the U.S. clears a path for Saudi Arabia and the UAE to pursue more AI ambitions. NVIDIA and AMD are already planning to spend billions of dollars in the region, Matt.
All right, also, I'm watching American Eagle Outfitters. They are down sharply after withdrawing their forecast. Another company to withdraw its forecast due to the macroeconomic certainty. You can see the shares today down 13% in the pre-market. They've already lost about 50% of their value, Shonali, in the past year.
And Matt, meanwhile, President Trump has sent a message to the world in Saudi Arabia. Make business deals and the U.S. won't meddle in your affairs. He praised the Middle East during a meeting with Gulf state leaders yesterday in Riyadh.
I've seen such progress. It's really incredible. I've also seen great unity and friendships. I've spent a little time with you just before this, and I've seen tremendous unity, tremendous friendship, and the whole world is watching the Middle East, and many are watching with envy. You have something very special going on.
Now, President Trump landed in Doha today. Anne-Marie Herdern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance, is there. She joins us now on the road. Listen, Anne-Marie, yesterday, 1 day ago, was full of fireworks. Do we expect those same fireworks as he continues this trip through the Middle East in terms of multi-billion-dollar announcements or strategic deals?
Well, you know, Shonali, sometimes 24 hours in Trump world certainly does feel like a year. A ton of deals were announced yesterday, and also some massive headlines on the geopolitical front, especially when it comes to the likes of Syria and the president lifting sanctions on Syria and meeting the new Syrian leader this morning before he touched down in Doha, where I am. And he's spending his morning at the royal court. We are expecting him and the emir to come out. They're going to be signing a bilateral cooperation focus on economics. More deals are expected. Last week, Bloomberg News, we had exclusive story that Boeing was lining up to work with the Qataris. The Qataris are willing to invest, buy 100 wide-body jets. I was told this morning that actually you can expect that number when they come out and announce it to be higher. So more than 100 jets being purchased by the Qataris. So expect more deals today when it comes to the president and his time here on the ground. Also, we are wondering whether or not, for some it's fuss, for some it's consternation, whether or not the president is going to announce this Air Force One Boeing from the Qatari royal family that he would be using. What I've been told that this is still being worked out, whether or not this is legal. There's a bit of pushback right now in Washington amongst Republicans about the security of this, the legality of this, and just whether or not it's appropriate. It's
Interesting to say the least. I mean, we did get the Statue of Liberty as a gift from a foreign government, but is this plane used? I mean, I'm not 100% sure it makes sense to have someone's old plane that they've dressed up in their own style as Air Force One. How does that work?
Well, I think what would happen is you would just have the bones of the plane, and they would completely remove all the guts. There would have to be a tremendous amount of security overhaul if this was going to be carrying the President of the United States. The issue, of course, is the fact that the President in his first term put in for a new Air Force One with Boeing, and obviously there's just been delays on delays. And now the President talked about it to Fox News last night, was that the Qataris heard about it and offered up this jet that they had, which I believe at the moment is actually being housed in the United States.
All right, Anne-Marie, thanks very much for that reporting. Bloomberg's Anne-Marie Horton reporting from Doha. Apparently it's a 13-year-old jet, and like, if they can't retrofit a new one for Air Force One, how long would it take to rebuild the old one? It's definitely an interesting story. Let's get to the implications of his trip for the markets and really for AI, because new agreements will give Saudi Arabia wider access to AI chips. NVIDIA is rallying on the news, and Supermicro is soaring after signing a $20 billion pact with Saudi-based data center company DataVolt. For more, we're joined by Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. Mandeep, great to have you here on the program. So NVIDIA makes sense. Supermicro, I mean, didn't they have trouble finding an auditor?
Well, I mean, that's, I guess, past right now, given how much things have changed.
That was months ago, right?
Well, and look, I think more than Supermicro, this means a lot for NVIDIA, just because, you know, there was concrete announcement around sovereign buyers emerging for NVIDIA's chips. And so far, the biggest concern was NVIDIA is exposed to the hyperscalers. They kind of control 45% of NVIDIA's revenue. In this case, now you've got sovereign buyers who are talking about multi-year purchases, and actually they announced an 18,000 GPU purchase, which amounts to close to $1 billion in revenue. So we were all concerned about how NVIDIA and AMD are losing China revenue. Well, now we have an offset here in the form of two countries, Saudi and UAE, and it trickles down to a Supermicro, but it's not very clear, you know, what sort of margin impact it will have on Supermicro. So more, I would say, of a positive for NVIDIA than it is for Supermicro.
Yeah, and my one comment on this, too, is in addition to the benefit for AI, there could be very significant implications for energy costs. And I think that's probably not really understood yet what that could mean. I also want to talk about Apple here, because there's a different story to be talked about when it comes to the challenges that it's facing. We are now hearing that Han Hai, which is a partner for Apple, is tempering its full-year sales outlook. How do you read through to the impacts?
Well, so in the case of Apple, I think the smartphone refresh cycle we know has been protracted. It really hasn't played out, even though there is a pull forward component that everyone expects because of tariffs, and that should drive the 1Q. But in terms of the, the data center trend, that has helped NVIDIA and all the players on the server side. You don't see the same in terms of smartphone as an end market. So with Apple, until and unless you have more clarity on how much Apple Intelligence is going to improve over the next few months, it's hard to kind of pinpoint a big refresh cycle scenario right now.
Yeah, and in the meantime, Apple down about 0.4% pre-market. Mandeep, we thank you so very much for your time. That is Mandeep Singh of Bloomberg Intelligence. Now, the U.S. is changing its policy, as we've been seeing, and they have been forcing strategists to change their forecast multiple times this year. Now, some of that includes Ed Yardeni and David Kostin of Goldman Sachs. They have recently raised their year-end targets after cutting them earlier in the year. Joining us now, Bloomberg's equities reporter Alex Semenova. And it's interesting, you talk to investors and they say, we want to buy, but we're nervous about it too. Is it same for the strategists?
Yeah, pretty much. Basically, you can't fight the momentum of this market once it goes back to the upside. It's been pretty incredible. Last month, actually, strategists cut their year-end forecasts at the fastest pace since the pandemic, and now they're going back to their bullish ways. They entered 2025 pretty optimistic until we got tariff announcements, cut their forecast pretty quickly, and now that we've gotten, a pause on tariffs, they're saying that the risk of a recession is lower. They're expecting that AI will regain momentum after positive earnings. You have Goldman Sachs actually upwardly revising its forecast twice since last Friday. David Kostin there first, moving it up to 5,900 by the end of the year, and then 6,100 after the trade deal with China. And then also Ed Yardeni, I just caught up with him yesterday. He said that he usually sticks with his forecast through the year, and it's been really unusual to have to revise it so often. He said that he told his clients that he reserves the right to revise his forecast as often as the president changes his mind.
Yeah, I thought it was a great quote there in the lead of your story. What are we now expecting? When you look across the sea of forecasts that you survey, what's the outlook for this minute in terms of stock market performance?
Yeah, so on average, most people are still expecting a modest gain. The really interesting thing, though, is a lot of strategists are highlighting the fact that the fundamentals here haven't really changed. Over at Barclays, Alex Altman there, he's the head of equities tactical strategist, said that he doesn't feel quite comfortable with stocks making all-time highs when some of the same issues that we've been facing are still here, when the 30-year U.S. Treasury is within a whisker of 5%, when the universal tariff rate right now is 14%, but you really can't fight the momentum, especially at Goldman Sachs. They say that U.S. equity positioning is still low, and that's kind of the case for more upside.
Yeah, we're not all too far from those all-time highs. You saw it in that chart over here.
Something like 3%.
Well, you're focused on the 2-year.
Yeah.
The 2-year yield, which is just over 4, right?
And the 10-year has been around 4.5%. And listen, if the bond market is telling you there's trouble, my question is, how long could the equity market shake off that concern for?
All right, I guess we'll have to have Alex back on and ask her that question again. Alex Semenova, thanks so much for joining us from the Bloomberg Cross Assets desk. A check now on futures right now. We're looking at gains on the S&P 500, or at least we were 10 minutes ago. Let's bring up the chart and see here. Up 0.2%, almost 0.2 and more on the NASDAQ 100. And then the small caps, even though you had a call out from, what was it, Citi and JP Morgan saying buy what's done poorly previously, the small caps, the Russell 2000 at least, down. Coming up, President Trump wants the price of oil to come down between $40 and $50 a barrel. That's according to Goldman Sachs. More on that next. This is Open Interest.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China. In 2023, it's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Let's get to high interest now. Look at what's making headlines around the world. President Trump said the U.S. would explore normalizing relations with Syria after the toppling of its longtime autocrat Bashar al-Assad. Trump is also pledging to lift sanctions against the country's new government. He met with Syria's new president, Ahmed al-Shara, during his Mideast trip. The decision to lift sanctions and normalize relations may spark fresh tensions, though, with Israel, which has issued warnings about the new Syrian government. And United Health Group is giving Stephen Hemsley a one-time $60 million equity award on top of his $1 million base salary as he begins his second round as CEO of the beleaguered insurer. Hemsley will also get additional personal security benefits following the December murder of United Health's top insurance executive. Yesterday, the company unexpectedly replaced CEO Andrew Whitty, who resigned reportedly for personal reasons. And House Republicans may land on a compromise on the state and local tax deduction today. The deal would represent a breakthrough in one of the thorniest policy debates in President Trump's economic package. The House Ways and Means Committee is debating a proposal that calls for increasing the put in place, remember it was unlimited for over 100 years, of $10,000 to $30,000 and phasing out that deduction for individuals who earn $200,000 or more. But several lawmakers have already rejected that plan, saying it doesn't do enough to reduce the tax burden for people living in their districts. Shonali?
We're going to turn now to the oil market because crude is down about 1% in today's session. But Goldman Sachs has shared an in-house analysis of President Trump's social media posts. And they've determined that he seems to favor U.S. oil prices between $40 and $50. And for more, we're going to bring in Bloomberg Deputy Editor for U.S. American Oil Markets, Devika Krishna Kumar. $40 to $50 oil based on social media posts. How different of a fundamental analysis is this than what you're used to?
It's quite remarkable, especially if you think about how Goldman arrived at this conclusion. They analyzed about 900 posts, which is quite incredible when you think about a president tweeting about oil prices or posting on social. The floor and the ceiling, so to speak, of oil prices has become the entirety of the oil market's focus at this point because prices have been trapped in a range for a long time, and where those levels are going forward is going to be critical to determining how people put on positions and how they can manage risk.
I would ask if this is good for his standing in places like Texas, where he has a lot of support, but clearly the president wants to bring down the price for consumers. It doesn't help those who are producing oil here in the U.S.
That's right. It's been a tricky thing to navigate for politically. Of course, right from the start, the president has said we want to lower prices for consumers, we want to bring down inflation, and this has been a key reason for them to advocate for lower prices. But having said that, the energy industry is also a big proponent of his political moves, and so how he's going to please both sides is going to be interesting to watch, because a lot of shale companies during earnings this quarter have already started talking about, well, at these prices, we don't really know how sustainable production volume is going to be. Maybe if prices stay at 50, maybe even go lower, things will start to slow down quite significantly in the oil field, and that's not going to be good news for.
Well, you're not going to drill, baby, drill if you can't make any money on the product, right? And their break even is what, 50, 55?
It varies. Again, it depends on well quality and like geology and a lot of different things. But yeah, on the whole, it's not going to be wildly profitable for them to keep drilling into a market where, bear in mind, demand is also looking pretty shaky if you think about tariffs and the impact on buying from Asia in particular. So there's a lot of moving parts at the moment, especially when you think about OPEC Plus bringing back barrels. So the global market is starting to look rather oversupplied going into the second half.
And to make your point here for a moment, pulling up the S&P 500 sectors, you're seeing energy not being the worst performer. That would be consumer discretionary, but it's kind of been splat dab in the middle. It is flat on the year. It did not see that Trump bump that you might have expected on the heels of the election. Now, when you think about the supply-demand dynamics of the oil market right now, what is going to be the biggest driver of that pricing that is not a Trump social media post?
It's probably going to be what OPEC Plus does. You know, this was quite a big move from the producer group. Back-to-back months of increases of over 400,000 barrels a day. That's a significant amount of volume that's coming back to the market, and very quickly at that. So whether those volumes continue to come and how quickly they come, especially given what's going on with trade talks between the US and China, I think those are the two big factors that the market is watching. If I had to say one more, it would probably be what happens with Iran, whether they achieve a nuclear deal. You saw yesterday President Trump talking in the Middle East and saying once again that we will not hesitate to put maximum pressure on Iran if we don't achieve a deal. So that's a big variable for the market as well.
All right. Excellent reporting. Devika, thanks so much for joining us. Devika Krishna Kumar there covers oil for us on the BN side. A check on futures right now ahead of the opening bell. You can see we're looking at gains on the S&P futures of more than 0.2%. And remember that we closed out the day yesterday in the positive, up about 0.75%, and 3.25% was the gain on Monday. So we're really on a roll here. We wiped out the losses for the year, and we're back up to just under, on the cash trade, 5,900. Coming up, Morgan Stanley's Michelle Weaver is on the program. We'll tell you why she thinks 6,100 may be now in play for the S&P 500. This is Open Interest.
Names at the Fed are on Bloomberg.
I'm not going to overreact to any increase in inflation that I think is attributable to the tariffs. But if I see a significant drop in the labor market, then I'd be ready to go. I wouldn't be sitting here waiting to determine whether the inflation is transitory or not. It's time to worry about the real side of the economy. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Nobody covers the Fed like Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Two of Wall Street's major trading desks are making the same bold call as U.S. stocks tensions ease on the pressure on them. We're going to look into the biggest losers for the quick short-term profits. Citi and JP Morgan, they are bullish over the next few weeks on small caps, technology, hardware, and home builders, all of which have lagged the broader index. But will you buy? Joining us now, Michelle Weaver. She's Morgan Stanley U.S. thematic and equity strategist. You're seeing a proper jump back. You had Matt talking about how the S&P 500 now finally positive on the year. Same goes for the NASDAQ 100, but not so much for the Russell 2000. It's still down almost 6% this year. Do you think that they could see some love? Would you get in given the continued potential pressures on the U.S. economy?
I think it's still too early for small caps. I think there's a lot of temptation to go into some of the lower quality names, the things that have been beaten up the most. But I still do think it is too early. Tariffs, the risk is going down. We're seeing, positive momentum there. But the tariff policy is far from final. And small caps have a lot fewer levers to pull when it comes to tariff mitigation strategies. So I think it is still too early there.
Don't forget that the Dow Jones Industrial Average, Shanali, is still down year to date.
Are you watching that?
These kids, Michelle, they don't care about the Dow. They're all looking at the Russell 2000.
We run way too fast and loose, us kids.
No, in all seriousness, I wonder where you look for the most upside, right? I mean, even if we get to 6,000, 6,100, that's not achieving a new high on the S&P 500. So are you looking in emerging markets? Are you looking at some private assets? Are you looking somewhere else besides just big cap U.S. stocks?
Yeah, so you mentioned 6,100. I just want to formally set out too. Our range now is 5,500 to 6,100. That's the trading range that we got pre-Liberation Day. Liberation Day was such a surprise, I think, for markets on the level of tariffs that we saw. You got through the range to the bottom side, but I still do think that 55, 6,100 is where we're going to be, especially into the summer when we get more formalized discussions on trade. But I think, not to sound like a broken record, but it's still high quality, it's still large cap. Those names have worked well, and that's really still where we see, and we want to be relatively safe from here.
Where can I get my 25% gain this year?
I think that maybe that's tougher to come by, my friend.
I mean, if we want to talk excitement, I mean, the AI names have been doing really well. I think within the AI story, what we're still really excited about is the AI adopters. We've seen, the people building out the AI infrastructure do well, the chips names, the power names, but what about what happens when we actually take this technology and put it into businesses? And that's a very idiosyncratic story. Unfortunately, you can't just buy, a sector like that. But I think that's where you're going to see a lot of excitement potentially back half of the year and into 2026.
Michelle, you're sticking with us. That is Michelle Weaver of Morgan Stanley. And it's interesting. Everyone's talking about the small caps, Matt. The Magnificent Seven is still down more than 5%.
We've been here before when everyone talks about the small caps. The Mag 7, I have been looking at NVIDIA because it is also still down for the year, but it's powered higher since Liberation Day.
Meta and Microsoft are the only two Mag 7 names that are up on the year.
That's fascinating. I wouldn't have thought that. And I mean, a lot of stocks came down after the tariffs and went up. NVIDIA just climbed higher and higher and higher. It's in basically like a post-Liberation Day bull market.
Yeah.
Almost.
Speaking of, as we head into the open, let's take a check on these markets too, because NVIDIA is powering the market higher. We had another day yesterday where that Trump trip in the Middle East had driven a lot of exuberance after the tariff talks. We are up on another day of gains despite the continued weakness in the bond market. Nobody's listening. People are buying, Matt.
Yeah, he wants to do deals, and that's definitely helping the stock market. S&P futures right now up 0.2%, would be a third day of gains for the S&P. The NASDAQ up 0.25%. This is Open Interest.
I fell in love with cricket. I started reading about cricket. You know, cricket is not a very simple game to follow. You need to understand it. And here I didn't know a simple thing like there are different kinds of bowling, like there is a spin bowling and there's a pace bowling, and in spin bowling there is a different kinds of off spin and a leg spin, and in pace there is a swing. And so it took me some time to just start talking to all these boys of cricket. I spoke to Sachin, who is known as a god of cricket, and I would ask him such embarrassing questions. But yeah, today it feels very good to see Mumbai Indians doing so well. My son is leading it. But also I think the Mumbai Indians women's team is something that fills my heart.
Why?
With joy. I think these girls go through so much to get to where they are. Right from seeking permission from their parents who are not willing to let them follow their dreams. Financial issues. When you see them all coming together from these remotest villages of India and play for you and tell you these stories, it's just so inspirational to see our girls in sport.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Alex Steele in Houston, Texas, and this is Bloomberg.
Moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. You're looking at gains, slight, but still green arrows on the S&P 500. We could push above 5,900 on the cash trade today. We're there in futures. NASDAQ futures up 0.2%. Small caps down about 0.3%. Even though Citi and JP Morgan say buy these, it's a short-term tactical trade, but they've been hit too hard. You hear the opening bell on the New York Stock Exchange, and this one touches close to home. I have no relationship to Horace Mann, which is an insurance company. However, the educator was the first president of my alma mater, Antioch College, and he said, "Be ashamed to die until you've won some victory for humanity," a quote I will never forget. On the NASDAQ, Hashdex, some kind of crypto ETF, doesn't matter. Shanali, what are you watching in terms of the stock movers, the big heavyweights right at the top?
I don't know that humanity is being saved today, but at least the AI industry is. You have NVIDIA on the rise about 2.3%. Other chip makers also higher. The U.S. has cleared a path for Saudi Arabia and the UAE to pursue AI ambitions. NVIDIA, AMD, they're already planning to spend billions of dollars in the region. Take a look at AMD. It's up almost 6%. Supermicro, this is an anomaly, of course, up more than 17%. But, of course, they had a rougher year last year, Matt.
Yeah, lost an auditor, had trouble finding a new one, kicked out of an index. Now they're back. However, let's talk about CoreWeave. Higher ahead of its latest quarterly results. Investors are going to be looking for any insights into demand for artificial intelligence infrastructure. Clearly it's there, but how much? And what I think is interesting is this is a recent IPO, Shanali, as you know, and they've done very well. They're up like 40, 50, 60% since they IPO'd, and that was just at the end of March. So CoreWeave trading at $66 and change. Still with us is Michelle Weaver of Morgan Stanley. And Michelle, what's your take on the animal spirits? I mean, are we going to see IPOs coming back in the market? We're already seeing a few. Are we going to see M&A deals get done? Is this the right environment? You talk about the back half of the year. Are we going to see deregulation that's really going to make us excited about markets again?
So I think there's a few different components to the animal spirit. So we have kind of the corporate side that feeds more into the M&A story. That will get a lot more excitement if we do see deregulation. I think it's still a little bit early. I think we're probably past peak uncertainty now, and that would be represented represented by Liberation Day. I do think, though, we can see a little bit more confidence within corporate decision making, but consumers are another important part of the animal spirits sentiment type story, and the consumer is still in a really precarious place. We run a proprietary consumer survey, and 42% of consumers said they're planning to cut back in response to tariffs. That figure was about 35% pre-Liberation Day. So people are very aware of what's going on and are very aware that companies may be raising prices to offset some of this. So I think, you know, corporate confidence, corporate sentiment, that should be in a better picture now, but the consumer is still a place to watch.
And corporate was pretty rough. One of the most fascinating things I've heard in the last few days was in your interview with Ken Griffin. Shonali flew down and spoke to him on Monday. He said this administration already has been a champion of deregulation because they haven't put on any new regulations, right? And so we're, what, 5 months into the year, and they just completely stopped that. And for him, it made a big difference. It stuck with me.
Yeah, it stuck with me too, because it's already a win, right? And you have the Treasury Secretary telling the surveillance team this week, third quarter or fourth quarter is when you really start to see it. So to the extent that you could add that into pricing for the market, what does it look like?
So I think policy sequencing has been something that's really interesting to compare under the second Trump administration versus under the first Trump administration. So under the first administration, you got the dereg first, you got the tax cuts first, and you didn't see tariffs until a couple years into the administration. This time we're seeing basically the exact opposite. We've seen some of the more growth negative, the more challenging parts with the tariff policy up front. But we are still really constructive that you could see more dereg, more tax cuts in the back half of the year. And that's why our price target for year end is still 6,500. So first half of the year, still a little choppy. Back half, we could.
6,500. Nice.
You'll take it.
You'll take it.
Not a 25% jump.
No, but
higher,
good.
nonetheless.
Positive.
But there are still factors that people are worried about. We have Walmart reporting tomorrow. This is going to be a big barometer of the U.S. consumer, albeit you could argue now somewhat wealthier consumers more and more, those people over $100,000 in income.
Stepping down.
Yeah,
trading down, I think is the term.
Trading down. So what do you make of what they might say tomorrow? How much can that change the game?
Yes, so about the top 40% by income spend around 80% of the total. So that group is something that's really important to watch for the broader health of consumer companies. I would say, you know, consumer spending is not about to go off a cliff here by any means, but people are becoming more selective with where you're allocating your dollars. More discretionary parts of the market, you could see more weakness in there. In that survey I just referenced, people were planning on cutting back from dining out, from travel, from apparel spending, but for the more core goods, staples type retailers, they should fare a little better.
We have hit 5,900. It's a big round number. It doesn't mean anything, but it still is kind of a milestone. Romaine was talking about this yesterday on the close. How much can this market be driven, or how much further can this market be driven by retail? Because retail investors held strong post-Liberation Day, right? As at the smart money was dumping its bets. Do they have any room left to run, or are they fully invested?
I think retail is still fully invested. I don't think they're going away from here by any means. They show that they were willing to hold fast, and they were not put off by some of the headlines. I don't know how much potential upside you could get driven by retail, but I do think it's still a mechanism of support.
You know, speaking of support, what were they buying? Because you heard all of these anecdotes about retail diving into Tesla. And on the year, Tesla is still underperforming all of the Mag 7 and much of the market. And you look at what's actually been performing, it's actually industrials, financials, utilities, those things that those big institutional buyers are used to buying for the sake of protection. Did the retail buyers buy the right things?
They were still into tech. They were still into some of those high-flying type names. I don't want to speculate on, you know, individually what names they were putting on, but I would say overall it's the support mechanism they provided for the index broadly that was really, really important for what they did.
You see more of the Mag 7 turn green. That's when I think you can call that a return of animal spirits.
Right, and I mean, it makes sense also that, you know, MAGA loves Mag 7. I'm sure they're big buyers of that. Let's take a look at Well, first of all, let's thank Michelle.
Thank you for having me.
Real pleasure having you here. I hope you come back soon. I'm going to take a look at the move screen on the Bloomberg terminal. This is a great way to look at a dynamic picture of what's happening in the S&P 500. You can see the biggest gainers on this side, and obviously NVIDIA is always going to be on top. As long as we organize by points, and if you want, you could click here and organize by percentage change, and then you see smaller companies right there. Thank you, Joe. Super Microcomputer, really dominating advanced micro devices, NVIDIA. It's all about tech today. You can see they're bunched up there. And on the low side here, Northrop Grumman is the biggest loser. Biotech, Cooper, Target. You're going to see some names that you're not familiar with now if we organize by change. Go back to points, Joe, and we'll see the biggest losers, who's subtracting the most from the S&P 500 index. Berkshire Hathaway, Apple, and Exxon. You also see on the move screen a great picture of breadth. You had 300, I think, and 33 stocks down and only about 160 gainers. Here, in terms of the sectors, industrials, as Shonali mentioned, financials, utility, consumer staples leading the way. So kind of a defensive gain today. On the downside, you have those consumer discretionary. Wait, this is year to date. Okay, year to date. I thought it looked very familiar. Consumer discretionary has done bad. In terms of the day, IT, again, all about tech, communication services, the hyperscalers, and healthcare leading the way up, a bounce back, a dead cat bounce, if you will, after United Health. And at the bottom, utilities, materials, real estate, and energy. Shonali?
A little bit of risk on. Now coming up, chip makers are rallying on the heels of President Trump's Saudi Arabia visit. We're going to power up on the conversation around semiconductors next. This is Bloomberg Open Interest.
The top names in business are on Bloomberg.
The real direction of attention is around trade, tariffs, taxes, and deregulation. If a lot of this can get resolved more quickly, then the slowdown can be much shallower. The longer it goes on, the more risk.
Volatility is going to be here for some time. It's whether the volatility is accompanied by whiplash behavior.
It's difficult to land on a transaction and present it to the market in a period of maximum uncertainty.
We have some of the best companies. They can do hard things, but they need to know what the parameters are in which they're working. Investors are looking at how do I reposition geographically some of my assets and take advantage of other countries in the world that are ripe for more growth.
I see us moving from what was hyper-exceptionalism to merely exceptional. I don't think there are good alternatives to the U.S. today.
There's not a plausible scenario where the U.S. still won't be a very attractive place for capital.
Nobody covers business like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
In case you missed it, on the opening trade.
How big a headwind is that going to be to my performance over the next 6 months, next 12 months? That dollar story, that dollar factor, that FX overlay.
Yeah, I don't think you can overstate the importance of this dollar shift. As we start to see a convergence of relative economic and profit growth rates, you are starting to see some of that overvaluation unwind, and it's shifting portfolio flows as well.
Don't miss the opening trade live every weekday.
This is Bloomberg Open Interest, and we're going to take a check on stocks because it's also looking at Green Day on the screen. It's 2%, 0.2% higher on the S&P 500, 0.4% higher on the NASDAQ 100. That Russell 2000 still 0.2% lower and not getting the love that Citi and JP Morgan have been looking for. But it's time now for our top calls. We're looking at some of the analyst action in focus this morning. And first up, we're looking at Cboe Global Markets, getting a double downgrade to a sell at Morgan Stanley. Analysts say that the de-escalation of the trade war between China and the U.S. has come sooner and better than expected, but this would limit the upside for options volumes on Cboe. You're seeing about a 1.8% decline on the morning. Next, Wayfair getting cut to a sell at Loop Capital. The downgrade is driven by tariff uncertainty. We've been talking about looking at those retailers, still up about 2% today, though. Next up, KKR getting raised to a buy at Morgan Stanley. The analyst says that it's a way to play the anticipated capital markets recovery. Fun fact, they made about $1 billion in that business last year. They're up about 1.5%. Finally, we're watching Rosenblatt Securities raising its price target on Coinbase to $300 a share. The crypto exchange will join the S&P 500 index next week. It'll be replacing Discover, and I'm going to be talking to the company's CEO, Brian Armstrong, today in an exclusive interview at 12:30 New York time, Matt.
All right, we're looking forward to that interview and that program. Shonali, let's talk right now, though, about chip makers rallying on the heels of President Trump's visit to Saudi Arabia. The president, as you probably know, has been striking deals left and right to give Saudi wider access to advanced AI chips. NVIDIA, AMD, and Supermicro already reached a deal worth $20 billion. And NVIDIA has officially surpassed Apple as the second largest company by market cap. Microsoft is in the #1 slot. Bloomberg Technology co-host Ed Ludlow, who follows all these big companies and the little ones for us from the West Coast, joins now. So, Ed, what do we know about these deals that lump in a little company like Supermicro along with a big behemoth like NVIDIA?
Yeah, I mean, the unlock is the ability for NVIDIA and AMD to sell their latest generation cutting-edge processor, GPU AI accelerator into that market, Saudi Arabia, right? The Commerce Department announced last night they would rescind the diffusion rule, which in simple terms was a technology export restriction. The reporting had been that were it due to go into effect on the 15th, tomorrow, the US would not have enforced it anyway. And now the question is, well, will we get a new rule and what will the parameters of that be? But you're really smart to flag Supermicro, because literally what we're talking about is the building of data centers in the Gulf. If you can send the GPUs, then a name like packages them into server racks, can then proceed with its deals to do that as well. So their deal with DataVault's really interesting. As you know, it's $20 billion. I would point out that that business is a much lower margin business than actually NVIDIA does, just by designing the chip. I think you also showed AMD. I would point out that the buoyancy of AMD is partly informed by a $6 billion additional share buyback they authorized this morning, which is on top of $4 billion they were already doing. So take that into account. But just look at the research on the sell side from BI. This is immediate sales growth that policy has unlocked for those two names in that region.
It's interesting, Ed, I don't know if you know the numbers to this. I realize this is very new news, but something that really struck me on the heels of these deals being cut or these talks advancing is the fact that this is being done in an energy super hub. Is there a chance here to really accelerate AI computing power through the Middle East, given that costs could actually be a lot lower?
Well, in short, yes. Building data centers requires several things: capital, space, time, and the correct political and regulatory environment. And most who follow the market would agree that Saudi and the UAE are places that conform to those specifics. So take the deal, for example, between NVIDIA and Humane. The first phase is 18,000 GPUs. We measure the size of a data center in megawatts, literally in energy demand. That first phase is a 500 megawatt data center. Technically, that's at the hyperscale level, what we call hyperscale. But if you compare those to data centers around the United States, those range from 5,000 to 11,000 megawatts. So it's small by comparison, but Saudi and the UAE have the tools to get it done. And that's why, again, you see from Bank of America or Bloomberg Intelligence this multi-billion-dollar sales opportunity each year for the chip makers, because they'll move fast in moving the product to those nations and start building.
Ed, You know, there's a lot of talk about the Qataris giving President Trump an old used airplane.
I heard you talking to Anne-Marie about this. Yeah, go ahead.
And the security concerns there. But what about giving the Saudis, who have such a close relationship with China, these chips that are capable of beating the Whopper in global thermonuclear war? I mean, isn't there a security concern with sharing this kind of high-level tech?
There is security concern. And the whole point of the Commerce Department and the Trump administration reviewing the diffusion rule was the concern that if they allowed those nations in the Gulf access to the technology, those nations have a close relationship with China. They could act almost like a sales channel or third-party funnel. So what we do have is corporate deals. NVIDIA has a deal, Cisco has a deal, AMD has a deal, Supermicro has a deal. We do not have bilateral agreements between the United States and Saudi and the UAE. Those are expected, nation to nation, to come in the coming days. And how they address the China question is absolutely top of mind for everyone. But again, go back to the Bloomberg intelligence deck on what this means for sales growth of NVIDIA and AMD in particular. It helps them offset the revenue to China. So you'd think that those companies would play ball, be more conducive. And then the next question is, if they rescinded the diffusion rule last night and it won't go into effect tomorrow, what does the new rule look like? Does it explicitly codify restrictions on third parties passing the technology to China? You're absolutely right that that is the key question from here on in.
Ed, we thank you so much for your time. That is Bloomberg Technology's Ed Ludlow, and I've got to say, we're going to want to have him back just to talk about the Musk effect and his visit to the Middle East. We'll keep that in mind for a future segment.
We can tune into his program in 1 hour and 12 minutes.
Absolutely. But for now, we're looking at stocks because we are actually now wavering. We are negative on the S&P 500, but pretty much flat on the morning. We are looking at a reversal. Remember, we started the day in the green. Gains are very lightly being held in the NASDAQ 100, but also starting to turn around. Those Russell 1000 or 2000 stocks now at session lows or near session lows, almost 0.5% lower. We're going to keep an eye on it all. Stick with us. This is Bloomberg Open Interest.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back to the circuit. This time, we're taking you to the frontier.
Where is
do we have a camera, or do we don't want to lose you, Emily, in all of this.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks today. We're looking at a loss now on the S&P 500. We've had a couple of pretty bang-up days, up 3% and change on Monday, up 0.75% yesterday to almost 5,900. But we bounce up against that level and come back down today. The NASDAQ 100 still holding on to gains, about 0.2%. Take a look at some of the movers here. CoreWeave is one we have been talking about and we'll continue to discuss. Plus, it's up like 50% since its IPO. So, and that was just in late March. We're going to talk more about IPOs. American Eagle Outfitters pulling its forecast. Another company to say the macroeconomic uncertainty doesn't allow it to look at the future, and it's already lost half of its value year to date. NVIDIA is holding the S&P unchanged right now, gaining 2.5% on those deals. NVIDIA and Supermicro both really helping to hold us back from bigger losses after those deals out of Saudi Arabia. And you can see Aurora Innovation and SIBO Global Markets both down right now. Shanali, what are you looking at?
Yeah, we're looking at the progress in trade talks because that and economic resilience so far have fueled a market rally, and it pushed stocks back into positive territory for the year. But the optimism may now also be turning into fears of vulnerability. You're seeing it in that wavering market today. Joining us now for more, Bloomberg Equities reporter JP Barnard. We've been asking, right? This has been a temporary pause when it comes to what you're seeing, or temporary de-escalation with China. A lot of exuberance around the Middle East, but to the extent that investors are not diving in fully, what's keeping them from it?
Well, I guess like it's still uncertainty and an unclear path of the economy, and I guess like everybody agrees that we are not going back to the world that we had before the tariff story played out. So there will be some tariffs being in place, even if they find like some common ground that they can agree on. They will not be as high as at the height of the drawdown, but there will be some tariffs, and this will have implications for global growth, for corporate earnings, and probably like for a long-term thinking about like supply chains and how you maneuver your goods around the globe, and especially also for like international relationships. So this is all stuff that people don't know about it yet, and we see it like in so many corporate earnings that they are saying like guidance can't say much about it because we simply don't know, and that's the same with investors. And if you haven't been like part of the rally from the bottom because you felt like it's worth going in there, then right now you face a very unattractive risk-reward profile, coupled with uncertainty, coupled with headline risk, and that's just something you don't want to really like own here.
Are we going to rally, though, JP, on a big, beautiful bill? I mean, if we get an extension of the 2017 TCJA and then more tax cuts, especially on the corporate side, is that a catalyst for this market?
That sounds like Trump, big and beautiful. That's what he likes. And I would say like it's certainly a possibility. The more good news you get, the more likely the market is to rally. And the thing is like people are still chasing this rally, so there's not enough exposure in portfolios right now to have like that alpha on that you need in a total blue sky scenario. So if we get that indeed, then I'm pretty sure markets can rally further. But for the time being, I guess it's going to be a little bit more choppy and a bit more wait and see, and a bit more depending on what the next headline is going to be.
Yes, I'm glad you brought up the big, beautiful bill, because the bond market is saying something else. You're seeing the 10-year actually up almost 2 basis points. We are closer and closer to that 4.5% level. JP, at what point does the stock market look to the bond market for a clue? Because if you can't rely on the sweetener of too many more rate cuts, if you can't rely on the 10-year staying stable, then isn't that telling you something about the direction of travel?
Well, I mean, I guess the stock market is looking already, but that's the funny thing about the stock market, which it does quite often and not always in a sane way, that it actually looks at the stuff, or the people look at the stuff and they point it out and they raise an eyebrow or two, but then still prices still go up. And let's not forget, like right now, this is a very technical, very systematical driven rally. It's not exactly those people who look at the fundamentals and at the macro data that are in charge right now and that are leading the gains. So everything that is going basically around the stock market in terms of macro data, in terms of warnings from other assets. I mean, the dollar is another topic that you still need to keep an eye on. I wouldn't say is not being ignored, but it's just not like playing a big role in the price action that we are seeing. This comes next, I would say. And of course, if there remains a trend of like anti-American flows, then this is also going to be a problem for the stock market.
All right, getting closer and closer to the danger zone there on the 10-year. JP, thanks so much for joining us. JP Barnard out of Frankfurt. Coming up in the next hour, John Stoltzfus joins us, Oppenheimer Asset Management, as well as Caterina Simonetti of Morgan Stanley. This is Open Interest.
much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, it complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. And coming up, we're back in the green. Investors are awaiting fresh catalysts for the rally that erased the S&P 500's 2025 losses.
Chipmakers getting a boost today as President Trump's Middle East visit opens the floodgate of AI deals.
And we might get a major breakthrough. Matt, on Capitol Hill, House Republicans could reach a compromise today on state and local tax deductions.
Definitely a big deal for people who live here and people who oppose double taxation. Let's get a check on the markets right now. As Sonali said, we're back in the green, but just barely. I mean, the S&P 500 is unchanged right now at 58.88. It's got to be good luck in some cultures. The NASDAQ up about 0.2%, 21,236, the level there. And the U.S. 10-year getting nearer and nearer to the danger zone of 4.5%. And Sonali, the 20 and 30 years already at 5.
Absolutely incredible. That cost of financing, we got to keep an eye on it. But for now, we're going to go to the Middle East. For more on the president's trip, we are now joined by Bloomberg's Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Bloomberg Surveillance. We are looking at live pictures right now with Trump in Doha signing at a signing ceremony with the Emir. What are the details here about how that trip is going?
Well, the president has been spending the afternoon in Doha just off the heels of a huge trip in Riyadh where he talked about a number of investment deals as well as big shifts when it comes to geopolitics. Right now, it's another investment deal. He's signing this deal when it comes to Boeing. We scooped last week that Qatar was working on buying 100 wide-body jets from Boeing. I actually heard earlier this morning that number was going to be even higher, so we'll have to wait to see what the headline number comes out to be, but potentially north of 100 Boeing jets. This just reiterates what the president has been wanting to do on his trip to the Middle East and how he sees partners in the future. He sees economic partnerships, economic transactions as paramount for his administration. And he really sees the Middle East and the Gulf being the center of that, doubling down on what we saw in the first iteration of Trump when he was the 45th president, but really taking it to another level here as the 47th president. And you can just see that was on full display yesterday in Riyadh.
Anne-Marie, I hate to keep going back to this jet because it's kind of a silly story in some ways. A lot of people are also concerned about the legality and constitutionality of Qatar giving the president a plane. But to me, it doesn't make sense. If you're worried about how long it takes for Boeing to upfit a new jet, Why accept a 13-year-old used jet from Qatar?
Well, the president spoke about this old-time golfer who said, if you're given a free putt, why wouldn't you take it? That's how he views the world. He is being offered a temporary use of a jet that was used by the Qatari royal family that they're not using right now. And he says, this is in his own words, and he talked about this last night in a Fox News interview. He talks about the fact that the United States has provided defense for places like Qatar and Saudi Arabia in the region, and has been a huge help for a number of economies around the world. Why wouldn't they accept a gift? That is the president's thinking. What I have heard so far about this Air Force One jet, and potentially we're going to get this announcement of this temporary basis, is the fact of the matter is the DOD, it would be temporary borrowing from the Pentagon. There's a number of legal issues that are still at play. There's a number of lawmakers that are concerned about what this means in terms of the Constitution, whether it's appropriate or even legally to accept such a gift of this high price value. And then, of course, there is this security concern that even though Qatar is a place where we do have American military troops, men and women stationed here, still a fact it would be a foreign country supplying a jet to carry around the most important person in the United States or in the world, and there is that national security concern. So there's a lot of issues at play here when it comes to this jet. I say there's a fuss for some people, consternation for others. We're going to have to wait to see where this really hashes out, I think, first and foremost on the legal basis.
Right, and we should say also, as we speak right now, you have the U.S. and Qatar signing a letter of acceptance for the aircraft, as well as a statement of intent, defense agreements, as you've been talking about. Now, Enrine, going back to the golf analogy for a moment here, because you could argue here that the reason you wouldn't take the free putt is for the integrity of the game.
It was
right?
Sam Snead, by the way, is the old-time golfer. Sam Snead.
Okay, but that's the reason you wouldn't take the free putt. And so on this one, what do you think is going to be the bigger question moving forward? Is it going to be, well, let it go because the defense arrangements between the United States and Qatar are deepening, and this is it's symbolic as much as anything else? Or is it going to be a bigger ethical question moving forward from lawmakers as we head into the midterms?
Well, I think we need to wait. I mean, lawmakers already are talking about that he shouldn't be accepting this for a number of reasons. They have issues with Qatar. You know, you have to remember this is a place where this is a government that has had dealings with the likes of Hamas when it comes to financing. Also, Hamas has a political office here in Doha.
And
so there's a lot of
sorry to cut you off here. We want to break into the president right now for our audience.
It's going to work out. I think it's going to work. It's got to work out one way or the other. We know it's going to work out. But you were of great help, and other things, but in particular trade. The trade is Kelly's telling me from Boeing, it's the largest order of jets in the history of Boeing. That's pretty good. And that's 140, was that a 140 or 160? Well, yeah, but you're right, it's actually 200, including the 40, so it's over $200 billion. But 160 in terms of the jets, that's fantastic. So that's a record, Kelly, and congratulations to Boeing. Get those planes out there, get them out there. But I just want to thank you. We've been friends for a long time, long before politics. Well, for you it was politics, for me it wasn't, right? But we've been friends for a long time, and this is an outstanding man. He's a great man, and we're going to help each other. The United States is in a very strong position militarily. We have the best equipment anywhere in the world. You're buying a lot of that equipment, actually, and I think we're going to see some of it in action tomorrow at the, we won't call it an air fair, but it's going to be sort of an air fair. We're going to be shown a display that's going to be incredible. They have the latest and the greatest of our planes and just about everything else. So I think it's going to be a lot of fun and very interesting. But I just want to thank you for the friendship, for the long-time friendship. And again, long before any of this stuff, we just liked each other. That's not a bad thing. That's a good thing. But we always had a very special relationship. And we came from Saudi Arabia, where we have another great man over there that's a friend of yours. And you two guys get along so well and like each other. You sort of remind me a little bit of each other, if you want to know the truth. They're both tall, handsome guys that happen to be very smart. But he's also a very special guy, and it's good to see all the relationships forming in the Middle East, because the Middle East is really being talked about all over the world, and we're having a lot to do with it. We're helping a lot, but they're doing a tremendous job. So I just want to thank everybody very much for being here. I want to thank the media. The media has been very fair, actually, and it's a great honor to be with you. This is, you take a look at this room. This room is the real deal. That's called white marble. It's very hard to buy. Believe me, I know very well, because you try to buy it, you can't buy it. And you just take a look at what you have here. It's been incredible what you've been able to build as a nation. And we're with you all the way, and you know that.
Thank you. The ceremony has now come to an end.
Now, to recap some of the headlines from that presser with the president, he says that the Boeing order is the largest in history. The total order is over $200 billion. And he also says he discussed Iran with Qatar. He discussed Russia and Ukraine with Qatar. We're going to bring back in now Anne-Marie Hordern to recap a little bit of what's going on under the surface here throughout this trip in the Middle East. What did you make of the more open conversation that the president has been sharing, particularly as it pertains to Qatar?
Well, I think the president is just really outlining how he sees the region. One, it's a place to do deals like this massive Boeing deal that we have been highlighting for over a week at Bloomberg, and $200 billion. That does sound like that is more than 100 wide-body jets. The second, I would say, is that he sees the region as a place to mediate global conflicts. He said he spoke to the emir about Iran. The president earlier today was also speaking about Iran. He went even further to say that Iran cannot just have a nuclear weapon, but also that they need to cut off financing to terrorist organizations in the region like Hamas, Lebanese Hezbollah, and the Houthis. On top of that, he said they discussed Russia and Ukraine. And the Gulf, of course, has been a place that has been trying to mediate this conflict. Russia does not view Europe, does not view even Switzerland as fair negotiators to try to mediate this conflict. So they have been relying on the region, more specifically on Saudi Arabia. And we should note that the president did say on Air Force One on his way over from Riyadh to Doha that he has a full day tomorrow, fully stacked when it comes to going to the United Arab Emirates. But he did say if Putin were to go to Istanbul and he could save lives and go meet him, he would. So the president kept that window open of potentially peeling off on this trip or adding another stop to this trip to bring him to Istanbul. But all of these conversations are happening in the Gulf. And I think that is really pivotal right now for Trump 2.0, if you want to understand where he sees the place for economic relationships and also mediators for big geopolitical conflicts. It's here in the region. It's a big paradigm shift of the post-war order.
Anne-Marie, we thank you for all of your reporting. That is Anne-Marie Hordern, our chief political correspondent, reporting from Doha, and looking forward to the rest of your trip in the Middle East. Now, Citadel's Ken Griffin had sat down with me for my upcoming Bloomberg Original series, Bullish, an upcoming episode. I had to ask him the best way to navigate the shifting policies out of Washington.
I think in retrospect, perhaps holding cash would have been the best way to navigate this, but that's so contrary to our culture of always trying to be on the offense, always trying to find ways to create value in the markets.
Joining us now is John Stoltzfus, Oppenheimer Asset Management Chief Investment Strategist. The well-known optimist tempered his outlook for the S&P 500 during April's turbulence, but we're bringing him back to ask, is it back, John? I mean, after, I guess, Scott Bessent and Jameson Greer proved to us that the White House is listening with this Swiss meeting and a turnaround on Chinese tariffs. Can we get back to real animal spirits in this market?
Well, I don't know so much animal spirits, Matt, but I'd have to think that where we are is a reconsideration that maybe things aren't as bad as they are, and that there are people who are listening within.
Oh, it looks like we have a. Do we have a mic problem? You know what?
We have a mic problem?
It looks like your mic may have slipped out here.
Oh,
I'll go ahead and, you know what? Let's figure out the mic problem.
Yeah, let's figure out the mic problem.
And then we'll get back to John.
We should take a check on these markets while we wait for that, because of course we are seeing a reversal on the day. We started higher, we are now lower. We're not showing this now, but actually if you see the dollar as well, we are wiping out a lot of the gains from earlier this week. So the animal spirits are actually not really around right now, right?
Well, I mean, we're back to 5,900 pretty much. We bounced up against that level, and we're well above now the April 2nd levels, right? And I think there are a lot of investors, a lot of retail investors who were terrified after they watched that press conference in the Rose Garden, but didn't sell stocks, right? We saw a huge downdraft on that following Thursday, on the Friday, then called in the traders Sunday night, and then Monday was a disaster as well. And so now we've gotten back to a level where we've completely recovered and then some. And I wonder, John, you got your mic back on. That's fantastic.
Thank goodness.
I wonder if you don't get some investors who missed out on that opportunity to exit from this market under this administration who are going to do it now.
I don't think so. I think, if anything, I think the idea is now we're beginning to see that there are ears and eyes that are watching the entire economy, that we do still have very much a art of the deal and shock and awe approach, but mixed with Scott Bessent's approach. And with that, we think it's good for the markets. We think overall, we think we're not out of the woods yet on this thing in terms of the tariffs. The 90-day clock is ticking away. But there appears to be some degree of progress that is enough to get the market to relax a bit and recognize the fact that we've seen good earnings for the S&P 500 and revenue growth, that we're seeing a consumer that's stronger. We're seeing essentially it's stronger than expected, okay, even as things slow somewhat, and a Fed that still is on target to doing what it needs to do and independent. So it looks to me like my target might have to be raised in the next few weeks if this keeps up. Going back, I don't know where we'll exactly
Hang on, what does the Fed need to do? I mean, we saw a really tame inflation print for now, but we've heard some people concerned that inflation could go back up to 3-4% by year end. Do you think the Fed needs to cut here?
I don't think the Fed needs to cut. If anything, I think the Fed needs to stay on target the way it has been now since March of 22, highly sensitive to its dual mandate, which is effectively keeping the economy growing at a pace that doesn't move into a recession, and most recently, since last year, giving real consideration to avoiding unemployment taking a sharp jump. And I think with that, if you can honor the dual mandate here, the recognition should be, we think, because as you know, I'm nearly 100 years old, so I lived through the 70s when inflation was high, and I was starting my career way back then in a different industry at that time. I'm 41 years, almost 42 years in this business now. But it takes a while for inflation to leave because there are several processes in this that we've noted. Is that usually when inflation first hits, the producers who get hit with that input cost increase first pause. They don't pass it on to their customers right away until it's generally accepted there is inflation. Then they all raise. The consumer keeps buying, but the process of reversing that requires competition to come back, and it's still, competition is slow to come back in many industries, but we think it's around the corner.
You know, a few things happening in the market right now. You actually have an IPO today. You have eToro that not only priced higher than expected, the IPO is indicated to open at $59.50. The IPO is at $52. The wild thing about that is that even in a kind of flattish market, you're seeing excitement for a new stock.
Yeah.
And for so long, we lived in a market where people bought the index and they sat back for a while. Is this going to be a buyer's market once again? Are people getting more surgical, and will they remain so for as long as we can
We think very much it's not a market that favors not listening to what the opportunity is in terms of individual securities. So it's alpha, but with some beta remaining, because you have to consider, people always asked us, what are you telling clients? As long ago as in February, where the market really started to come down, and we said, look for the babies that get thrown out with the bathwater. Don't blindly buy the dips. but look for the quality stocks that get sold off in a downdraft. And our favorites continue to be cyclicals over defensives. We like tech, communication services, consumer discretionary, financials, and industrials, which we think are just getting recognized. In fact, if you look at industrials and consider where it is right now, on one measure, it's the best performing sector. If you go back to the peak and see where we've come, it's actually slightly up versus the others still.
What are the kind of, I mean, when you say tech and communication services, I know what you're talking about. When you say consumer discretionary and even industrials, what are the kinds of companies that you're talking about, you're thinking about?
Particularly within consumer discretionary, just consider that people are still shopping. So the U.S., you know, I always say with the U.S. consumer, when times are good, spends like a sailor who's been on a long tour of duty who suddenly has shore leave. But when times are tough, people keep shopping in this country. They shop at discount, they shop private label, they buy used cars, they buy used clothes, vintage clothes, what have you, but they keep shopping.
Used wide-body jets?
Well, you know, that may show at a very high level it's taking advantage of a gift horse, you know, without looking in the mouth, so to speak, you know, of the horse. And so the consideration here really is that we think communication services, of course, because it's the search engines, it's the social media, and it's the streamers. But when it comes to industrials, my gosh, that's everything that to build these factories in technology and in healthcare and build them faster, you're going to need robotics, you're going to need power generation, both of alternative energy as well as traditional energy. There's real excitement here yet the industrial sector has yet to be rewarded the way we believe it should, because it's a combination of technology that is infused. If you can just consider agricultural equipment, get into a tractor, it's like a computer room today when you're in the cab of a tractor.
John, it has been so nice to talk to you. Come back to us, especially if you raise that S&P 500 target. And, you know, he's been right. You do see industrials really leading the S&P 500 on the year. Companies like Boeing up more than 17%, GE up more than 33%. That was John Stoltzfus of Oppenheimer.
I'm looking for a jump in this market because I see a couple big headlines crossing the terminal that should be favorable to stocks. China has suspended its export controls over 28 U.S. entities, and China has scrapped its unreliable list policies on some U.S. companies. So it looks like China is, you know, extending that olive branch even further, and that should be good for stocks.
But it shows you that the market is no longer reacting to the marginal headline. They only want the big ones. Now, up next, we're going to look at that IPO revival. We were talking about it. We just saw eToro indicated to open at an IPO pop. It's due to start trading today. We're going to talk more about that next in the Wall Street Beat. This is Bloomberg Open Interest.
up-to-the-minute news,
technology news, geopolitical news,
economic news,
financial news,
bringing you the latest news in private markets whenever, and wherever it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
In case you missed it, on the Pulse.
I see more and more European suppliers that are becoming aware of the need to increase the pace and to offer something unique. So if, let's say, 2-3 quarters ago, I was them more in a wait and see, now I see more reactive. We have some Chinese suppliers, yes. Are they making strategic component? Not. I think that there is nothing more than that.
Don't miss the Pulse, live every weekday.
Global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
It's time now for the Wall Street Beat. There's an IPO revival, sort of, underway. Just to go to the news, that online broker eToro shares are indicated to open at $59.50 from its IPO price of $52. Also, remember, Ryan Reynolds' Mountain is considering launching an IPO as soon as this week, while Cattle, a Chinese maker of EV batteries, is poised to raise at least $4 billion in Hong Kong. So it's a global revival. Let's discuss this with Bloomberg Stocks reporter Matthew Griffin. eToro, it's interesting. What a good time to IPO, because you look at a rival like Robinhood, it's up 68% on the year, but eToro is much smaller.
Yeah, I think it's one of the things that investors have on offer here is that eToro is a Robinhood rival. It's a new way to get exposure to the same kind of retail trading, crypto trading, real surge that we've seen. At the same time, they are smaller. They offer a pretty considerable discount to Robinhood. You look at what Bloomberg Intelligence has said. They trade at, or they're valued at about 5 times their sales. That's a significant discount to Robinhood, which is about well over 10 times on a forward basis.
It's a value stock in that way.
I get that. So is this a bet on the growth in kind of new finance? Crypto is a specialty of eToro, and kind of the changing of the guard here. Yesterday we saw Coinbase replacing Discover Financial in the S&P 500.
Yes, absolutely. I think it is, and eToro has gone public at what I would call just the perfect time. Right as they were on the road and preparing to go public, you had a surge in general equity markets, yes, but also a real rally in Bitcoin, in other cryptocurrencies, and in the stocks of Coinbase, Robinhood, companies that have exposure. You have that S&P addition. So I think eToro is set to ride that wave if it continues.
We have like a minute left here, Matt, but you look at CoreWeave, for an example. I want to pull it up year to date because you've been pointing out it's been doing so well. It reports earnings after market today. Private equity-backed company doing this well. Does it bode well for a broader IPO revival, given that it's those private equity companies that are stuck in the pipeline?
I think it does. I mean, it's hard to know where we go from here. I think the interesting thing is you've had companies go public. CoreWeave, since the big tariff swings, you've had eToro, you've had some insurers. These are, with eToro, with the insurers, these are companies whose revenue does not depend on selling physical goods, so not tariff dependent. But that could really help open up the market here. And with tariffs being cut now with the US and China, I think we're potentially in a good place for a broadening of this revival.
All right, we just saw the trade since it went public, 60%, the gain on CoreWeave. I've been trying to pin that down all day. Matt, great to have you on the program. Thanks so much for joining us. Matt Griffin there covering these IPOs for us in our Wall Street Beat. Let's get a check on the markets as we head to 10:30. Right now, the S&P 500 hovering in the positive, really unchanged at 58.90. Coming up, more than 1 million people a year are skipping connections. We'll talk about skip lagged.
Are you worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person not managing that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments, and so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Airlines are facing a lot of headwinds these days, from falling consumer confidence and higher costs to air traffic control issues that we're all too familiar with here in New York. Now the industry has another problem on the horizon. The upstart website Skiplagged. It's a controversial site that uncovers airfare hacks like skipping the last leg of a flight in order to get a cheaper price. It's counterintuitive, but it often works. Joining us now is Akhtar Zaman, Skiplagged CEO. Akhtar, great to have you in the studio on the program. So, talk to us first about this idea that I could fly, say, to Atlanta through Detroit and pay more than I would for just a flight to Atlanta. Why is that?
It has to do with how airlines price tickets. Yeah. You would think it's by distance, like the further you travel, the more fuel you're using. But no, it's based on market. Airlines price by the market, so like depending on which market you buy, it could actually be a different price. They often charge more for direct flights compared to longer flights. So you have this opportunity called hidden city.
Travelers have been feeling crunch. They've been feeling crunch for years, but obviously everyone wanted to go back and fly. But right now, obviously that extra mile is painful when it comes to the pocketbook. How much are you seeing adoption on the site right now?
Quite a bit. Usually when there's tough economic times, we see more usage. And that makes sense because we help consumers save a lot of money, on average 50% on their ticket, which is about $180.
So why do airlines care so much? Like if I book a Detroit-Atlanta flight and just stay in Detroit and skip the second leg of the tour, why do they care? Why bother?
They care because here is a very clear case of consumers winning. Skiplag is very pro-consumer, and that makes consumers love us, but it's the same reason why airlines hate us. Just people are saving money.
We are very in tune to the infrastructure issues when it comes to airports outside of New York City, what's happening with Newark.
Shanali's from New Jersey.
Oh my God. I mean, just flying back Monday, right? Whether it is staffing or whether it is weather, it is a nightmare to fly, let's be honest. And so if you're dealing with all these changes among airports when it comes to staffing levels, it actually kind of difficult for Skiplag a little bit in some ways, because flights have been changing so drastically within the matter of an hour, frankly.
Well, you would think so, but we've been in the business for over a decade. The success rate of skip lagging, which is just like missing flights to save money, is over 99.7%. So like it's a very valuable thing for consumers even these days.
What are the best deals that you can get? You know, if I want to get to San Francisco, should I book a flight to Tokyo? If I want to get to London, should I book a flight to Berlin? Like, what are the best deals that you see?
So whatever is the best changes every few minutes, and your way of figuring out what's best is to just go on our site and search like you would anywhere else.
But what are the biggest wins that you've found recently? Or do you have someone coming up to you saying, man, I just booked a flight to Miami and I really only wanted to get to Savannah and I saved, you know, $300?
Yeah, we have seen crazy savings, thousands of dollars, with families booking for like 5+ people. It really like it shines for last-minute tickets because that's where airlines are trying to charge consumers the most.
Okay, so we're in the middle of May. People are probably looking to June, July, maybe August. What is your advice to people who are looking into the summer travel season?
To shop around, like knowing your options. It's such a fragmented industry that like no one platform will get you the best price. But I would, of course, recommend checking out our website because we are trying to be as transparent as possible and giving you the options. Like we want you to get from A to B as much as you do.
All right, skiplag.com is the website. Akhtar Zaman is the CEO and founder. Thanks so much for joining us, Akhtar. Let's get a quick check of what's going on in the markets right now. We've seen very little change on the S&P today, but it's been hovering above the zero level. So right now, 58.89, and we bounced up over 5,900 for a moment. The U.S. 10-year yield coming up almost 3 basis points now, just to the brink of the danger zone, right? 449.46.
4.5% is the new kind of status, and obviously the tax talks are going on. We'll talk more about that. Before that, we're going to get a look at stocks moving under the hood this hour. We're going to bring in Bloomberg Equities reporter Alex Semenova. What you taking a look at?
Hey guys, a lot going on today. I'm taking a look at American Eagle. That company is taking a spill today after withdrawing its guidance like a lot of companies have this earnings season. They cited a challenging quarter that was marred by discounting and a write-down of inventory. They said that comparable sales are expected to be down about 3% and revenue is expected to be about $1.1 billion. That is down 5% from a year earlier. And the company not really casting any blame here, not citing tariffs, just citing macroeconomic uncertainty after a challenging first quarter for the company. Their CEO said that they're clearly disappointed in their execution. They said that their merchandising strategies did not drive the results that they anticipated.
KKR, you're going to tell us about KKR, but it's funny because I have the person who knows the most about KKR in the whole building to my left.
There's an upgrade, right?
Yeah, they got an upgrade from Morgan Stanley today to overweight from equal weight. They said that they recommended it as a way to play the capital markets recovery that many people anticipate. They also said that it represents an attractive entry point right now because it's actually been underperforming a lot of other alternative sector companies. They raised their price target to $150 from $120. It closed at about $127 yesterday.
It's about $129 right now, looking at a nearly 13% drop on the year. All these firms have been down, but it's interesting. Great story on the Bloomberg terminal today that shows you that now people are all excited about private credit again because things are kind of tough out there and private credit would then step in. It was tough for a while for Boeing. They have been an absolute darling this year. They are an absolute darling today.
Yeah, they're up 17% this year.
Really experiencing a nice comeback. And of course, they just won an order from Qatar Airways amid a flurry of deals coming between the Gulf nations and the U.S. during the president's visit. The agreement is for the 160 aircraft. According to the White House, they said that this is the largest order in the company's history. And the commitment is obviously a big win right now, which is coming at a time when there are a lot of delays by Boeing for the Air Force One presidential jets.
By the way, you ever skip the last leg of a trip, Alex, to get a cheaper ticket?
I don't, but I might have to consider it.
I actually forgot to ask Akhtar. Apparently, sometimes the airlines will ban will ban you as a traveler if you pull that on them.
Really?
I got to find out if that's legal, because they're worried, right? They want to be able to keep track of you wherever you are. So
fascinating.
I'll try it and see if I get banned.
Right, you go first, right? We'll follow you into that.
Alex Semenova, thanks very much for running through the stocks on the move with us this morning. Coming up, Morgan Stanley portfolio manager Caterina Simonetti joins us, and she'll tell us why she's remaining cautious even amidst this rally. Not today, obviously, but what we've seen since the bottom. This is Bloomberg Open Interest.
I think the geopolitical tensions right now obviously are front and center for us as we think about where to invest and how to invest. And in China in particular, you have to avoid those sectors that have sensitivity on both sides of the ocean, both the US government and the Chinese government. So we have not invested in some of these sensitive sectors like electric vehicles or semiconductors or AI. We're really focusing on super high quality domestic businesses that are around domestic consumption and services. So in our portfolio today, we have one of the largest, or the largest Chinese pet food company. Again, geopolitically not sensitive. We own one of the largest pharmacy chains in China. We own the largest white mushroom grower in China, all geared towards the domestic market, a growing middle class who wants higher quality goods and services and food. You know, and I think that's the sweet spot of where we're focused in the market today.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Now, two of Wall Street's major trading desks are making the same bold call as U.S. stocks see trade tensions easing and finally get some buyers. They are piling into the biggest losers, though, for quick short-term profits. This is at least according to Citigroup and JP Morgan, who are bullish over the next few weeks on small caps, technology hardware, and home builders, all of which have lagged the broader index and are yet to see a more significant rebound. Joining us now, Caterina Simonetti, Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager. What do you make of this call? Do you start to buy the laggards?
Well, we absolutely should take advantage of the market opportunities, especially since we saw such a such an incredible move in the market over the month of April. I mean, this is when you think about the experience that investors have been having over the last couple of years, where S&P returned over 25%, both in 23 and 24. Investors got numbed to some extent to the risks of the market and are expecting this higher than average level of returns. So when we see the decline, like we saw in the month of April, we have to make two conclusions. We have to do two things. One is consider whether we are investing appropriately, both from the perspective of income and asset allocation. And on the other side of it, we of course have to be opportunistic and see these incredible buying opportunities, both in defensive areas and also in growth areas that this market presents.
Do you think there are incredible buying opportunities right now, Katerina? I mean, back up at 5,900, back up at valuations that are, at least in large cap stocks, higher than the historical average?
Well, Matt, there are always sectors, first of all, that are just generally tends to be a little bit less sensitive to the possibility of economic recession. And while we certainly are more bullish and the chances of the recession declined significantly over the last couple of weeks, we're still not out of the woods. So areas like energy, utilities, absolutely present buying opportunities no matter what happens in the market, because they seem to be profit driven, they pay good dividends and resilient to economic environment. But we also cannot discount the tech, because the changes that we are seeing with AI, with the potential for profitability across the sectors, the changes that AI is going to bring to healthcare, to fintech, to industrials are just absolutely incredible. And that's why when we look at technology, again, like when we look at the volatility in the month of April, number of the tech companies held up pretty well. So when we look at the earnings revisions, at the forward-looking positioning of the company in terms of profitability, absolutely, we think there are companies that present buying opportunities. This is a stock picker's market, and this is a chance for us to pick these stocks up at the prices that are just relatively low in comparison to where they could be.
Katerina, what is the hedge? I guess I've been whining for the last couple of days about. I'm sorry about the scratch.
That's right. You want to take a sip of your?
I'll take a sip of my water, but.
Yeah. What's the
hedge? That's my question.
Yes. What is the hedge, and how expensive is the hedge right now, Katerina?
So if nothing, this breather in the market, the month of April, has been a bit of a wake-up call for a lot of long-term investors, especially investors that are near retirement. So there are two things that we can do. One is, of course, increase the positioning in fixed income, because we still have the benefits of high rates. And again, when we look back historically, we have not seen rates at these levels for over 20 years. So going into high quality fixed income is an absolute hedge. On the other side of it, we see a lot of concentration as a result of this Max 7 phenomenon. Their portfolios, many of them are lump-sided with higher than normal holdings, both in individual equities and individual sectors. And this is a perfect opportunity to rebalance, go into quality, also gradual buying into this market amidst the volatility. That's a perfect hedge to they take advantage of the volatility, but also de-risk the portfolios, which we absolutely must do in order to get, through these times and of uncertainty.
By the way, Katerina, you talk about investors being numb to the volatility. I'm wondering, are you talking about all investors? Are you focused on retail investors or institutional as well? And B, do we all expect some kind of put, if not a Fed put, then a Trump put?
Well, the investors certainly have different outlook versus traders. So when we look at the longer term horizon, individual investors, they are numb to the volatility because they're thinking, well, market is going to come back probably, and seeing the recovery from the month of April kind of just justifies this. But it's not a good reason to stay not invested properly. We should almost mentally go back to the April and say, this decline, was I okay with it? Should I make some changes now? Versus trader mentality, which is very strategic, opportunistic. What can I pick up right now? Valuations, looking at the earnings revisions, looking at this idiosyncrasies in the market and buying opportunities that this market presents amidst both the tariff policy, tax policy, and absolutely Fed right now after this pause in the tariff tariff policy is going to be more inclined to cut rates and stimulate the economy further.
Katerina, I guess I'm pretty stunned, actually, that you're not seeing actually a bigger bid in some of those big tech names in the Magnificent Seven. NVIDIA is still negative on the year, and the Trump administration couldn't be clearer that they would run around the entire world to strike deals to protect this industry. Do you not feel this way about it? Matt?
Yes. I do. Yeah. I think that we have to go into trades like this with eyes wide open. We have to extend our time horizon, because absolutely the role of in the profitability of stocks like that play a big role in the AI sector can absolutely not be discounted. And again, it's going to morph into other industries. And as we expand into our international trade, there is absolutely profitability opportunities, buying opportunities. And with the tailwinds from the government, this is going to go even farther. So we see buying opportunities. We just tell investors to proceed cautiously.
All right, Katerina, thanks very much for joining us. Katerina Simonetti there of Morgan Stanley, talking about the risks inherent really in investing, not just in these markets, but at all. Coming up, Speaker Mike Johnson is expecting a deal on the SALT deduction cap today, or at least before July 4th. We'll have the latest from Washington, D.C. This is Open Interest.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
There is some wiggle room. How much wiggle room, that's what we need to determine. But at the end of the day, I think both sides will come together to get this done for the American people. Because what we'll see if we don't get this tax bill done will be gravely worse than what we're experiencing now with the SALT cap for all Americans.
That was Representative Lisa McClain, chair of the House GOP conference on ballots of power yesterday, addressing the ongoing negotiations over the state and local tax deductions that were a cornerstone of our tax code for over 100 years. Speaker of the House, Mike Johnson, says that a deal on SALT, the cap that Trump put in 2017, likely will come today. But he said that yesterday, and maybe today he feels differently. Let's bring in Kayleigh Lines, anchor of Balance of Power, to figure that out. Kayleigh, House Majority Leader Steve Scalise says at least it'll be done before July 4th. What do you think?
Well, certainly the House Republican leadership is still trying to sound optimistic on the timelines here, Matt. They want the bill on President Trump's desk by July 4th, to be clear. They're hoping it will pass out of the House and head to the Senate by Memorial Day. But the SALT cap remains one of these outstanding issues that is a barrier to getting that done. The House Ways and Means Committee, after a marathon overnight markup that lasted more than 16 hours, did pass on party lines this tax package out of committee, but did so without having figured out what the SALT cap could be raised to that will pacify those SALT caucus of Republicans from states like New York who do not think the current $30,000 level in this bill is high enough. And that is what the Speaker is now directly negotiating with these members over. Keeping in mind, of course, that they do have a great deal of leverage because only 3 votes can afford to be lost in the House of Representatives with this very narrow Republican majority. And they also argue that accepting any cap is actually them making a concession, because if these tax cuts from the 2017 Act were not to be extended, there would be no cap on the state and local tax deduction. The other thing we have to consider here, though, is whatever number they ultimately come to in the House, whenever that happens, if it can get through on the House floor, it then goes to the Senate. And there are no Republican senators from blue states. The House is unique in that sense. So there may be Republican senators who are looking to take down not only a lifted SALT cap, but other elements of the Republicans in the House measures as well, including the rollback of clean energy credits, for example, from the Inflation Reduction Act, potentially looking at narrowing the scope of cuts to Medicaid. And all of that could complicate the efforts to getting this whole thing done and through both chambers of Congress by the 4th of July.
Kayleigh, why do we hear from, just now we heard from McLean and we hear from Rick on your show all the time that if the TCJA isn't extended, it's going to be horrendous for all Americans. But that's just not true at all. If the TCJA isn't extended, we get no cap on state and local deduction. We get a jump in the amount of mortgage interest you can write off. We get personal deductions for, dependents for every member of your family. I mean, for thousands, if not millions of American working class American families, it would be much better without the TCJA.
Well, likely what all of those individuals and President Trump, mind you, who argues if this doesn't pass, it will be the largest tax hike in American history, would say you have to look at the other parts of the country as well that don't necessarily have the concentrations of wealth that the coast do in states like California and New York, looking at potentially an income bracket, say, at the highest level, moving at a tax rate higher than 37%, which happened in 2017. That's the level where it was set. And this bill, of course, does not do what President Trump had floated, raising that threshold to 39.6%. So obviously, depending on your location, what constituency you are representing, you may feel differently about this. But the wide messaging you are getting across the Republican Party from the halls of Congress all the way to 1600 Pennsylvania Avenue, and the messaging you're getting at the White House is that there would be greater economic consequence if the tax cuts were not extended than those who might benefit from the SALT cap going away in states like New York. All of that said, of course, this is why it fits into the president's economic messaging as well, as he tries to explain that tax cuts are part of this policy, not just the inaction around tariffs, which potentially, of course, have detrimental economic effect with inflation and growth. He says this is key to kind of balancing the scales.
I do want to have you comment for a moment here on what's happening with the universities in this tax bill as well, because you have the Trump administration versus elite universities, Harvard and Columbia, for example, but you also have Harvard, Yale, Stanford, Princeton, MIT facing a higher levy here, but also colleges that are not as wealthy facing rises too. What kind of pressure is that going to put on endowments?
Well, it could potentially put great pressure on them, Shonali. You're right. There are institutions that are feeling direct retaliation from the Trump administration, which in fact yesterday froze another $450 million in grants to Harvard specifically. But the lifting of the endowment tax here is really substantial, from a rate that was quite marginal in the single digits to now as high as 21% that these universities with large endowments are going to have to pay. And that could have drastic impact on their finances, on the financing specifically of research, where a lot of things like health research emanate from these institutions. But that is one of the pay-fors Republicans are looking at here, knowing that there was only so much they could actually do in terms of adding to the deficit and trying to cut spending as well. It's all about trying to make the math work, but universities may feel the pinch as a result.
All right, Kayleigh, thanks very much. Kayleigh Lines there, co-host of Balance of Power. You can catch her program at 1 p.m. and 5 p.m. right here on Bloomberg Television and Radio. Coming up tomorrow, Stuart Kaiser joins us from Citi, as well as Liz Ann Saunders of Charles Schwab and King Street founder Brian Higgins.
Asia is a continent of contrasts. The region is a nexus of rich cultural traditions and a vibrant hub of trailblazing innovation and modernity. How will it push the limits of technology even further?
Going to space should become as easy as, taking a flight.
If NASA is designing a lander, their approach is they're designing a Formula One car. So we take, say, a Jeep approach.
Min-Sung, give us a sense of how you translate Korean architecture for the rest of the world.
We call this madang. In general terms, it's where we can be ourselves, where we belong.
There is an old saying in Korea that says, "Komi bulu, hwai bulchi." It means simple but not humble. So it has a tremendous impact on Korean architecture.
People tend to think the robot AI taking the job from them. We want to use the robot as a basic asset, meaning people have an income through the robot.
From space tech in India to robotics in Japan, Asia is driving the future, reshaping industries, societies, and the way we live. Join me as I take you through the bold innovations. Discover Asia's next-gen technologies on Momentum.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from San Francisco, this is Bloomberg Technology. Coming up, the Trump administration moves to rescind the AI diffusion rule launched by President Biden, looking to draft its own approach. Plus, the US is clearing a path for Saudi Arabia and the UAE to pursue their AI ambitions, with Nvidia and AMD winning multi-billion-dollar deals in the region. And a ban on supersonic commercial flights over US land could soon be history. Let's get to financial markets, the technology sector, and AI infrastructure. These are the big movers to the upside. We talked about in the last 24 hours the deals that Nvidia and AMD won to sell their cutting-edge processors or AI accelerators to Saudi Arabia. Note the outperformance of AMD, up around 5%. They also are doing a $6 billion additional share buyback. They already had $4 billion of buyback outstanding. Supermicro with its own $20 billion deal for data center infrastructure in the kingdom. Then there's the rethink on rules about technology export controls to the Gulf and other nations. The US has formally moved to rescind the AI diffusion rule and made it clear it would no longer be enforced while the bureaucratic process of revoking the rule unfolds. Bloomberg's Mike Shepard joins us now for more. We're making progress towards a place where America's biggest technology companies can sell that tech into regions like the Gulf. But China's an outstanding question.
Yeah, China is the outstanding question, and we're getting no signal from the Trump administration that there will be any relaxation of restrictions when it comes to China, especially not in the wake of DeepSeek's breakthrough. We did see just about a month ago the Trump administration move to bar NVIDIA from selling its H20 chip to China. This is a device that was designed for the Chinese market, and that is out of concern that the startups in China could use this chip as part of the inference model that could achieve AI breakthroughs. And the same thing applies to AMD's MI308 chip. So we are not seeing any relaxation of standards there. And while the administration is moving away from the AI diffusion rule, which set up, as you remember, Ed, these three broad tiers of countries governing their ability and their access to buy AI chips from AMD and from NVIDIA especially, they are replacing it with something else. And this will be, we expect, a more bilateral approach, that each nation would forge its own agreement with the U.S. and achieve some sort of security understanding whereby China would be prevented from acquiring the technology either physically or perhaps via the cloud. They would need to show security arrangements and standards before they'd be able to get through the door and acquire those chips, Ed.
The state of play of the last 24 hours is NVIDIA, the most important U.S. technology company right now, has a deal with Saudi Arabia. AMD has a deal with Saudi Arabia. But in terms of what comes next, you alluded to it, we expect bilateral agreements between the United States, Saudi Arabia, and potentially the UAE at a nation-to-nation level.
Well, that's right. And we were expecting to see some of that even during this trip. The president is still in the region. He has left Riyadh. He's in Qatar right now, accepting the perhaps new Air Force One that we've heard about so much this week. And then his next stop will be in the United Arab Emirates. And they also have a huge stake in the AI game. And they have, like Saudi Arabia, big ambitions in this area. Their G42 company is really looking to leave a mark in the region. And one deal that our colleague Mackenzie Hawkins broke the news on would be perhaps allowing G42 to buy hundreds of thousands of these AI processors from NVIDIA over the next several years. And that would be a key breakthrough for the company and for the Emirate, which has these ambitions of expanding into AI and into advanced technology as a way of diversifying its economy. It's really critical for them to expand beyond just oil and gas that has made them so rich over the years.
Bloomberg's Michael Shepard out of Washington, D.C. Thank you very much. Let's get more on the market reaction. Bank of America came out saying that NVIDIA and AMD have a multi-billion-dollar opportunity related to AI infrastructure projects, specifically in Saudi Arabia. And there's a lot of bullishness out there about the prospects of the deals announced in the last 24 hours. Nancy Tengler is CEO and CIO of Laffer Tengler Investments, and those were deals between American companies, leading American technology companies, and that Gulf nation of Saudi Arabia. As an investor, how did you react and respond to that news?
Well, thanks for having me, Ed. I mean, of course, it's optimistic rhetoric and potentially super beneficial to the ultimate earnings of the companies. We need to see when these investments come in, and the timing and the volume. But I think just on an overall basis, what it does is it replaces the lost revenue from China. And it may not dollar for dollar, but it does psychologically. And so we were in buying these names. I've been on with you many times. We were buying in January, February, and March, not just NVIDIA, but a number of the software-related companies around AI, and then, of course, Tesla. And I think that's a lesson to everyone that this trade is not over. Wall Street tends to be very short-term focused. Investors like me tend to be longer-term focused. And what we learned yesterday is confirmation that we're early innings in this AI build-out, and it is potentially the fourth industrial revolution.
Right.
And it is similar to what we saw in the 90s in terms of productivity enhancements.
Nancy, stay with us and bear with me. We have some news crossing the Bloomberg terminal. eToro Group's US shares are indicated to open at $63.50 each. This is pending trading on an IPO that priced at $52 a share. So priced at $52, but indicated to open at $63.50. The marketed range was $46 to $50. eToro, basically a rival to Robinhood, the trading and investment platform, Israel-based company. And this is a IPO that would give the company, at its $52 IPO price, a market cap of about $4.3 billion. Nancy Tengler, while you're with us, I see some green shoots. Is that one way to put it in this US IPO market?
Yeah, I do think you're right, Ed. I mean, this one makes me just a little bit nervous because it's piling on to day trading, I think, in many regards. However, I love seeing the retail investor engaged, in fact, much more so than the institutional investor. And I do think that we'll continue to see acquisitions, M&A in general. We just launched a mid-cap strategy for that very reason. So I do think this is bullish for the economy and the overall market, and I commend them on their day one of trading.
Let's get back to the big story, which I think is AI infrastructure and the relationship between the United States and the Gulf. What we're trying to understand is what happens next. Our colleagues at Bloomberg Intelligence did the analysis on how much revenue NVIDIA and AMD will derive from that Gulf region. So $10 to $15 billion in annual sales for NVIDIA through 2027, just $1 to $2 billion for AMD in the same region. But here's the key bit. Cushioning the blow from unchanged China export curbs. We opened this program saying that the diffusion rule has been rescinded, but a new specific Trump-era rule will come. How do you think they will approach China?
Yeah, I do think that is the good news in all of this. As I said earlier, the difficulty for investors in NVIDIA was what were they going to do if China was taken off the table as a potential customer. So I still think we'll see chips sold to China. The question is in what form, and then the question is how much does NVIDIA and AMD need that revenue if they're opening up, if they have opened up new markets for distribution. So I think what the Trump administration has done is isolate certain adversaries, so think Iran, Russia, China, by going on this goodwill trip to the Middle East.
Let me show you a chart. And this chart shows that as of today's market open, NVIDIA jumped above Apple as the world's second most valuable company. Microsoft remains in place as the world's most valuable company. Given everything that we've discussed and the events of the last 24 hours, where do you need to be right now, Nancy? In the infrastructure play or in the software hyperscaler play with Microsoft?
So I do think at the margin you want to be adding to the software play, which is, we added to NVIDIA twice this year, but we also added to Microsoft and Palantir, and then some of the cyber names, Oracle as well on the software side. So I think that is going to be the next stage of build out, and we took the proceeds from names like Dell that we felt like had a nice run, and on a valuation basis relative to growth and margins was probably mostly worked out. It's that's been a good call so far. But I think you want to, if you have to pick, I think you want to pick software over hardware.
Nancy Tengler of Laffer Tengler Investments, thank you very much. Now, coming up on the show, Tencent weathers the global tariff turmoil, posting a revenue jump of 13%. We're going to go to China and talk about that company next. This is Bloomberg Technology.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada. and this is Bloomberg.
Tencent saw revenue grow at its fastest pace since 2021, posting a 13% jump in sales to $25 billion in the March quarter. The results giving confidence to investors that China's most valuable company could weather a potential global downturn in 2025. For more, Bloomberg's Henry Wren joins us. And Henry, I mean, what are the main factors that drive growth in Tencent's business right now?
Yeah, two growth engines to mention. One, the most important one is the domestic gaming business. And that has been the key driver for the quarter. And the company said that its evergreen games, such as Honor of Kings, has registered record high levels of gross receipts in the quarter. And that has been the most important driver. And some newer games also shine as well. For example, the 2024 released game called Delta Force also has become one of the most played games in China. Another driver has been about the advertising revenue, which grew by about 20% in the first quarter. And that's down to the WeChat app, the short form video platform embedded in WeChat that has impressed as well.
This is a company that's heavily investing in AI research and ways to monetize, to create products with AI. What do we learn about that?
Yeah, a lot of focus, as you can imagine, probably on the analyst call is about, what's your plan about AI investment and how do you look about the recent ban on restrictions on AI chips in China. And the company gave a very long but pretty honest answer in terms of restrictions. And first, in terms of investments, the company is still investing hard in terms of CapEx. We are talking about the company doubling its CapEx versus a year earlier, although easing off slightly from the 4Q levels. But in terms of restrictions, the company said, well, in terms of the key businesses, for example, the promotion of advertising as well as the gaming business, the current backlog of AI chips is probably enough. But in terms of AI training, the company needs more powerful AI chips, the more powerful cluster of chips. However, the focus for now is to improve on the software side, given the restraint.
Bloomberg's Henry Wren on all things Tencent. Thank you very much. Another story we're tracking, no-fee banking startup Chime filed publicly for an IPO, resuming plans it had placed on pause when Trump's tariff plans ruled markets last month. It's the latest company fast-tracking its public offering prospects. More on the IPO outlook. Bloomberg's Katie Roof joins us. And Katie, we're tracking so many names at once now, which is interesting of itself. Tell me about Chime, what we know about this, the mechanism at which they want to go to market.
Yeah, so we saw Chime's IPO filing yesterday. They're the no-fee bank that was valued at $25 billion in the 2021 boom. They've raised a lot of money from many different investors, including Menlo Ventures and Iconic. They usually, when there's a filing, you want to go public a couple weeks after you start your roadshow, so usually within a month, although recently the tariffs had delayed several of the ones that had filings flip public. But, we're starting to see IPOs again with eToro.
With eToro, if you're just joining the program, just before we came on air, eToro's US shares were indicated to open, Katie, at $63.50 each. $63.50 each. The IPO priced at $52. We're waiting for that start of trading. eToro is an interesting one. Israel-based trading platform, kind of a rival to Robinhood. Tell me about this IPO.
Sure. Well, it was a long time coming, not just, with IPOs getting delayed repeatedly the last few years, but also this is a startup that's been around for more than 15 years. And, they're finally going through with their IPO. If you look at a comp, Robinhood's been surging year to date. So it actually makes a lot of sense that eToro would want to go public in a market like this.
Bloomberg's Katie Roof on all things IPO. Thank you very much. Now, coming up on Bloomberg Technology, we're going to hear from the Twilio CEO, Cosima Shipchandler, as the company kicks off its Signal Developers Conference back in person for the first time since 2019. This is Bloomberg Technology.
your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
In case you missed it on the opening trade.
How big a headwind is that going to be to my performance over the next 6 months, next 12 months? That dollar story, that dollar factor, that FX overlay.
Yeah, I don't think you can overstate the importance of this dollar shift. As we start to see a convergence of relative economic and profit growth rates, you are starting to see some of that overvaluation unwind, and it's shifting portfolios.
Don't miss the opening trade live every weekday.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I caught up with Twilio CEO Cosima Shipchandler as the company's bringing back its Signal Developers Conference to San Francisco in person for the first time since 2019. And that kicks off today. And as a part of that, they announced a new multi-year partnership with Microsoft.
So with respect to Microsoft, we announced a multi-year strategic partnership. Obviously, they're an incredible brand. They've got great enterprise scale. We really view it as 2 great companies coming together to be able to deliver on the vision that we've laid out. In particular, we're going to use them for their amazing AI technology. I think they've done some really interesting things with respect to Azure AI workloads. Again, we're going to bring that together with our contextual data capabilities, plus our communications, all in one platform. I think importantly, we're increasingly going to market as an infrastructure layer, one that unlocks the customer experience layer of the internet, if you will. And I think Microsoft's going to be a big part of that story.
So do we view this as kind of a sales channel move? There's an argument that working with Microsoft in this way on a shared common platform helps Twilio go after a much larger addressable market in which it hasn't historically played.
I think that's definitely a possibility as time goes on, but we're really starting from the foundations as a technology partnership. You know, we both pride ourselves on delivering technologies for builders. As I mentioned a moment ago, you know, Builder is very much in the ethos of the company. Their technology conference, which is in a week, is labeled Build. And so I think that just fits nicely together. And I think we'll see how things go there. We're very proud of some of the abilities that we're launching together. And I think it does open the door for commercial relationship down the road.
That was Twilio CEO Cosima Shipchandler. From partnerships to team sports. That's what venture capital has always been a bit of. But now we're seeing the rise of the solo general partner, where just one person raises the money and makes investing decisions. Joshua Browder is one such solo GP. His firm Browder Capital just announced a $30 million raise for its 4th fund. Joshua is with me in the studio. And those watching probably know you best as the CEO of Do Not Pay, which short description is an AI-powered lawyer chatbot that originally helped you get out of parking tickets. Why do you want to raise that much money and invest it on your own without any partners?
So I specialize in backing young founders. I'm an investor in more Teal Fellows than anyone else. And I think young, undiscovered talent is really a great investment opportunity. I was lucky to be the first investor in a company called Owner, which yesterday announced around a $1 billion valuation.
Right, so you took them from basically pre-seed when you made your investment to unicorn status. So you're now saying, you think you can do this?
I think that everyone is chasing hype, but young founders are really the future, and I love undiscovered people that everyone is passing on. And I go all in. I have one staying with me right now in my apartment. I put their...
What do you mean by that? So you've invited someone you've invested in, you've given them a home?
Yeah, give them a home, give them their first check, and really put them on the circuit. And I love to relive my own founder journey. And founders love working with other founders.
So the core question here is, why is that more beneficial to the founder than them taking a check from one of the giant firms?
They're not even ready to take one from the giant firms.
Right.
I catch them on day one, and everyone is chasing hype. I think the way to win is actually create your own hype and create your own winners.
It's interesting where you raise the money from. So one of the anchors of Fund 4 is Sequoia, a very large firm. We will have a partner from Sequoia on later in the program. But Marc Andreessen also contributed to the fund personally with his own money. Why might he do that?
I think he has a tradition of putting first fund managers in business, and this is my first institutional fund. I should mention he's also the first investor in Do Not Pay.
But he did that through Andreessen Horowitz, his giant firm. So now he's giving money to you personally out of his own pocket because he feels that you can, get to founders earlier than Andreessen Horowitz can at this stage.
I would just say it's about helping the ecosystem.
What's the strategy here? What kind of size checks will you write? What cadence of deals do you want to do? Because we're talking early stage.
So there's so much noise right now. People are doing dozens or even hundreds of deals a year. I want to take the opposite approach. I take one person every month or every other month and go all in for them. And that can be a $200K check, and it can be as high as $1 million.
Is it like more akin to an incubator than it is to sort of traditional seed, Series A, Series B round?
It's really up to the founder to build their business, but it's almost like an incubator. I feel like I'm a railroad conductor putting them on the right track.
You also have a job at Do Not Pay. How are you going to manage that? Leading your own startup as well as backing others, finding the next Do Not Pay.
Founders really love to work with other founders, and I think it's an unfair advantage being a founder and an investor. No one likes to work with a money manager or a professional investor, and because I can give that founder energy and share solutions to problems that I've overcome, founders really appreciate that.
What are the learnings you're taking from the Do Not Pay story and how you want to approach this? Like I recall a story where you had breakfast with Marc Andreessen in 2016, and at that time, Do Not Pay was going to be a not-for-profit, but you were convinced otherwise by him.
Yes, and the tiniest moment or strategy change can change everything, and I want to be that for my founders. I've dealt with problems that I can help them uniquely with. So, for example, how to get that app classified so that they're not paying 30% to Apple, which is something that we always deal with at Do Not Pay.
Joshua Browder, CEO of Do Not Pay, plus the solo GP and founder of Browder Capital. Thank you very much. Now, coming up on Bloomberg Technology, we're going to talk more about what these deals in the Gulf mean for AI development with someone who's been investing in AI for a decade, Sequoia's Konstantin Bühler. He joins us next. This is Bloomberg Technology.
I fell in love with cricket. I started reading about cricket. Cricket is not a very simple game to follow. You need to understand it. And here I didn't know a simple thing like there are different kinds of bowling, like there is a spin bowling and there's a pace bowling, and in spin bowling there is a different kinds of off spin and a leg spin, and in pace there is a swing. And so it took me some time to just start talking to all these boys of cricket. I spoke to Sachin, who is known as a god of cricket, and I would ask him such embarrassing questions. But yeah, today it feels very good to see Mumbai Indians doing so well. My son is leading it. But also I think the Mumbai Indians women's team is something that fills my heart.
Why?
With joy. I think these girls go through so much to get to where they are. Right from seeking permission from their parents who are not willing to let them follow their dreams. Financial issues. When you see them all coming together from these remotest villages of India and play for you and tell you these stories, it's just so inspirational to see our girls in sport.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Alex Steele in Houston, Texas, and this is Bloomberg.
Apple is investing $500 billion. NVIDIA is investing, and I see my friend is here, Jensen. That's very good, wherever you may be. Thank you very much, because he's putting in $500 billion. TSMC is investing $200 billion, and with this trip, we're adding over $1 trillion more in terms of investment.
Welcome back to Bloomberg Technology. I'm Ed Ludlow in San Francisco, and that was President Trump there in Riyadh yesterday, talking up all of the deals that have taken place in the last 24 hours, largely in AI infrastructure. When it comes to financial markets, there's like a bit of fatigue out there, although up basically half a percentage point, the NASDAQ 100 is outperforming other major indices. What the president also said on Air Force One last night is that he wants America to lead in both the theaters of AI and crypto, although Bitcoin under a bit of pressure, 103,000 or so US dollars per token. These are the single names that we're really focused on in tech stocks right now, and they are principally the chip makers. NVIDIA and AMD both securing multi-year, multi-billion-dollar deals to ship their latest generation AI accelerators to the Kingdom of Saudi Arabia, and Bloomberg also reporting, citing sources, that a deal with the UAE is coming as well. Bloomberg's Anne-Marie Horden is in the Gulf and has been following the latest on President Donald Trump's visit to the Middle East and joins us now. AMH, the centerpiece of all of this is the deal between two leading, or maybe more than two leading American technology companies and their access to markets in the Gulf.
Yeah, absolutely, Ed. This is really one of the standout pillars of the president's trip, and it's transformational for a lot of these Gulf countries, which traditionally have relied upon their influence, their wealth being from natural resources, to now they're thinking about the future. And to have that future, to have AI data centers, they need to get their hands on advanced semiconductors. And you know, as well as anyone else under the Biden administration, there was frustration with these geopolitical swing states on getting access to those advanced technologies. There was something called the diffusion rule. The Trump administration decided they were going to cancel it. And I actually quickly had a conversation with Jensen Huang last night as he was walking into this honorary dinner with the president in Riyadh. And I said, what do you think? They rescinded the diffusion rule. And he looked at me and said, rescinded? Canceled? AMD, right. NVIDIA are elated about this new marketplace they can come to when it comes to advanced technology. But Ed, you know, there is still this China question that is looming over all of these deals.
Right. The business in the Gulf, Jensen can take potentially like market opportunity lost in China and make much of it back in the Gulf based on the research I've seen this morning. The business of geopolitics, those outstanding questions on China, and there are more deals to be done between the United States and the nations that the president's visiting. What happens next, AMH?
Yeah, he's going to go to UAE, and we have a report that potentially the UAE is going to buy 100 million of NVIDIA's high tech, these advanced semiconductor chips. No surprise in the sense that Sheikh Tahnoun was in the White House just a few weeks ago, and he then left, and the UAE announced $1.4 trillion of investment they would like to make. But an asterisk, a part of that deal, of course, is that to make that kind of investment, they need access to these chips. But Ed, you talk about NVIDIA and this potential new market share they can get in the Gulf. When I talk about China, though, and the conversations that are happening in the region, especially these bilateral conversations, and probably some of these conversations still to be had because they're working this out, is that if these countries get access to these chips, how do they make sure the tech does not leak to China? That is still a national security concern that has bipartisan support in Washington, D.C. These Gulf states want to work with the United States to make sure they can do that. But potentially you can see almost these AI data centers hubs where they're on these lands, whether it's in the United Arab Emirates or whether it's in the Kingdom of Saudi Arabia. But the U.S., and this is a story I had reporting on, but the U.S. would control the access to that tech because they want to make sure that that technology does not get into the hands of Beijing.
The US controlling access to the technology. Bloomberg's Amarine Hordan in Doha, Qatar. Thank you very much. Let's pivot from the geopolitics of AI to the investing side and bring in someone who's been involved in the sector for a long time. Konstantin Bühler specialized in AI machine learning investments. He's a partner at Sequoia Capital, where last year, nearly 70% of the startups the firm invested in were AI companies. Let's start with just simply your reaction to the AI infrastructure deals of the last 24 hours. US technology going to the Gulf and setting up data centers and AI development in that nation.
Well, thank you, Ed. It's always great to be here. And these new deals are testament to the fact that AI, artificial intelligence, is not just a matter of corporate success, it is a matter of national imperative. It is a great sign of the importance of this industry. I think back to a decade ago, and we had concerns about the U.S. staying ahead of AI. There are really four key pillars to AI strength. There's the compute, there's the power, there's the data, and there's the algorithms. Thinking back to that last wave of AI, the reason why the United States has been so far ahead is that fourth pillar, those algorithms. So as we develop new technological allies around the world for compute, for power, for data, it's really important that we stay on the absolute forefront when it comes to algorithmic advancement. We have the best researchers in the world. We have the best engineers in the world.
Okay, I'm sorry to interrupt you, Konstantin. We've got some breaking news crossing the terminal. From the White House, President Trump has secured $1.2 trillion in economic commitments in Qatar. The Qatar commitment is $1.2 trillion. According to the White House, there are economic deals worth $243.5 billion. This is something the president has announced on the ground in Doha. We were just speaking with Bloomberg's Anne-Marie Hordan, who is in Doha, Qatar, and she noted that this is what's pending. We don't have the specifics in terms of sector, in terms of companies involved, but as we get that, we'll bring it to you. And right now, we'll go back to the conversation we were having, which is there is US leadership in the field of AI infrastructure. You basically broke down the four categories.
Yes.
One that is increasingly crossing my desk is AI memory in the context of agentic AI. This is something that people say we need to invest in this and solve it. I personally don't have the expertise or academic grounding to understand it. Why is your industry talking about it?
You're exactly right, Ed. So there's compute, there's obviously the data, there's obviously the power and the algorithms, but another important component is memory. Because when you interface with an agent, you want it to remember you, of course, but it also has to remember itself. Think about a physician, for example. Every time they interface with a patient, an agent is going to be able to help them think back to previous interactions, not just what the patient said, not just their vitals, not just data about the patient, but over time, using tools and companies like Open Evidence, the physician's going to be able to remember exactly what the interaction was like, how to communicate to the patient, and memory is going to become more and more important.
The question is, where does all of this activity take place, right? The subject of today's Bloomberg Big Take is DeepSeek, right? And the Big Take presents the hypothesis that the company's sudden emergence last month illustrated how China's industry is thriving, irrespective of US political policy. Jensen Huang told me in March, more than 50% of AI researchers are in China. When you think about the issues you've outlined, do you agree with that hypothesis presented, that China's AI industry is thriving, but also looking at the same issues that your industry is looking at here?
Well, it is true that they have amazing researchers there, but it's also true that we have some of the most creative, brilliant researchers on the planet. Here's an example. Just recently, we hosted our annual AI conference, Sequoia AI Ascent. We brought together 150 of the top minds in the industry. This is everyone from Jensen Huang and Sam Altman to the young up-and-comers. And the number one technical topic of the conference was a concept called tool use. Tool use is all about AIs working with each other. We're teaching the computer how to use the computer. And there was fortunately a big advancement in our industry over the past few months, a new protocol called Model Context Protocol. Think about each AI agent as an expert. Think about every piece of software as an expert. Your CRM is really good at remembering your previous interactions with customers, for example. The issue is that those experts don't necessarily speak the same language. What this new protocol allows is a universal translation mechanism so that all these AI agents and all these softwares can communicate. That is pivotal to us as the United States staying ahead. We have to be working together. I'll give an example of what this protocol could do for us. We have a portfolio company called Rocks. It helps the best sellers do really great research before meeting with a potential buyer. They can not only do that research now, they use MCP to connect and actually make a pitch deck directly on the specific needs of that user. They can even plug into Cognition or Claude Code and write an entire demo. That's how we stay ahead of the curve in AI, collaboration, and working together as researchers and engineers.
Sequoia partner Konstantin Bühler, great to have you back here on Bloomberg Technology. Thank you very much. Now, coming up, the sleep fitness startup 8 Sleep joins us to discuss its growth strategy and its new product lineup. That conversation's next. This is Bloomberg Technology.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back to the circuit. This time, we're taking you to the frontier.
Where is
do we have a camera, or do we don't want to lose you, Emily, in all of this.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China. In 2023, it's something like $40 billion. And whatever the tariff rate ends up being on China is going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
up-to-the-minute news,
technology news, geopolitical news,
economic news,
financial news,
bringing you the latest news in private markets
whenever,
and wherever it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France,
and this is Bloomberg.
Sleep fitness startup 8 Sleep is launching an expanded suite of products today. The company makes high-tech, temperature-controlled mattress covers and systems, and it's also expanding into new markets while talking up a potential IPO. 8 Sleep CEO Matteo Franceschetti joins us from New York. This is interesting. In my world, everyone around me tracks the data so carefully, maybe through a wearable and other means in sleep. Let's start with what's new. What is the actual proprietary technology you're offering and how it helps a consumer?
Yeah, of course. We develop our latest technology. It's called Pod 5. At 8 Sleep, we develop technologies to improve your sleep performance. And Pod 5 is a modular sleep system that controls your body temperature, your elevation, and sound to maximize your sleep. It does everything based on your biometrics, so we're also able to track everything about your sleep and your health in real time, and then we adjust the environment for you to improve your night of sleep.
Are these technologies and products that a consumer can get access to via their health insurance? Are you part of a broader sort of health network or system that's a go-to-market channel for you?
Not yet. Right now, we just sell direct to consumers, but it's part of our vision. At the end of the day, we see a future where the pod will be reimbursed by insurance companies because we have hard data proving that we can improve your sleep by up to 34%.
The reason I ask is you've had incredible growth, right? Revenue is 10x since 2020, a 5-year CAGR of 60%. And those are numbers, but what is it that's driving the growth? Like, what is it geographically, the demographic of the consumer, the sales channel that's helping you?
Well, first of all, I think our results. People really love the product and they see the benefits. Some of our customers, sometimes they also use wearables and they can see the difference in their own wearables of when they use the pod or when they don't. But what is really driving our growth, which is connected to this, is word of mouth. A very large part of our revenue is just because our customers recommend the product to other people. At the same time, we keep expanding. We're right now in 30 countries, and we expect to open Asia by the end of the year.
I think you're also looking at Saudi Arabia. Given the news of the last 24 hours, how did that come about?
Yeah, right. We were so lucky. We didn't know, obviously, about that, and we are announcing Saudi Arabia today, which we expect to be a very large market. We were already in UAE, and the fact that the president and so many other key CEOs are there is amazing.
You're also evaluating China. How realistic is it from a market perspective of the end user, but also supply chain for you to go into that market?
Yeah, we expect to launch in China by the end of the year. It's a market that we know really well. We have been manufacturing in China since 2014, when I moved there to really kick off the manufacturing of 8 Sleep. And we expect to start selling in that market, as I say, before the end of the year, in Q1 at the latest.
Will you support your growth with an IPO, Matteo?
I think it's part of our strategy, absolutely. I think great hardware companies like Tesla and Apple, they all went public fairly early. I think it will give us a discipline, and it will also prove that we are here to stay. We are very ambitious about what we can do for humanity to improve their health and their sleep.
Matteo, we're running short on time, but what I really want to get to is your core competencies. Have you got brilliant software engineers, brilliant hardware engineers? What is your biggest advantage?